All right. So next, let's begin the next chapter, the revision of PGBP, profit and gains from business or profession. So very simple, guys. If there is a P&L account that you're looking at, there will be the income side and there will be the expense side, and of course expenses are all covered under the section 30 to 37, whereas income is covered under the charging section is section 28, plus special income, deemed profit is given under section 41. So the all incomes are covered under section 28. Deemed profit is covered under section 41. Expenses are covered under 30 to 37. And whatever profit you get, that profit will be called as profit and gains from business or profession, PGBP. The tax will be computed at normal rates, and there is also special type of computation for certain things. It is called presumptive taxation. And then we have special sections called 40, 40 capital A, 43B. All these are special areas. So ultimately the charging section is which section? Section number 28. Charging section is section number 28. So income is defined in 2 clause 24. Income can mean profit, income can mean gains, income can mean losses also. Sir, is negative income is also, is it income? Yes. Negative income is also income. So income will be profit, income will be gain, income will be losses. Now we have two interesting terms called business or profession. Two interesting terms called business or profession. Now business can be, business and profession are mutually exclusive. If you use the word business, it is not profession. If you use the word profession, it's not business. So business is a word which has wide meaning. Business can mean any trade, any commerce, any manufacturing, whereas profession is a particular skill set. Once you become a chartered accountant, you will be a professional. Once you become a lawyer, you will be a professional. So when profession is concerned, what they have is intellectual or labor. It's basically skill. It's an intellectual skill or a skill with respect to your labor. Intellectual skill means what? CA, CS, lawyer, etc. Labor skill means what? Surgeon and sports person. Vocation. Vocation is your calling or vocation is your passion, which eventually will become your profession. For example, me, my passion was teaching, it still is teaching. So I took it up as a vocation, but later it became my profession. So basically, a vocation can, basically when you see the definition of profession, profession will include vocation. So vocation is your calling and a passion, whereas profession is your skill set, and business can be anything. So if I use the word business, I cannot use profession. If I use the word profession, I cannot use the word business. Okay, yes. So as far as business is concerned, as I told you, it is trade, commerce or manufacturing. There will be efforts involved. You will get the returns. It could be organized sector or unorganized sector also. So the Pani Puri fellow right opposite your campus can be, is a businessman, of course. Whether he pays tax or not is immaterial, but is he a businessman? Yes. So effort, return, organized sector, unorganized sector, everything is called as business. Profession is your skill set. Vocation is your passion. Nirmala madam doesn't care about anything. Whatever you do, pay tax. Simple. Simple logic. Whatever you do, you will have to pay tax. Right? Yes. Now, let us just, till your tea break, let us just understand the, what do you say, charging section. Okay. So any income means what? Business or profession. It can be earned any time. It can be earned one time in the entire year. It can be earned 100 times in the entire year. It can be earned for 6 months in the entire year. Doesn't matter. Whether it's a seasonal business, regular business, isolated business, it is 100% taxable. And whatever you receive, you may receive in cash or kind. For kind, you will have to do a valuation. You may receive a watch. For watch, you have to do the valuation, and then that also is taxable. You are a chartered accountant, you do a job really well, and your client will be very happy with you. Apart from the fees, let us say he'll also give you this watch. He will give you this watch saying that, let's say this watch is 20,000 rupees, please give. He will not tell you the money. He will give you this gift, take this watch. Now, is that watch also taxable? Yes, because there is a nexus between whatever you got and your business. So the entire concept is about the nexus. If you have a nexus or a bonding between that, then it is definitely taxable. So gift to a doctor, chartered accountant, there will be a nexus. Now if you give it in your personal capacity, let us say your client has always given you money, no problem. And now because your client has also become very close to you because you have been you have been his auditor or accountant for so long. Now on his deathbed, your client, purely because of the personal relationship he shares with you, he gives you a land, he gives you land, he gifts you a land. Now would that be taxable under PGBP? Answer is no, because there is no nexus. What is nexus? For the work that you have done, if you have given something, then only it is PGBP. Otherwise, it will not be PGBP. Okay? It will be, I am not saying it is not taxable at all. It will be taxable in IFOS, in the income from other sources, but it will not be taxable under PGBP. So I told you my client giving me a watch. Is it PGBP? Yes. Why did he give a watch? Because I did a good job. Did he give it for instead of fees? Did he give? Yes. Did he give in addition to fees? Yes. But why did he give the land when he was about to die? That was not because I was an accountant. That's because he felt a sense of a connection between us. And hence, as a token of endearment, so to speak, because he really liked me, he gave the land. Is there a nexus with the business as such? No. So there it is not taxable under PGBP. It may be taxable under IFOS. We'll see later. So anything you receive in cash, kind, valuation, all these things will be PGBP. Reimbursement of expenses is not PGBP. Voluntary payment made by client, nexus, I told you, watch, land, jewelry, trip, etc. If there is nexus, then that is PGBP, otherwise no PGBP. Employee is getting salary, definitely will not be PGBP. He is getting car, driver, gas connection, rent-free accommodation, 3 servants and all. This is not PGBP. That will be taxable in the hands as perquisite. There are two things: contract of service and contracts for service. If it is contract of service, it is employment. Contract for service, it is consultancy or profession. So you should look out for it. What is the type of contract? It is contract of service means it is employment. For service means what? It is consultancy or profession. Even if it's an isolated venture, once in 12 years, the Neela Kurunji flower will bloom in the Nilgiri region. Now it is coming in Chikmagalur also. In the Nilgiri region, it blooms only once in 12 years. When the Neela Kurunji blooms, I will take people from Bangalore to Munnar, and I'll show them everything. I am doing this entire exercise once in 12 years. Mother example, Mahakum. Mahakum happened once in 144 years only. I am organizing a tour to Mahakum, isolated venture, once in 144 years only. Is that also PGBP, the money that I earn? Yes. Everything that I earn will be what? Profit and gains from business or profession. So amount received, even in a keyman insurance policy will be PGBP, guys. So keyman insurance policy is taken by all the key managerial personnel, that is MD, whole-time director, manager, CEO, CFO. On the lives, I will take a keyman insurance policy because if they die, the company only can come down. Today, if anything should happen to Mukesh Ambani, Reliance will again, share price will tank like crazy. So they will always keep something called as what? Keyman insurance policy. Now you may die during that time, you may not die, you may commit fraud, you may not commit a fraud, whatever it is. So now, when the premium is paid by the company towards the keyman insurance policy, is it a deductible or allowable business expenditure? 100% yes. That was no doubt about it. But what if, let's say there is no fraud or I don't die, there will be a surrender value. There will be a surrender value. Some surrender value will go to the company, some surrender value will go to the KMP. The question before the courts and before the department was, surrender value received by the company, is it taxable in the hands of the company as income? Surrender value received by the director, is it taxable in the hands of the director as PGBP? So, premium paid by company, debited to penal account, definitely around under 37(1). Surrender value, wherever there is no fraud, surrender value. So employee or KMP will receive the surrender value. Is it exempt? Yes, it's exempt under 1010D. It was, but now guys, definitely it is taxable. This is the position as of today. Is tax applicable? I am an employee or I am a KMP. I am receiving surrender value. From whom am I receiving surrender value? I am receiving surrender value from the insurance company. Now, will tax be applicable? Yes. Employee taxable as salary. Consultant taxable under section 28. PGBP. If I'm an honorary chairman, for example, what's his name? Or man, 70 hours. Narayan Murthy, sorry, slip. Suddenly it didn't come out. Narayan Murthy said 70 hours and all you have to work. Full week. So Narayan Murthy is not involved in Infosys, but is an honorary chairman. If an honorary chairman is receiving some funds, it will be income from other sources. What funds? That is your Keyman Insurance surrender value. Okay, so as of now, it is 100% taxable, guys. Now, on the other hand, if there is a fraud, if the insurance amount is received, if there is a fraud, insurance amount is received, then it would not be taxable. If insurance amount is received, it is not taxable under section 28. It has now been made taxable under 28(6). It was not taxable before. We will consider it now. Now is it taxable? Yes. So guys, very simple. If the company is paying Keyman insurance, it is debited to P&L account, allowed. Then any credit, if there is, whenever there is a surrender value received by employer KMP, is it taxable? Yes. Similarly, if there is a fraud, an insurance company has paid the company, is it taxable? Yes. All these things will be taxable. Income includes illegal income also. Guys, income will include positive, negative, legal, illegal, everything. It will include all incomes, no problem. So, even if I have an income with respect to smuggling, etc., that is also taxable. Nirmala madam will not look into the legality. Nirmala madam will look into whether money is coming or not. So, that will also be taxable. Now, any salary, commission, bonus, remuneration, interest received by partner from the partnership firm, even salary, that is not income from salary, it is PGBP itself, because partner is actually the owner of the business. That is what it is. Then non-compete fee, is it PGBP? Yes. What do you mean by non-compete fee? Let's say I am a famous chef in a 5-star hotel, and now I am quitting that 5-star hotel and starting something on my own. I have learned 2-3 amazing dishes in that particular 5-star hotel, which is the ingredients. It is invented by the 5-star hotel. So 5-star hotel has a, what do you say, trademark over it. But anyway, when they are leaving, when I am leaving, they'll tell me, boss, please do not compete with me. And you cannot use any of these, whatever you use now, you cannot use any of these things, whatever you have learned from here, and do not compete with me. At least in this city, don't do. You open anywhere else. Please do not open another restaurant in this city. You can open anywhere else, no problem. For that, I am giving you 20 lakh rupees. It's called non-compete fee. Is that 20 lakh rupees PGBP? Answer is yes, because now you are doing business. Or if you go to a competitor and say, do not open your ice cream parlor here. Right? A new ice cream parlor goes to Pabbas and says, sir, please do not open your ice cream parlor here. Then I will obviously lose business. Sir, please do not open here. I'll give you 20 lakh rupees, sir. Yes, it's a valid business agreement. Is it PGBP? Yes. Right? So non-compete fee will not just be not carrying on business. It will also be not sharing the know-how. So for example, Shell company. So one of my dad's friends actually had made a lubricant, which if you add that lubricant to a petrol, there is fuel efficiency will increase. He had actually done it. So now he's telling that you please allow us only to use that lubricant. Shell company has a contract with my dad's friend. I will use the lubricant. You should give it only to me, the formula, and for which I will give you 100 crore rupees. You do not share that IPR with anybody else. Yes, PGBP. It is not even for not competing. It is also for not sharing the know-how. Check it out. It is also for what? Not sharing the know-how. Everything. It has a lot of things. It is not just not giving. It is also for what? Not sharing the know-how. So if you see section 28 here, page number B4. Not sharing any. First one is what? Not carrying on any activity. Chef example. Then here, not sharing any know-how, patent, copyright, trademark. That is also PGBP, my dear friends. Next, any compensation received from termination or modification of a business contract. You and I had a contract where I was supposed you are handling the whole of India operations for me and you are getting 50 lakh rupees per annum. Suddenly I will come and tell, look, you handle only the southern Karnataka region. Northern Karnataka region, I found one more business partner and he will handle. And I am sorry, because of which I cannot pay you 50 lakh anymore. I'll pay you only 40 lakhs. But you will be losing 10 lakhs every year for the next 4-5 years. So I will give you some compensation. I will give you 20 lakh full and final settlement for the business that you are losing. So 20 lakh I am giving you right now. That is what? Compensation that you have received. For what? Modification of a business contract. For you, is that PGBP? Yes, it is. Because you are receiving the 20 lakh compensation. Similarly, if I say things are not working out between us, let us end the contract. But since I'm ending the contract, I'm giving you a termination compensation. 10 lakh rupees. Which is there as per the agreement. For the termination compensation, please take this 10 lakh rupees. Is that taxable in your hands? Yes. Then any duty drawback, cash compensate is about any sort of duty drawback, any sort of assistance or benefit given by the government for encouraging export. Refund of duty, it could be subsidy, it could be support, everything is PGBP because it is thereby decreasing my expenditure, or I would say it is increasing my income. So when I make an expense of 10 lakh, I am getting subsidy of 2 lakh from the government, that is duty drawback, that 2 lakh will be my income. Ultimately 10 minus 2, 8 only has to be taken. Then there is a, what do you say, building, Casa Grande, let's say. In that building, only 2 of those small buildings, flats, they want to convert to sales office. What am I doing? I am converting a stock in trade into capital asset. When I am converting stock in trade into capital asset, stock in trade, the cost of these 2 buildings will be, let's say, 2 crore each. Cost will be 4 crore, both put together. But this stock in trade I'm converting to capital asset. The value of that building both put together is 10 crore actually. 5 crore, 5 crore each. Cost is 2 crore, 2 crore. The value is 5 crore, 5 crore. So when I'm converting 4 crore to 10 crore, at the time of conversion itself, Nirmala madam is telling the difference between the two, 6 crore, should be credited to P&L account and to pay tax on that. Sir, why will I pay tax on that, guys? Because you will record the asset at 10 crore. Won't you charge depreciation on 10 crore? Yes. When you are charging depreciation on 10 crore, how will I show the difference between 4 crore to 10 crore? 4 crore is the cost, which was in stock in trade. Your closing stock was 4 crore. Now you are making it 10 crore and removing it from stock in trade. And you are recording it at 10 crore in the balance sheet. So, Nirmala madam said, when the moment you convert stock in trade to capital asset, the difference between 10 crore and 4 crore, 6 crore, you should take it as PGBP. Everybody with me on this, yes or no? Take it as PGBP. So this is the charging section, my dear friends, of profit and gains from business or profession. Everybody with me? Come on, fist pump and thumbs up on the group. Thumbs up, everybody. Understood? Charging section. Great. Let's see. So moving on. That was the end of, what do you say, section 28. That is a charging section. So more, obviously the more depth is given in all these areas. Incentive duty, drawback, yes. Now, receipts in the hands of the partner. Come to page number B4. Receipts in the hands of the partner. They say, so this receipts will be what? This receipts will be, I would call it the bricks receipt. Bonus, remuneration, interest, commission and salary. Bricks receipt is received by a partner of a firm from such firm. It is always, what do you say, taxable in the hands of the partner. Okay. On the other hand, there is something called as section 40 small b. This is from the firm point of view. When the firm is paying the money, for them will it be allowed? Yes. What is taxable for the partner will be an allowable expense for the firm. But there is a limit under 40B. If you pay within that limit under 40B, then it is allowed for the firm and it is taxable in the hands of the partner. Okay. So if it is within 40B limits, then for the firm, the entire bricks expense will be allowed. Whereas for the partner, it is taxable. On the other hand, guys, if you go beyond the 40B limit, then that extra portion will be disallowed for the firm. For example, if only 7 lakh is allowed, as an example, or let's say 6 lakh is allowed. Bricks, bonus, remuneration, what do you say, interest, commission, then salary. Up to 6 lakh only is allowed, assume. If I pay anything within 6 lakh, for the firm it is allowed to be debited to P&L account, and for the partner it is taxable. But if I pay 7 lakh rupees, that extra 1 lakh is disallowed for the partnership firm. When it is disallowed for the partnership firm, firm will pay tax on that extra 1 lakh. But the question is, that extra 1 lakh, will it be taxable in the hands of the partner? For the partner, is it taxable? Answer is no. For the partner, it will not be taxable, guys, because you cannot have double taxation. If it's already taxable in the hands of one person, it is not taxable in the hands of the other person. Okay. So if you see, check this out. This one, page B4 and this point. If such interest, salary, etc. has been disallowed under section 40B, in case of the firm, the same shall not be taxed in the hand of the partner to the extent disallowed. And now, very interesting point, that 40B limit also has changed. See, B5, very important. Finance Act 24. Earlier in Inter, you may remember that on the first 3 lakh, it was this dialogue and all was there. Now it's very simple. Book profit. First, I have to compute something called as book profit, and on the first 6 lakh, remuneration allowed is only 3 lakh rupees or 90%, whichever is higher. On the balance amount, it is 60%. And when we reach taxation of firms, quickly we can see that later. Okay, this is how it is, guys. Right. Then one more important change that has happened. What used to happen was, I think Nirmala madam had gone and stayed in a place called Airbnb. So Airbnb is a platform where you can host your homes. If you have an extra home or if you have an extra floor, extra room in your house, you can let other people come and stay. So Airbnb is a platform where homes from across the world can be hosted. So what people used to do, if they had multiple homes, rather than renting it out and putting the income from house property, they were renting it out on Airbnb. Normal home, 800 square feet, for example, if you rent it out, depending on the area, you may get around 15,000 rupees per month rent. Let's say in Bangalore and other metro places. On the other hand, or let's say 10-15,000. On the other hand, it is 15,000 rupees per month. That's it. On the other hand, if you give it on Airbnb, and if it is outstanding, the entire house, you make nice interiors, etc., you can actually get almost 3,000 to 4,000 rupees per day. So what people were doing, they are giving it on Airbnb and making almost 1.2 lakh rupees per month instead of 15,000. And then they used to charge expenses. Guys, expenses can be fabricated, no? Maintenance expense, maid expenses, cleaning, all like that. They will to put some expenses around 90,000 rupees. And then pay 30,000 is to offer to tax. This is what was happening. 90,000 fake expenses. Expenses actually would be what, 15, 20,000 rupees, but show 90,000. People were, instead of income from house property, mind you, in income from house property, you will only get a standard deduction of 30%. That's it. Rent, repair, maintenance, everything a standard deduction, whether you spend or not, standard deduction will be 30%. There ends the matter. But here, interestingly, they have told it is what? They used to charge 90,000 rupees and all those things. So, 1 lakh 20 minus 90, 30,000 rupees. So, this 90,000 they all used to do. So, in Finance Act 2024, targeting those Airbnbs, Nirmala madam has made a change where she has told that anybody who has an extra house like this, or they are giving it out like on Airbnb or anything similar to that, will not be under PGBP. It will come under income from house property, which means, my dear friends, if you are earning 1,20,000 rupees, income from house property standard deduction, you can only claim 30% deduction. So 36,000 only you can take. Remaining is all always taxable. Not taxable. Got it? So check this out, guys. Read this. Page number B5, read that point and read the rationale. Wherever there are amendments, I'm going little slow. Read the rationale as well. Read. Make it full screen. Done. Apart from that, any compensation received by managing director, etc., that also will be coming under this particular section. So, basically, managing director will get compensation for any loss of the office. So, for them also, it will be coming under this particular section. So, just 1 second, guys. So, even managing director, basically, under 2 clause 53 of the Companies Act and 2 clause 54 of the Companies Act, MD and manager, both of them can get something called compensation for loss of office. So if they are getting compensation for loss of office, right, a director will get compensation only if he is removed, whereas MD, whole-time director, manager will get compensation for other reasons also. Except the following reasons, for all reasons they will get compensation. If they resign, they will not get compensation. If they commit fraud, they will not get compensation. Or if there is any breach of trust because of which he vacates his office, he will not get compensation. Otherwise, for all cases, he will get compensation for loss of his office. How do I tax this compensation? If he is employed and if it's a contract of service, employment, and if he's getting compensation, it is taxable under the head salary. Whereas if he is employed for service, means what? Contract for service means what? I already told you, consultancy. Contract for service is consultancy, contract of service is employment. If a director is employed in the company, then it will be taxable under the head salary. But if the employee is joining consultancy, then it will come under 28 to A and B, definitely. He will get compensation for loss of office. What are the examples under which he will get compensation? Will that be also PGBP? Answer is yes. What are the examples under which he'll get compensation? Company has closed down suddenly and it is not his fault, either due to COVID or some regulation. Company has closed down. He still was promised 3 more years of service, but today only the company closed down. Will he get compensation? Yes. For loss of office, 100% yes. And the director has been removed. It is not for fraud, but is removed because he's not fitting in the company. So is it fine? Is it, will he get compensation? Yes, he will get compensation. Right? Those are some of the examples. So definitely he will get compensation, no doubt about it. Right. Moving on. So section 28 we did, guys. Now moving on to section 29. When I am computing PGBP, I have to follow the sections 30 to 43B. So 30 to 43B gives me all the expenses, etc. So that I need to follow always without fail. Right? That is what it is. One second. I'm opening your chat only, guys. Sorry. There. Yeah. So you have to follow what? 30 to 43B. Very, very simple. Now, for example, Jan 2023 and the pre-incorporation happened, and the incorporation happened only in April 2023. Jan 23 the entire process began, and April 23 only the incorporation happened. During the pre-incorporation stages, expenses was around 40 lakhs, income was around 1 crore. I made 1 crore income, 40 lakhs expense during the pre-incorporation period. After the incorporation from 1st April 2023, the PGBP whatever I made was 9 crore rupees. PGBP was 9 crore. Now, this agreement of that 1 crore income before incorporation, will it be taxed is the question. So we should understand one thing. As per Indian Contract Act also, Companies Act also, until the company is in force, until the company is incorporated, there will be no expenses, no income. Everything will not be covered in the hands of the company. Who will have to pay for this? The other people only have to pay. Company cannot pay. Now, because company has not come into, company has not taken birth only. When company has not taken birth, how can you say that the company is liable? Company will not be part of the deal only. The Specific Relief Act of 1963 also said that all pre-incorporation contracts will be valid subject to certain conditions that you leave. But under income tax, my simple question is this: that income of 1 crore minus expense, whatever, 60 lakhs, will be taxable in whose hands? That's a simple question. That income of 60 lakhs will be taxable in whose hands? It cannot be taxed in the company's hands. It cannot be taxed in the company's hands because company is not born only. So it cannot be taxed in the hands of the company. Whose hands will it be taxed under then? So income tax law suggests that it will be taxed in the hands of, if you see, 1 crore minus 40 lakh, 60 lakh will be taxable in the hands of the promoter as an association of person. It will be taxed in whose hands? Promoter. As a what? Association of person. So Nirmala madam will ensure that tax will be there on every single thing, either as AOP, either as BOI, either as company. So in this particular case, it will be taxed in whose hands, guys? It will be taxed in promoter's hands. As a what? As a association of person. As a association of person. Did you understand this? So all pre-incorporation profits, because company is not in existence, will be taxable in whose hands? Will be taxable in the hands of the, will be taxable in the hands of the whom? Not company. It will be taxable in the hands of the promoters. As what? As AOP. As what? AOP, Association of Persons. Will always be taxable in the hands of promoters as association of persons. So all revenue receipts will be taxed unless exempt. They'll always be taxed. As simple as that. Right. Yes or no? Thumbs up. Every section, thumbs up. If you understood. If you didn't understand, thumbs down. So that I want to understand what did you not understand. So I'm always here for you. Tell me. Guys, I'm waiting. Great. So now guys, moving on to come to the notes again. Page B8. One by one we are going section wise. So this section, expenses are relating to building used for business or profession. Section number 30. Section number 30 speaks about building used in business or profession. So, building used for business or profession. If the owner only has the building, rent is not deductible. Rates and taxes deductible. Insurance deductible. Revenue repair deductible. Capital repair is not deductible. Capital repair is not deductible. Tenant on the other hand, tenant if he is paying rent, deductible. Guys, owner cannot pay rent to himself, right? Tenant can pay rent deductible. Rates and taxes deductible. Insurance deductible. Revenue repair deductible. Capital repair will always be added to the cost. Capital repair will not be debited to P&L account, hence it is not deductible. On the other hand, if I have taken a entire floor on rent and I will tell the landlord, sir, I need one more floor, sir. This one more floor I will only construct. No problem. You don't have to. I will construct for you. I will make the interiors according to my taste. Everything I will do, sir. You just give me permission. I don't want you to spend any money. I will only do everything is what the tenant says. So for this, he is paying a rent of 1 lakh rupees per month. This ground floor, one floor. So will it be debited to P&L account 1 lakh rupees? 100% yes. Now what am I doing? I am adding one more floor on top. This entire construction tenant only did for 25 lakhs. Question to you is this additional floor that he did for 25 lakhs, can the tenant claim depreciation? He's not the owner. How can he claim depreciation? The issue went to Nirmala madam and said, Madam, I am doing it on my own account. I am paying the money. Why don't you allow? Please allow me to do it. So the tenant also can he claim depreciation on that amount, on that extra floor of 25 lakh was the big question. And the issue went to court and then eventually the law was changed and that concept is called as deemed building. See? They said if the SSE carries on the business or profession and he builds the building, extra floor, it is deemed that he is the owner only for the purpose of depreciation. And such capital expenditure, you can claim definitely depreciation on the expenditure incurred. This is the concept of what? Deemed building. So, good. Next, section 31, guys. Expenses relating to machinery, plant and furniture used for business or profession. This is the machinery. If you are the owner, if you are will you pay rent to your own machinery that you own? No, not deductible. Will you pay insurance? Yes, deductible. Revenue repairs, deductible. Capital repairs, not deductible. Tenant, on the other hand, tenant is paying rent for the machinery. Is it deductible? Yes. Insurance, deductible. Revenue repair, deductible. Capital repair, not deductible. So what is current repair? If it is to preserve and maintain the already existing asset. Capital repair is something which you have to start from scratch and which will completely change the dynamics of that machine and it will make it more productive. That is called capital repair. Capital repairs are never deductible as such. So if it is a, what do you say, normal repair, deductible. Capital repair, not deductible. Rent I am paying I can also take some machine on rent, right? Machinery on rent. That would be deductible under section 37. Okay. That is this particular point. So repair versus replacement depends on various criteria. This is section 31, gist of the story. Now, section number 32, depreciation. One of the most important sections, section 32, depreciation. So, in Income Tax Act, depreciation is not a single asset method. It is called as a block method. It is not a single asset method. It is called a block method. So before that, I'll explain how was it before, guys. How was it before? So till 87, 88, it was always called single asset method. So why am I doing what was there before when I am doing an exam oriented batch? It's very simple, because whatever was there before is still presently available also for power generation companies. So this method is still applicable for power generation companies. Single asset method is still there. Concept called terminal depreciation, concept called balancing charge is still there. It is not there for everybody. It is only there for uh, companies in power generation. That's why I'm doing like this. So I'll do this first and then go to what was there, what is there presently for other assets. So let's take an example of building A, building B, building C. Year number 1. Cost is 2 lakh, 2 lakh, 2 lakh. So it's a single asset method. Depreciation will be 20K, 20K, 20K. What will be the WDV? 1 lakh 80, 1 lakh 80, 1 lakh 80. In year number 2, right, building A was sold. Building A, whose WDV was 1,80,000, was sold. Two scenarios. Scenario number 1, it could have been sold for 1,44,000. Scenario number 2, it could be sold for 1,96,000. Scenario number 1, it could be sold for 1,44,000. Scenario number 2, it is sold for 1,96,000. If it is sold for 1,44,000, what is this thing? What is the WDV? 1,80,000. It is sold for 1,44,000. Building number A is sold for 1,44,000. Building number B, building number C, there is no change. So if you see building number B and building number C, 1,80,000, 1,80,000, again 10% depreciation I will take, 1,62,000, 1,62,000. But guys, building number 1 only is sold for 1,44,000 of the WDV of 1,80,000. So there is a loss. There is a loss of 36,000. Under the single asset method, that entire loss of 36,000 is allowed to be debited to P&L account, and that is called as terminal depreciation. Only for asset number A. 1,80,000 asset is sold for 1,44,000. So that balance 36,000 will be treated as what? Terminal depreciation. And it is allowed as what? It is allowed as an expenditure. Is allowed as an expenditure. Okay. So 36,000 allowed as what? Expenditure. Understood this? Terminal depreciation. This is no longer there under section 32 in a WDV method, but this is still applicable for single asset method power generation company. That's why I'm doing. So earlier it was for everything. Now it's only for power generation. On the other hand, scenario number 2. Asset worth 1,80,000 is sold for 1,96,000. I repeat, asset worth 1,80,000 is sold for 1,96,000. So in that be the case, point number B, 1,80,000, C 1,80,000, 18,000, 18,000 is depreciation. So 1,62,000, 1,62,000. But point number A, there is a profit of 16,000. Why? An asset worth 1,80,000 is sold for 1,96,000. What is the profit? 16,000. That 16,000, my dear friends, is credited to P&L account. Is credited to P&L account. And that is called as balancing charge. So loss is fully debited to P&L account, and the profit is fully credited to P&L account. Terminal depreciation and balancing charge. Now, this was for all the assets, but now this concept of balancing charge and terminal depreciation is only limited to assets in power generation companies who have adopted SLM basis. Now, in the new concept for other assets, forget about power generation, other assets, The entire thing is called block concept. It is called as the block concept. So guys, it will be opening WDV, everything will be added. Actual cost of the asset acquired during the previous year, everything will be added. Minus sale of assets destroyed or scrap value insurance compensation will be subtracted. And WDV at the end of the year. And less depreciation as per Income Tax Act will give me the opening WDV for the next year. To demonstrate this, what I am trying to tell is, see, as per our example, opening WDV was nil. Nothing was there at the beginning of the year. Then I added what? Actual cost of asset acquired during the previous year. What was the asset acquired? 2 lakh plus 2 lakh plus 2 lakh. Overall, 6 lakh. Actual cost of the asset acquired during the previous year, 2 plus 2 plus 2, 6 lakh. Less sale or assets destroyed or scrap value or insurance compensation. How much is that? Nil. That is also nil. So what is it? Opening WDV nil, actual cost of asset acquired 6 lakh, sale of assets destroyed or scrap value, insurance compensation nil. What is WDV at the end of the year? 6 lakh. WDV at the end of the year is 6 lakh. Now less depreciation, overall 10%, 60,000. What is the opening WDV for the next year? 5 lakh 40. 5 lakh 40 is the opening WDV for the next year. It is same as that only 1 lakh 80, 1 lakh 80, 1 lakh 80, 5 lakh 40. But now guys, in a WDV block concept, everything is together. In a block concept, everything comes together. 1 lakh 80, 1 lakh 80, 1 lakh 80, there it is separate. Here it is coming together. If you are buying also, you are adding to the block. If you are selling also, you are subtracting from the block. The moment it comes into a block, the asset loses its individual significance. I repeat, the asset loses its individual significance. So 5,40,000 rupees. Here number 2, what happened? An asset is sold in this block for 1,44,000, same dialogue. Scenario number 2, asset is, sold in the block for 1,96,000. So now, opening WDV 5,40,000. Actual cost nil, less sales. Sales 1,44,000. How much of asset is is here? 1,80,000 worth of asset is here. How much is it selling for? 1,44,000. Once I remove it, this will become 3,96,000 rupees. The loss of 36,000 rupees has actually what? Increased the WDV by 36,000. Because here I am, here 1,80,000 is present. Here I am removing 1,44,000. I am removing less. I am removing 36,000 less. Since I am removing 36,000 less, WDV is more, 3,96,000. In the single asset method, 36,000 was debited in the first year only. Here, their loss is translated into increased WDV. I am subtracting 36,000 less here. Ideally, 1,80,000 is the asset. Here 1,80,000 should go, but I am selling it at 1,44,000. So I am subtracting 36,000 less here. Since I am subtracting 36,000 less, that 36,000 is sitting here in WDV. This WDV will be depreciated over the coming years. In a single asset method, 36,000 single hit will happen in that P&L. But in this method, that 36,000 will be spread across different years. Because that is lying in the WDV. Because I subtracted less here, more amount is lying in the WDV. So loss of 36,000 has increased the WDV by 36,000 and it will go on for the next year, many years. Other case, here what has happened? I have sold at a profit of 16,000. 1,80,000 is the asset lying here. I have sold it for 1,96,000. Amount is 1,80,000. I have withdrawn 1,96,000. How much I have withdrawn more? 16,000 I have withdrawn more. Since I have withdrawn more, WDV has reduced by 16,000. WDV has reduced by 60,000. In the old method, WDV was 3,60,000. Here, because there is a loss, it has increased by 3,96,000. Here, because it's a profit, it has decreased by 16,000. Ultimately, the concept is the same. But here it is SLM and WDV. So, if you sell it at a loss, WDV will increase. If you sell it at a gain, WDV will decrease. I am selling it at a loss, WDV will increase. In the old concept, 36,000 hit in the first year. In the new concept, 36,000 will be spread across many years because it will be lying in the WDV. Reverse case, 16,000 is credited to the P&L account immediately. Here 16,000 is forming part of the reduced WDV balance, which will be, so lesser depreciation will be debited over the next few years. Did you understand this concept of block method? Yes or no? Thumbs up, thumbs down. Thumbs up, thumbs down. Come on guys, all of you. Good guys. So it is called as the block concept. What is it called? Block concept. Now, conditions for the entire thing, you should be an owner and you should be using it in business or profession. What type of owner? You should be a beneficial owner, means all the benefit should come to you. Only then you can claim depreciation. There's only one exception. One exception is deemed building, which we have seen. In the concept of deemed building, tenant is not the owner, but tenant will deem it to be his own. So conditions, owner and asset should be used in business or profession, and beneficial owner also is the main criteria. What is the exception? Exception is it will be deemed building. That is what it is. So beneficial owner means what? Very simple. Car is bought by me, correct? And you will take the registration in 2 months. And until even if the car is registered in your name also, I don't care. Even if the car is registered in your name also, I don't care. Who has paid the money for the car? So ownership is not as per the Motor Vehicles Act. Ownership is according to who has bought the car. If I have bought the car for my son, let's say my son is 21 years. If I have bought the car for my son and he has attained the age where he can drive, his name is there in the registered, in the Motor Vehicles Act register. In the RC book, his name is there. Is he the owner or am I the owner? Income tax says beneficial owner. Who has paid the money? Me. So even though his name may be there, ultimately I have to pay the entire depreciation I can claim, because it's always based on the beneficial owner, not the registered owner. Beneficial owner and not the registered owner. It's always based on what? Beneficial owner, not on the registered owner. There are many cases here. Nidhi's Transport Company, Mysore Mineral, CBDT, Circular, and also CIT versus ICDS Limited. Everywhere they have told only one thing, that is always based on exclusive ownership. It should be there, and the benefit should be flowing. It's not just anything else. The benefit should be flowing. Now, right, apart from that, just a sec. So this is what this entire thing says. Great guys, so understood that. Moving on. Now, so 3 important points with respect to depreciation. The value is less than 5,000 rupees. As per Companies Act, you will write it off completely and claim expenses. But in Income Tax Act, even if the asset is valued at 1 rupee also, you should add to the block. No mercy. Revaluation of asset, accounting standards, you have to go as per rules. Income Tax Act, we need to ignore. Whether we are putting to use the asset, active use, passive use. Active use, basically they say, is it ready to use or put to use? In income tax, it is always based on put to use. So if I have just bought an AC and kept it just like that, no depreciation because it is ready to use. Depreciation will happen only if it is installed. So it's always based on put to use. Now, there are exceptions. There are certain things which are passive use. For example, fire extinguisher. Fire extinguisher, I will never use it unless it is 100% required. When is it required? Only when there is a fire. So, is it ready to use or put to use? Actually ready to use. But the lawmaker says anything which is passively usable, for example, extinguisher, that is also deemed to be in usage. If I have installed a fire extinguisher, it means it is already put to use, because whenever I want, I can use it. Standby equipment, for example, there is a UPS, and then if UPS goes down, I need one more additional backup UPS immediately. That standby equipment is also always called as put to use. Spare part, normal spare part is revenue expenditure, but any spare part which will increase the capacity and it will go beyond what the asset has the capacity for, then it will be capitalized and you will give a depreciation. So any lubricant added to a machine which will increase its production capacity, or any for any machine, if I add any component which will increase the production value, instead of producing 1000 units, it's now producing 1300 units because of the insertion of that extra component, extra booster. All that will be capitalized. So it depends on the facts of each and every case is what we need to see. Is what we need to see. So as far as hire purchase is concerned, ownership is transferred only on the payment of the last installment, and depreciation is to be claimed from the beginning itself. Depreciation can be claimed from the beginning. And very interesting to know, in a lease, lessor and lessee. So even though lessor has given away the asset to the lessee cannot claim depreciation, only lessor can claim depreciation. So it's a very interesting thing, only lessor can claim depreciation. And in hire purchase also, ownership is transferred on the payment of the last installment. Depreciation is to be claimed from the beginning itself, from the hire purchaser. So there are 4 classes of assets: building, furniture, plant and machinery, intangible assets. So building will be your road, well, footpath. If it's an entire campus and there are many buildings, from one building to the other building, even the road, park, that also will be called as a building. Imagine, road is called as a building. And for water source, there will be a well. That well is also called building. Footpath is also called building. So you have building, then you have what? Furniture. Furniture will include what? Electrical fittings. Then we have plant and machinery, and then intangible assets. Intangible asset will what? Patent, copyright, any designs, etc. will be called as intangible asset. Goodwill is not an intangible asset. So you have what? Patent, copyright, design, all these things, but goodwill is not at all an intangible asset. Interesting to know, goodwill is not added in the block of assets. In the year 2021, amendment was made saying that goodwill measurement is not possible. Now, what is your goodwill? What is my goodwill? Income tax department said is immeasurable. Since it is not measurable, people were putting whatever figure they wanted and they were claiming depreciation on that. Right? See, patent you can value, copyright you can value, design you can value, but goodwill cannot be valued. Right? So what is the goodwill of the center that you are sitting in today? We don't know. Right? What is the value of any academy? We don't know. What is your value? We don't know. You can say whatever, but then the valuation may be based on various parameters. Hence, people were valuing very, very high and then charging depreciation. So in Finance Act, and the Supreme Court also supported that. So once and for all, the Nirmala Madam in 2021 said that goodwill can never be added to the block of assets. Goodwill should be removed. So intangible assets, my dear friends, does not involve goodwill for the purpose of income tax. Is goodwill an intangible asset? Normally, yes, but for the purpose of income tax, goodwill is not an intangible asset. Then what about in your entire building? Let's say there is a, let's say you are now in a residential camp. There is one temple there inside. That temple, is it for that particular building? Is it giving any value in terms of production of resources? No. It's just there for recreation and spiritual upliftment. Is it used for business or profession? No. But guys, the court ruled, yes, that is also used for business or profession. In what way? By providing that peace of mind. It is also passively used. Imagine. So can you claim depreciation on temple also? Yes. And claim depreciation on temple as well. So method of depreciation for generation and distribution of power generation unit, you can either choose SLM or WDV. You can choose what? SLM or WDV. For other SSE, should always WDV method. For SSE, SLM or WDV, generation of power. For other SSE, that is not in the distribution of power, it is always WDV. So I gave you the example of terminal depreciation and balancing charge. That is only applicable for SLM basis. For WDV, basis, it will not come. Okay, SLMWD, always WD method should be used. Then rates of depreciation, my dear friends. Building, residential building 5%, guest house, staff quarters, it's called residential building. General building 10%, temporary building 40%, furniture 10%, intangible asset 25%, plant and machinery, motor vehicles used for hiring business 30%, other cases 15%, ships 20%, aircraft 40%, computer and computer software, it is 40%. Books used in profession or library 40%. Pollution control equipment 40%. Computer and computer software, however, as I told you, computer software also is excluded from depreciable asset, because now, my dear friends, computer software is called royalty. So in international taxation, there was an amendment. In all those rules, there were amendments whereby computer software is not part of computer. If Windows software comes embedded in the laptop, then it is computer. But if you have to purchase the Windows software separately and install, that computer software will not be called as computer. It will be called as royalty. That royalty is allowed as an expenditure in the P&L account. Okay. So computer software will not include, basically computer will not include computer software. Books 40%, pollution control equipment 40%, windmills installed before 1/4/2014 15%, after 1/4/2014 40%, oil well 15%, other plant and machinery 15%, other plant and machinery 15%. So guys, generally you will get the full rate, but you will also get the half rate. At what rate? When will you get half rate? When will you get full rate? This is like the block of asset concept. Yes. Page number B16. If asset is put to use for 180 days or more, then you have full rate of depreciation. If asset is put to use for less than 180 days in the previous year, half rate of depreciation. Assets not at all put to use, no depreciation. So, if you buy an asset AC, 1 lakh rupees, did not put to use at all, will you get depreciation that year? No. If you buy, let's say, any machinery and you use it for 180 days or more, 180 days or more means what? Basically 4th October. If it is used after 4th October, it will be less than 180 days. If it is used before 4th October, it will be more than 180 days. If it is bought 1 year and put to use before 4th October, then will you get full rate of depreciation or half rate? Full rate. But if you put to use for less than 180 days in the previous year, you will get half rate of depreciation. You buy an asset and put to use it in December, then it will be what? Half rate of depreciation. So if you buy it in April 24, but put to use in December 24, guys, it's not about when you bought, it should be when it is put to use. If it is put to use in December 24, half rate or full rate? Half rate. If you bought in April 23, put to use in December 24, if you acquired it in April 23, put to use in December 24, half rate or full rate? Half rate or full rate? Guys, it will be full rate. Because you see the dialogue here, assets put to use in for less than 180 days in that previous year. That previous year. Which previous year? The same previous year in which you bought the asset. The same previous year in which you bought the asset. What rate of depreciation will it be? Half. That previous year is the most important dialogue there. Yes or no? Right. All right, buddies. So good. Moving on. Additional depreciation. So you know the normal depreciation. Apart from that, you will also get what? Additional depreciation. Additional depreciation is given under 32(1)(2)(a). For manufacturing or production of an article or a thing, you will get additional depreciation, or for a power undertaking, you will get additional depreciation. This is for what? A new plant and machinery only, acquired and put to use. It is not for old plant and machinery. Only for new plant and machinery you will get a one-time additional depreciation. Business may be new or old, I don't care. I repeat, business may be new or old, I don't care, but the depreciation, what do you say? The machinery must be new. Machinery must be new. So how much will you get, guys? 20% of actual cost only in the year in which it is put to use. Only in the year in which it is put to use, you will get an additional 20% depreciation. So if you are a machinery, your plant and machinery will anyway get 15% plus extra 20%. So in the first year, if it's a new plant and machinery, you will actually get 35% depreciation. So if it's a new plant and machinery, you will get 20% additional depreciation, 15% normal depreciation. Overall put together 35% depreciation is what you will be getting. And there is no additional depreciation for the following cases. There is no additional depreciation for what? Aircraft, ship, building, furniture, intangible asset, vehicles, and old plant and machinery. There is no additional depreciation. For vehicles, normal vehicles outside, you will not get additional depreciation. But if you have a forklift vehicle or any crane which is used in the factory, forklift vehicle or crane used in the factory, will you get additional depreciation? Yes, you will get additional depreciation. So additional depreciation is allowed for forklift vehicle and for cranes used in factory, not for anything else. Third one, plant and machinery. Plant and machinery, what all is covered? Second hand plant and machinery, not covered. Which means if you have a second hand plant and machinery, you will not get additional depreciation. Any plant and machinery used in office premises, you will not get additional depreciation. Any plant and machinery used in residential premises, you will not get additional depreciation. You will not get additional depreciation for which 100% depreciation is already allowed under other sections. I repeat, you will not get, what do you say? You will not get additional depreciation for those plant and machinery for which 100% depreciation is already allowed under other sections. For example, scientific research. Scientific research asset under section 35, if you remember, or we will doing anyway, that you will already get a 100% deduction which is debited to the P&L account. So will you get additional depreciation if it is already given 100% depreciation? No, you will not get. This is what normal depreciation also you will not get. So the plant and machinery less than 180 days additional depreciation at half rate also you will get at 10%. Why, guys? Because additional depreciation you will get less than 180 days half rate. So if you use it for more than 180 days, you will get 15% plus 20%. Total 35%. If you put to use it, let's say in December 2024, you will get additional, normal depreciation 7.5%, half rate. Additional depreciation also half rate, 10%. So you will get how much? 17.5%. If an asset has been bought in and put to use in December 2024, I repeat, if an asset has been bought and put to use in December 2024, my question to you is, will you get additional depreciation next year also? Because this year you would have taken what? This year you would have, what do you say, taken 10%. Next year will you get that extra 10%? Will you get? Yes or no is the question. So answer is yes, guys. Remaining 10% also can be claimed next year. So let's assume you buy an asset in December 2024. New machinery. How much will you get? 7.5% normal depreciation, 10% additional depreciation. Totally 17.5%. Next year, what's the depreciation you will get? Normal depreciation 15%. Then unclaimed additional depreciation of last year. Unclaimed additional depreciation of last year, 10% also you can claim. So next year you will get 15 plus 10, 25%. This year you will get 7.5 plus 10, 17.5%. So hope you understood this point. Additional depreciation benefit is allowed only for power generation undertaking, which is there for WDV method and any WDV. Additional depreciation is not allowed for power generation, which is going through SLM method. Then If you are in the printing division, publishing division, then your FM broadcasting channel, are you manufacturing something? Because additional depreciation is only for those things where you are manufacturing something. So my question is, if you are into printing, publishing, broadcasting, etc., are you manufacturing something? The answer is, it went to court and court said, yes, I am manufacturing something. Additional depreciation can be claimed because I am manufacturing an article or a thing. Yes. So, I mean, this notified backward area not needed for us, guys. Notified backward area not needed for us. So, this will be all the concepts of what? Additional depreciation. And I told you goodwill should not be taken into account. Goodwill must be removed from the intangible asset. Anyway, in 2020 only they brought that law. So, that's what it is. Now, once again. Yeah. Now come to page B21, guys. The concept of actual cost. Actual cost of. So we did 28, 29, 30, 31, 32. Now said after all depreciation points, now we have to go to something called as actual cost. Because actual cost is what? The actual cost of the asset that is added. So if you see the WDV part, before that I'll just show you. If you see the WDV concept that we were discussing, here, page number B16. WDV of the assets in the immediately preceding previous year less depreciation actually allowed in the immediately preceding previous year less. Then it will be WDV, the opening WDV, add actual cost. This is what we are going to discuss. Actual cost is going in 43.1. Actual cost of the assets acquired during the previous year put to use for 180 days or more, put to use for less than 180 days, acquired but not put to use. Total. Less money is payable in respect of any asset. Money is payable. So this is all put to use for 180 days or more. For this you will get full rate of depreciation. Less than 180 days you will get half rate of depreciation. Not put to use, you will get no depreciation that year. This is all the additions minus deletions. Money is payable. It means what? Money is receivable actually. Though the wordings is money is payable, it means money is payable to SSE. Or I can read it as money is receivable by SSE. This is what? Basically sale. When you sell it, discard it, demolish it, destroy it, scrap, you sell it off, whatever you get, that has to be subtracted. So as I told you, once you buy an asset, everything will be combined and it will be a block. And whatever asset you are removing from there, asset will not have any individual value. It's only block of money, and from there money is going out. That's all. So that you have to subtract. Then you will get also in case of some slump sale, when the entire undertaking only is sold. Slump sale is an area where entire undertaking unit business only is sold. For that, different WDV. WDV in case of slump sale also has to be removed. And ultimately, what will I get? WDV for the purpose of depreciation, you will get less. Depreciation at the prescribed percentage actually allowed. And finally, what will you get? Closing value of the block. Closing value of the block you will get. Finally, you will get what? Closing value of the block. Okay. So now this is the normal thing. We have done this. Money is payable will be seeing, no problem. But what is the most important thing? What is the value of the asset I'll be adding to the block? Right? WDV at the immediately preceding previous year minus whatever was allowed here will be opening WDV. This is opening WDV. To that opening WDV, I have to add the asset, and that asset I can't add some random amount. I should add the amount which is given in the income tax law. There are various explanations given. There are various rules to formulate what do you mean by actual cost. I buy an asset for 10 lakh and add 18% GST, 11 lakh 80,000. The question is, should I take 11 lakh 80,000 as actual cost or 10 lakh? Those kind of things are given in the law, okay? Actual cost. So this was what was there in B16. Now come to actual cost concept. B21. Actual cost. Actual cost means the cost of the asset to the assessee as reduced by the portion of the cost which is directly being met directly by any other person or authority. So very simple. Actual cost is what you have paid for it. Asset is 15 lakh. You have paid 10 lakh. 5 lakh is paid by government on your behalf. 5 lakh is paid by somebody else on your behalf. You have paid how much? 10 lakh. Somebody else has paid how much? 5 lakh. You will take 15 lakh or 10 lakh? 10 lakh. Actual cost means the cost of the asset to the assessee as reduced by that portion of the cost which has been met directly or indirectly by any other person or authority. Means if the asset is 15 lakh but 5 lakh is paid by somebody else, I should take actual cost as only 10 lakh. That is in the main dialogue only, it's there. Apart from that, these are the additions and subtractions. Excise or custom duty I should subtract if input tax credit is allowed. So if the asset is 10 lakh and 1 lakh 18,000 or whatever, asset is 10 lakh and 1 lakh 80,000 is the GST. If credit is allowed, then I should only take 10 lakh. But if it's a blocked credit, for example, vehicles, for vehicles it's a blocked credit, right? So if I buy a vehicle for 10 lakh and 1 lakh 80,000 is a GST, so 11 lakh 80,000 overall, it's a blocked credit. So will I take 11 lakh 80,000 or 10 lakh? I will take 11 lakh 80,000. So if I take 11 lakh 80,000 overall cost, I will subtract 1 lakh 80,000 assuming input tax credit is allowed. If input tax credit is not allowed, then it will only be 11 lakh 80,000 rupees. Amount of excise or customs duty, now GST, in respect of which input tax credit is allowed. Then you see subsidies and grants. If government has given some subsidy, government has given some grant, any additional cashback you have got, everything must be subtracted. Third, this is the amount paid in cash. So for that we'll discuss here. Nice. If you make any cash payment more than 10,000 rupees, it is banned. Revenue expenditure is also banned. Capital expenditure is also banned. If you make a revenue expenditure in cash more than 10,000 rupees to a person in a day, to a single person in a day, revenue expenditure will be disallowed. You will add back that. Revenue expenditure is disallowed and that section is 40A3. So if it is debited, Nirmala madam has told you should add it back, which means what? Disallowed. But if it is a capital expenditure, if it is a capital expenditure, it should be subtracted from the cost of asset. If it's a revenue expenditure, add, disallowed. If it's a capital expenditure, subtract. Subtract from the cost of asset, 43(1). Revenue expenditure, add. Capital expenditure, subtract. Got it? Revenue expenditure, add back. Capital expenditure, subtract from the cost of asset. Understood? So capital expenditure, whereby you have spent more than 10,000 rupees via cash to a person. So for example, it says what? Otherwise than by account pay check. The wordings you see here, otherwise than by account pay check or account pay bank draft. So you should, or bank transfer. If you do account pay check, account pay bank draft, bank transfer allowed. Everything else disallowed. When I say disallowed, if it's a revenue expenditure, add back. If it is a capital expenditure, subtract. Subtract from what? Actual cost. Subtract from actual cost. So when asset is purchased, let's say for 10 lakh rupees, 5 lakh rupees is by NEFT. 30,000 is through UPI. 1 lakh rupees cross check. Cash you gave 10,000 rupees but across 20 days. In one day you paid 5,000 rupees cash 20 times to a single person. 70,000 you did via Beam app. What all will be covered, guys? See, 5 lakh is allowed, 30,000 no problem. Cash you gave 10,000 but across 20 days, no problem. It should be what? More than 10,000 to a person in a day. If you gave 10,000 for 20 days, no issues. 2 lakh is allowed. 70,000 is allowed. So much. 5, 7, 8 lakh is allowed. What about one day only? 5,000 rupees I gave 20 times. No. Maximum 10,000 rupees to a person in a day. So if you given it 20 times, 1 lakh. Allowed or not? Not allowed. Also, 1 lakh rupees crossed check. 1 lakh rupees cross check given. Guys, what is allowed is only account payee check or account payee bank draft. But here 1 lakh I'm giving what? Cross check. So cross check allowed or not? Yes, cross check is disallowed. The difference between account payee check and cross check is what? A cross check, can you endorse it and give it to somebody else? Yes. Both account payee check and cross check should only be deposited to the account. But a cross check alone can be negotiated further. So if I put your account number there, I can give somebody else's account number because account pay is not mentioned. It can be negotiated further. Whereas if it's an account pay check, it cannot be further negotiated. So if it is belonging to you, it is belonging to you only. It cannot be further negotiated. That's about it. So that also has to be taken into account. Got it? So if you see, this is the one part. Then what? Forex fluctuation. Either decrease in liability or forex fluctuation increase in liability. So very simple. If I buy an asset worth $1 lakh, where that point of time $1 was 80 rupees, 80 lakh. Now suddenly I have to repay that some amount. When I am repaying $1 lakh, $1 has become 85 rupees. Has it increased in the liability or decreased in the liability? Increase. So will it be added to my cost or decrease from my cost? It will be added to the cost. 5 rupees has increased. On the other hand, when I am repaying the amount, if the asset value of the rupee value is 78 rupees and not 80 rupees, 2 rupees reduction. So 1 lakh into 2 rupees, 2 lakh rupees. That 2 rupees reduction, will it be adding on to my asset or I subtract from my asset? Subtract from my asset. So is it addition or deletion? Deletion. So if it is in releasing, what do you say, resulting in increase of my value, increase of my liability, then it should be added. If it is reducing my liability, then it should be subtracted. You see here, increasing the liability, add. 80 has become 85 rupees. Decreasing liability, subtract. 80 has become 78. Then interest on loan borrowed for acquiring the asset payable up to the date on which it is first put to use. So if I buy an asset, 1 crore, I'll take a loan and buy this asset. But I'm paying 10% interest on it. This is the day, sometime in August 2024, I will put to use this asset. From August till next March 25, it's already put to use. So this, after it is put to use, this will, the entire asset will go to the balance sheet. 10 crore. But what about this 10% interest? 10% interest from 1st April to August. April, May, June, July, 4 months. Then August onwards, it's already been put to use. August till March, 8 months. So August till March, 8 months. So 1 crore 10% is what? 10 lakhs is my Let me make it 1.2 crore. So 10% will be 12 lakh. 12 lakh will be for my full year's interest. 12 lakh will be my full year's interest. Of which 4 lakh interest is till I put to use. 8 lakh interest is after I put to use. This 8 lakh interest will not be added to the cost of the asset. This 8 lakh will be debited to P&L account. This 8 lakh will be debited to P&L account. This 4 lakh rupees will be added to cost of asset. Because any asset that you buy till it is put to use will be added to the cost of the asset. Any asset till it is put to use will be added to cost of asset. You have to see here. Interest on loan borrowed for acquiring the asset payable up to the date on which the asset is first put to use will be added. And all expenses incurred for acquiring the asset like freight, insurance, loading, unloading, everything will be added. Expenses incurred in connection with installation of the asset, technician fees, etc. will be added. Everything will be added. This is the actual cost concept. So, got it, guys? So, moving on, guys. Now, we will determine something called as the actual cost. There are various explanations. One by one, we have to see actual cost. There are certain explanations to actual cost. All explanations are given here only. Asset are come to stock in trade and all these things is all given here. One by one, we should definitely discuss. So there are certain logic to it. We'll have to discuss that. Let's see one by one. Right. So you see, there was one guy called Chota Bhai Limited. There was one company called Mota Bhai Limited. Okay. Chota Bhai has black money. Okay. He has black money and Mota Bhai needs black money. Very simple. So Chota Bhai has black money. Mota Bhai needs black money. What used to happen? Chota Bhai Limited had a asset worth WDV 60 crore and his fair market value was 80 crore. His asset was 60 crore, fair market value 80 crore. He sold this asset valued at 60 crore for 95 crore. Crazy. An asset worth 60 crore, he sold it for 95 crore. FMV was what? 80 crore. Now the thing is, Mota Bhai Limited paid full white 95 crore. You only tell me an asset which is valued at 60 crore in the WDV but actual value is 80 crore. Why will I sell it at 95 crore? Obviously because I want to convert black to white. So this black has been converted to white because now I have asset worth how much? 95 crore. Chota Bhai, what does he do? He gives to Mota Bhai Limited 15 crore black money. He gives 15 crore black money. To whom? To Mota Bhai Limited. There ends the matter. An asset whose FMV is 80 crore, he is got money 95 crore in white. So that 15 crore extra which he had in black, he gave back. So that Mota Bhai in fact has actually bought an asset for 80 crore only. But in the books he is showing it as 95 crore, 15 crore he got cash also. And for him, imagine what will be the actual cost for this guy. He's buying the asset, no? He's buying the asset. He's buying the asset for how much? 95 crore rupees. He will use it as actual cost 95 crore. There ends the matter. Win-win situation. Chota Bhai converted black to white. Mota Bhai converted white to black. Plus Mota Bhai is now getting the actual cost how much? 95 crore. There ends the matter. So there is an explanation which was added which says the assessing officer will now compute this. He will not make it 95 crore. According to him, the value can be 70, 72, 73, etc. That explanation was added whereby the AO only shall value the actual cost. The assessing officer shall value the actual cost. That is explanation, one of the explanations. Okay. So now what they are trying to tell is, if one person sells it to another person at an enhanced cost, what is the logic behind it? Conversion of black to white. Then whoever has got it as enhanced cost, that actual cost he cannot take an enhanced amount. He should take what? At a lesser cost only. Who will decide that? Assessing officer will decide. Assessing officer will decide. That is one of the explanations. Second, one more explanation. This is one more crazy thing. Motabai Limited sold an asset worth 5 lakh rupees. Motabai, an asset worth 5 lakh rupees, sold it to Chotabai. Chotabai sold it for 6 lakhs. Chotabai sold it to Tatabai at 7 lakhs. Tatabai sold it to Batabai at 8 lakhs. Batabai sold it to Sheila Auntie at 9 lakhs. And Sheila Auntie sold it back to Motabai at 11 lakh. Guys, an asset worth 5 lakh is going away from me. An asset worth 5 lakh is going away from me, and I am reacquiring it. I am what? Reacquiring it at what amount? 11 lakh. An asset worth 5 lakh is going away from me and reacquiring it at 11 lakh. So what should be the WDV? Ideally, I will take 11 lakh. Government is like, boss, you gave it for 5 and you reacquire it 11, and all of the other people are your friends only. So if an asset goes out of the person and comes back to him at an enhanced cost, it's cheating. So very simple. What did the lawmaker say? They added an explanation to value this actual cost. Explanation was added very simple. Original cost of the asset minus depreciation allowed, as if it was the only asset in the block. Very simple. So you take that one asset out, 5 lakh, I mean whatever 10 lakh, give the depreciation of that for that asset. How much is that asset now? 5 lakh. Or the amount that you are bringing it for, 11 lakh. Whichever is less or whichever is more. Obviously I'll take whichever is less. So from the block, if an asset is going out, that asset you standalone compute the depreciation as if there was no other asset in that block. That asset was bought for, let's say, 10 lakh. Now, as of now, the asset is standing at 5 lakh. You are taking it out 5 lakh. At the time of taking it out, it is 5 lakh. But when you're bringing it back, it is 11 lakh. So the lawmaker says actual cost will be 5 lakh or 11 lakh, whichever is less. As simple as that. Original cost of the asset minus depreciation allowed, as if it was the only asset in the block. Second one, whatever amount is prepaid for reacquisition, this or this, whichever is less. This or this, whichever is less. Simple. Third one, scam number 3. There was a company called Motabai Limited. There was one more company called Factory Limited. Factory Limited had pollution control equipment. Factory Limited had pollution control equipment. So earlier depreciation for this pollution control equipment was 100%. Now it is 40, but earlier it was 100%. The SSE had bought it for 2 crore. Depreciation was 2 crore. What is the WDV? Nil. Now Motabai Limited did very crazy thing. What did he do? Motabai Limited purchased this asset for 2 crore. So something whose WDV was nil was purchased by Motabai for 2 crore. Okay. And then leased it back to Factory Limited. Understood? So first of all, pollution control equipment, WDV nil. You have WDV nil. I have purchased from you and I have given you 2 crore. So you are happy because you are getting 2 crore for something which value is 0. Me, I have bought the asset for 2 crore. I am leasing back to you only. When I am leasing back to you, lessor can claim depreciation or lessee can claim depreciation? Lessor. But you are getting to use it. Anyway, you want the pollution control equipment, you are getting to use it, whose WDV is nil. But I have taken at how much? 2 crore. I am showing in my balance sheet how much? 2 crore. Lessor only can claim depreciation. So Motabai claim depreciation as is a lessor, cheating. Something which was valued at 0, I have reacquired and leased back to you. So some 2 crore full depreciation 0. Now I got it. I have also enhanced it to 2 crore. Again depreciation I will do. cheating. So explanation says WDV of motor buy for the asset is equal to WDV of factory limited, 0. WDV of motor buy for this asset is equal to WDV of factory limited, 0. So for motor buy and factory, it will always be 0. Whatever I acquired it for, this 2 crore, I cannot take it. Correct? I cannot take 2 crore. So what will it be? It will be only 0. It will be 0. So which one? This example you see again, I'll repeat. Chota Bhai has black money. Mota Bhai has white money. He needs black money as white money. So an asset valued at 60 crore, FMV of 80 crore. If I want to buy asset from you, I'll buy it at market value. Market value is 80 crore. Mota Bhai is buying that 80 crore asset for 95 crore, guys. 95 crore. So what happened? 80 crore asset I got, but I'm paying you 95 crore, which means you have black money. But the value of the asset is 80 crore. But I'm buying it for how much? 95 crore. I have given you 95 crore for an asset worth 80 crore. I will take 15 crore black money from you. Simple. So 15 crore black money was given to Mota Bhai. And Mota Bhai is happy because I got 15 crore black money. I gave 95 crore. But actual value 80 crore. Ultimately, simple. I got black money. I gave white money. How much? 15 crore. But I am taking the actual cost at 95 crore. Why? Because I have given white money 95 crore. This also was cheating. Assessing officer said you should value actual cost. Assessing officer only should value actual cost. So he may decide it is not 95 crore. It is 90 crore, 85 crore or something like that. Okay. Ultimately, I should buy an asset for 80 crore. But what did I do? I paid white money 95 crore, got back black money 15 crore. Ultimately, actually, balancing figure is 80 crore only. But now what am I doing? I exchange black money, white money. Plus one more benefit, what did I get? I got actual cost of 95 crore. Hope you understood now. Yes or no, guys? Yes or no? This factory limited also cheating. They said WDV of Mota Bhai for this asset is what? WDV of factory limited, 0. Then, if a stock in trade is converted to a capital asset, if a stock in trade is converted to capital asset, that Casa Grande example. Cost of 2 apartments, 4 crore. FMV of 2 apartments on date of conversion, 10 crore. Amount to be recorded in P&L account, as name suggests, obviously it is 10 crore. Tax will be paid on how much? What is the PGBP? 10 minus 4, 6 crore. So asset to be recorded at actual cost 10 crore, but PGBP income will be 6 crore. Right? Yes. So this is a simple thing. So here asset should be recorded at what? 10 crore. Now, building, if it is used for any other purpose, a building is used for any other purpose, now it is brought into business. Building used for any other purpose, now it is brought into business. Actual cost will be cost of the building minus notional depreciation. Cost of the building minus notional depreciation. So building, for example, was 10 lakh on 14/2/2018. Actual cost if we brought into business on 14/4/2021 will be cost of the building 10 lakh minus notional depreciation. Notional depreciation. So notional depreciation is whatever rate it is, 10%. So from the day you purchased it, it's on 14th February. So you will get only half rate depreciation, 5%. 18-19, 10%. 19-20, 10%. 20-21, 10%. So as of today, it will be 4,92,550. So you will have to bring it into business at 6,92,550. Very, very simple. So guys, building used for any other purpose now brought into business. You should charge cost of the building minus notional depreciation for all the years. Next question is, notional depreciation should be, you see the explanation. Explanation 5, page number B23. Building used for private purpose subsequently brought into business. The cost of purchase or construction of the building is reduced by the notional depreciation. Calculate the rate in force on that date. That date. That date is date of bringing it into business or every year rates. On that date means what? Date of bringing it into business or rates in force every year. Like in 17-18 depreciation rate I should take, 18-19 accordingly depreciation rate should I take, or should I take the rate on the date I am bringing it into business? That was the logic. That was the question. So when they use the word rates in force on that date, it is always date when you are bringing it into business. Rates in force on that date means what? Date you are bringing it into business. So you see, rate as on that date is what? Date of bringing the asset into business. Ignore the previous rates. In 2017, it could be 8% depreciation. I don't know. In 2019, it can be different rate. No. When am I bringing it today? Today, what's the rate? 10%. So I should take the same 10% to all the years. That's what they're trying to tell. Guys, and moreover, please note, very, very interesting, important MCQ they'll ask you. This is only building which was used for private purpose, subsequently brought into business. They'll ask you a question. A motor car was personally used before. Now you are bringing it into business. Motor car was purchased for 1 crore. As of now, WDV is 20 lakh. You will take it as 1 crore or 20 lakh. Building is used for private purpose. If it's anything other than building, for example, motor car, then you see this provision is only for building. If any other asset is brought into business, actual cost is equal to original cost of acquisition. There ends the matter. This provision is only for what? Building. If any other asset is brought into business, a car worth 1 CR is brought into business today. WDV is 20 lakhs. What will I take actual cost as? Original cost of acquisition, 1 crore. Got it? Yes. If I use the asset by way of gift, will, inheritance and all these things, very simple. Actual cost will be the cost of the previous owner. If previous owner is used for personal purposes. If the previous owner is used for business, actual cost will be equal to cost to previous owner minus depreciation actually allowed to him. Very simple. So if he used for personal purpose, then actual cost. If he used for business purpose, whatever he WDV after you charge, whatever is left for him, then only that will be taken to me as depreciation actually allowed to him. Then if a foreign company, Firangi Limited, is bringing an asset, it was using all the assets, it bought an asset in 2016. In 2022, the WDV of that asset is 1 crore. They are bringing it into their own Indian company for again 10 crore. Imagine 2016 10 crore, fully depreciated, almost 1 crore is left. Again they reintroduced it in India, 10 crore. If this be the case, what is the asset? Any asset. So what is the asset? Any asset. Right? What is the actual cost? Purchase price minus notional depreciation. Now what is the asset? Any asset. What is the actual cost? Purchase price minus notional depreciation. What is the purchase price? 10 crore. Notional depreciation I should charge at the rates in force Mind you, this is not rates in force as on that date. This is rates in force. When law uses the word on that date, when law uses the word on that date, it is date of bringing the asset into business. When law uses the word on that date, that is date of bringing it into business. That is the machinery example. But for this foreign company bringing it into Indian company, they have simply used the word rates in force. Rates in force means what? Rate as per the Finance Act for every year from the date of purchase, and it is not current rate. So rate in force means what? Rate as per the Finance Act for every year from the date of purchase, and it is not current rate. It is rate as per the Finance Act every year from the date of purchase and not current rate. Okay. What will be the current rate? Dialogue will be rates in force as on that date. Rates in force as on that date. So I hope you understood this. If it is used for scientific research and later it is brought into business, then actual cost will be nil, because in scientific research I have already claimed an exemption, full 100% I have already claimed a reduction, so it will be nil. On the other hand, if a holding company is transferring an asset to a 100% subsidiary, and that 100% subsidiary happens to be a Indian company, then also the WDV, I mean the, what do you say, actual cost will be different. I'll discuss. Or if it's a foreign company, this is a transferor company, foreign subsidiary, it is transferring to its 100% holding company, then also there's difference. For example, transferor company Tesla. Tesla USA is transferring an asset of WDV 10 lakh, original cost 40 lakh to Tesla Bangalore. Whereas Hamleys UK is transferring an asset worth WDV 10 lakh, original cost 40 lakh to Reliance Industries. Reliance Industries is the 100% holding company. Tesla Bangalore is the 100% subsidiary of Tesla USA. Then what will be the actual cost of to Tesla or Reliance? It will be WDV of the transferor company. What is transferor company? This one. What is the WDV to that? 10 lakhs. What is the WDV to this? 10 lakh. So that will be 10 lakh. WDV of transferor company will be 10 lakh. So if you see full screen, check it out. Take a picture of this holding subsidiary relationship. Done. Next. So amalgamation in the nature of merger, amalgamation in the nature of absorption. We'll finish this portion and then we can take a lunch break, guys. So amalgamation in the nature of merger, amalgamation in the nature of absorption. So merger, absorption. Merger means what? Two companies are coming together. Vodafone Idea coming together, Vodafone Idea. Absorption. Veranda Learning or Reliance has purchased Tesseract. Veranda Learning has purchased a coaching institution called JK Shah, coaching institution called Time, coaching institution called Race, all that they have purchased. So Veranda Learning is absorbing these companies. That is absorption. Reliance has absorbed Tesseract, absorption. On the other hand, Vodafone and Idea merge, Vodafone Idea. So Vodafone Idea is an amalgamated company, Indian company. Whereas Veranda Learning has acquired JK Shah, it's an amalgamating company. It's an amalgamating company. So this is a transferor company, other one is a transferee company. So what is the WDV of an amalgamating company or transferor company? So in this case, The company which is transferring everything is called transferor company or amalgamating company. The final company is called as a amalgamated company or the resulting company. So Vodafone Idea amalgamating company. When they merged, it is called amalgamated company. Veranda Learning Reliance amalgamated company or transferee company. And which are the companies that are coming together? Transfer. Who are transferring? JK Shah and Tesseract are the examples of transferor company. So what is the WDV of the amalgamating company or transferor company? It will be the actual cost of the amalgamated Indian company. Whatever was there in the books of the other company will come into the books here. Very simple. On the other hand, if I hive off, demerger, for example, Reliance Jio Infocom. Sorry guys, 1 second, I'll come to that. Sorry, yeah. Example, Reliance Jio Infocom. It's the demerged company. Now, demerged company will demerge into three. Reliance Jio Infocom is retained. Reliance Digital Fiber Private Limited, Reliance Jio Infratel Private Limited. These are practical examples. So, Jio Digital Fiber Private Limited, Reliance Jio Infratel Private Limited are called as resulting company. What is the demerged company? Reliance Jio. Reliance Jio was there. It split into three. One was me only. Remaining two are what? Jio Digital Fiber Private Limited, Reliance Jio Infratel Private Limited, resulting company. Here also, WD of the demerged company will be actual cost for the resulting company. So I split into three, right? So whatever assets I gave it to that company, that only will be actual cost. Actual cost. That is what it is. So you see here, guys, this is all the explanation. This is all the explanation. So rest of the topics will continue after the break, guys. Okay, guys. So moving on, there is something called as unabsorbed depreciation also. So what do you mean by unabsorbed depreciation? So basically, when here page B27, that portion of depreciation which could not be fully claimed due to profits being nil or insufficient. So guys, if the profit is 2 CR and the depreciation is 5 CR, this is profit before depreciation. Profit before depreciation is 2 CR. And this one, 5 CR is what? Depreciation. So this 5 crore depreciation is absorbing the profit to some extent. But 3 crore worth of depreciation has not been absorbed by the profit. Has not been absorbed by the profit. Hence, this 3 crore depreciation is called as unabsorbed depreciation. Can this be used for any number of years? Yes. Such unabsorbed depreciation can be set off for any number of years. And can it be set off? Yes. Against any income? Yes. Except under the head salaries. So such unabsorbed depreciation can be set off against any income except the head salaries. Can it be carried forward to any number of years? Yes. So unabsorbed depreciation can be carried forward to the subsequent years indefinitely. Can be carried forward indefinitely for set off. Continuity of business is not a precondition in order to get the benefit of carry forward of unabsorbed depreciation. So unabsorbed depreciation is allowed to be set off in subsequent year even if no return has been filed. That's the best part. Because if you have not filed the return, other losses cannot be carried forward. There are other sections there, 71, 72, 73 like that. But two sections are missing. That is 32.2. 32.2 is missing. So, and one more section we'll see later. So 32.2 is missing. So can you actually set off unabsorbed depreciation in the subsequent year, even if there is no return of income filed? Answer is yes. So unabsorbed depreciation is allowed to be set off in the subsequent year, even if no return of income has been filed by the SSE for the relevant assessment year. For the relevant assessment year. Power sector undertaking depreciation. So sale of assets under different categories you've seen. Terminal depreciation, balancing charge, already explained in the initial stage. Same thing will apply here also. So we can go ahead, guys. We can go ahead with this. Now coming to sale of assets concept. Sale of assets, section number 50. section number 50. So guys, sorry, sale of asset concept, let me come to that quickly. So guys, opening WDV 6 lakh, number of assets 5, actual cost 2 lakh, number of assets 2, 2 assets are added. Overall 8 lakhs is there, 7 assets are there. Assume all 7 assets are sold for 8 lakh rupees, or let's say are sold for 9 lakh 50,000 rupees. Okay. How many assets are sold? How many assets are sold? All 7 assets are sold for 9 lakh 50. So always remember, block can never be negative. Block can never be negative. And both the conditions must be satisfied. There should be some value in the block and there has to be at least one asset. I repeat, for the block to exist, point number one, there should be some value left in the asset WDV. Second one, there have to be some asset left in the block. So at least there should be one asset left in the block and also what? There should be some value. So there should be some value or there should be some asset left in the block. If that be the case, what happens? Very simple. Then number of assets, here in this case, how much? Now what is the number of assets? 7. 7 minus 7, all those things. When will the block exist? Block will exist as long as there is some value in the written down value and some assets left in the block. If either of the two conditions are not satisfied, then the block will cease to exist. Right? So basically here 8 lakh, 9 lakh 50,000 is what it is sold for. So 8 lakh is fully subtracted. 8 lakh minus 8 lakh fully subtracted. 7 assets also goes. Is the block existing? No. Block will not exist because assets also are not there. Value also is not there. So guys, this difference of 1,50,000 rupees will be called as capital gain. Okay. When will capital gain come in WDV? When the block is no longer existing. When will the block no longer exist? Or when will the block exist? Two conditions must be satisfied. Condition number one, there should be some value in the block. Here some value should be left. Second one, there should be at least one asset in the block. If one asset is also not there, value goes. Now, here you see 6 lakh, 5 assets, 2 lakh, 2 assets, totally 8 lakh, 7 assets. 7 assets were sold for 7 lakh. 7 assets were sold for 7 lakh. So here we have what? 1 lakh left. 1 lakh left. Tell me, is the block existing or no longer existing? Block will not exist only. Why? Because for the block to exist, two conditions must be satisfied. Condition number one, there must be some value in the block. It is there. Condition number two, at least one asset must be there. One asset is not there. So this is a dead loss. Gone. Dead loss. Then here, 6 lakh, 5, 2. 2 assets were added. Overall 8 lakh. 7 assets. 4 assets were sold for 9 lakh 50. 4 assets were sold for 9 lakh 50. Is the block existing? No. Why? Asset value 0. How many assets are left? 3. What is selling price? 9 lakh 50,000. So block can never be negative. If sale value is greater than the block, block will be nil. If sale value is greater than the block, block will always be nil. Block will continue if some value is in the WDV. Block will continue if some value is there in the WDV and at least one asset is there in the block. At least one asset is there in the block. This is what it is. So ultimately, asset must be there in the block. If asset is not there, WDV is not there, no depreciation, then it will come to capital gain. In the first example, 1,50,000 capital gain. The other second example, what? Asset is not there, but WDV is there. Depreciation will not come, capital gain. In this example, 7 lakh sale consideration, cost 8 lakh, 1 lakh. That dead loss, what I meant was, it is dead loss for PGBP, but now it come under capital gain. It's a capital loss basically. Next, asset is there, WDV is not there, depreciation is not there, capital gain will come. 9 lakh 50 minus 8 lakh, 1 lakh 50 will be my capital gain. Very simple. Now, this is always deemed to be short-term capital gain. It is always deemed to be short-term irrespective of the period of holding of the asset. It's always short-term. Very, very simple because long-term capital gain will be taxed at 20% and now in the new law it is taxed at 12.5%. in the Finance Act 24. Whereas short term will always be taxed at 30%. When the gain is taxed at 12.5%, if there is any gain arising out of what? This, you have already claimed depreciation on that, right? You've always been claiming depreciation. You've already got the benefit. Why will I get the benefit of 12.5% again? So if it's a long term, let's say the asset was bought 10 years ago. Today, if I'm selling it as part of the block, ideally it should be long term capital asset. But I've already claimed depreciation. Then I'm getting a reduced rate of 12.5%. How fair is that? Two benefits I'll not give. So the lawmaker has told that it is deemed to be short term capital gain, taxed at 30%. Taxed at 30%. So if WDV creates capital gain or capital loss, it is always short term. It is always short term irrespective of the period of holding. It is always short term irrespective of the period of holding. Got it? That is what it is. Unabsorbed depreciation we saw. So if it is 400 crore minus 600 crore, 200 crore, it is carried forward indefinitely. It will be, I mean, how to set off? We will set off on everything else except salary. Yes. Now coming to one by one. So great. So now let's come to, so we are going in a methodical sequence. Come to B30. Come to this tea or rubber or coffee development account 33AB and rule 5AC. So guys, those who are in the business of manufacturing tea or rubber in India, according to the rule, how much of coffee will be taken as business income? How much will be taken as agricultural income? Because coffee, as you know, will be cured, will be grown, will be roasted, will be ground, made into, pudi powder. And then coffee powder will be sold. So basically growing, curing and roasting can be more of agriculture. But grounding, making into powder and selling will definitely be for business only, no? So we don't know how much is business, how much is agriculture. So if you come to page number B31, this is important to remember the percentages. So for manufacturing of rubber, the income tax department only has given you the figure. 65% will be agricultural income, 35% will be business income. Then growing and curing of coffee, they say 75% agriculture, 25% business. That's all. They're only saying only growing and curing, as I said, it is always agricultural income, because more of that growing and curing is related to agriculture. But the moment I start roasting it, I start grounding it, it slightly becomes business. Hence you see 60-40 ratio. Growing, curing, roasting, grounding coffee 60-40. 60% agricultural, 40% business. Income from growing and manufacture of tea 60-40. 60% agricultural, 40% business. Income from growing, manufacturing of rubber 65-35. Growing and curing of coffee 75-25. Growing, curing, roasting, grounding coffee 60-40. 60% agricultural, 40% business. Growing and manufacture of tea 60% agricultural, 40% business. Simple. Right? So rubber 65-35. Near our coastal area, Mangalore, there are a lot of rubber plantations. Yes. Then coffee, roasting and curing 75-25. I told you the logic. Whereas tea and coffee, when I say coffee, it means roasting, grounding, everything. 60-40, 60-40. This is the entire scheme of things. Okay. Now, these companies can have to follow what? Especially the tea, coffee, rubber, all these companies have to follow the respective board. There is tea development board, coffee development board, rubber development board. So they have to follow the rules and regulations of the board, and they have to keep depositing the amount to that particular board. So Income Tax Act has some deductions. So basically, if you deposit any amount, either within 6 months from the end of the previous year or before the due date of filing the return. So our previous year is 31st March 24. 6 months will be 30th September. And due date of filing the return for all companies is 31st October 24. So they are trying to tell either before 30th September or before 31st October, or let's say you are filing your return, you can file anytime before 31st October. Let's say you are filing your return on 31st August. So they are saying either before 30th September or 31st August, whichever is earlier. Whichever is earlier. What should you do? You should deposit the amount into the account. You should deposit the amount into the rubber development board, tea development board, and all those things. And this has to be deposited where? Either to the tea, coffee, rubber deposit account with the government or with NABARD, National Bank for Agriculture and Rural Development, in a scheme which is approved by the tea board, rubber board, and all those things. So instead of giving it to the board, I can give it under NABARD or I can keep it under a tea, coffee, rubber deposit account with the approval of the central government. And guys, this is like a safe space. I can use this amount for various activities which is for rubber development, tea development, coffee development. How much deduction will be there? I have deposited 20 lakhs. Will 20 lakhs be allowed to be debited to P&L account is the question. So if you see, quantum of deduction is amount deposited above or 40% of the profits of such business before allowing such deduction, and set off of brought forward of losses, whichever is lower. Whichever is lower, guys. So if I have deposited 20 lakh, either that full amount deposited 20 lakh or 40% of the profits. Let's say profit is 100 lakh. 40% of that, 40 lakh or 20 lakh, whichever is lower. If I have deposited 20 lakh and the profit is only 50 lakh or profit is 40 lakh, 40% of profit 16 lakh. 16 lakh or 20 lakh, whichever is lower. So ultimately I should do what? Whichever is lower. So this is one part. Guys, since these are the fringe areas, people think they'll not ask this only, they'll ask in the exam. Our examiners are very, very shrewd, very, very smart. Right? They're very shrewd and very smart. These kind of questions only they'll ask in the exam. Right? So you should remember this. How much? 40% of the profits of such business before allowing all the deduction under this section and set off of brought forward of losses. So you should not allow this deduction. All other profits except this deduction, because I'm computing this deduction only. Or 40% of, or the amount which has been deposited to whom? Rubber development account. Whichever is lower. Whichever is lower. Now, that amount will be allowed to be deducted only and only if you use it for the purposes. Now, I can only keep that in the account, then no problem. I can keep it in that particular account, no problem. So, my profit is 100 lakhs and I have deposited 40 lakhs or deposited 20 lakhs, sorry. So, either 40 lakh or 20 lakh, whichever is less, 20 lakh. 20 lakh if it is lying in that account, no problem. 20 lakh if it is lying in that account, absolutely no problem, as I told you. It should lie in the account. But if I withdraw that money, I should use it for certain purposes. When I withdraw that money, it should be utilized for the scheme. Tea development account, rubber development, all this will provide schemes. It should be utilized for that scheme only. But if it is utilized for this, also they'll ask in the examples, in the adjustment. So if it is utilized for office appliances, excluding computers or other office appliances, whatever you took deduction earlier will be disallowed, which means will be added to the income, will be deemed to be the income. In that 20 lakh example I gave you, 5 lakh you used for office appliances. Is it used in the factory? No, office appliances, some chair, table and all I bought. This thing I bought, printer I bought. This 5 lakh will be added to income. Any machinery or plant to be installed in office premises or residential accommodation. So machinery or plant should be there in the factory, but if I put it in the residential accommodation, one coffee vending machine, director wanted 1 lakh I spent on coffee vending machine and put it in his office or in the house. That whatever debited had happened before, now you will deem it to be the income. Machinery or plant for which actual cost is fully allowed as a deduction. Means if it's a scientific research asset under 35, specified business 35 AD, in these sections 100% deduction is allowed already. Now if I am buying those assets for which 100% deduction will be allowed under any other section, why will I take that 20 lakh as a deduction? That will be added back. Or new plant or machinery to be installed in undertaking for business specified in the 11 schedule. This tea company, rubber company, coffee company has also one more company, alcohol. They'll buy an asset, alcohol division they have. They'll buy an asset and they will put that asset in the alcohol division, tobacco division. All these are specified in the 11 schedule. Alcohol, then this paraffin wax, petroleum, natural gas, oil, petroleum, all those things. So same company may be doing both businesses. So if I buy money from this 20 lakhs only, I buy an asset and put it in that alcohol manufacturing division, obviously, why will I give deduction for that particular thing? Okay, these small things they'll ask in the exam in terms of adjustments. Okay, so you should be careful. Of course, any subsidy received, etc., will be obviously exempt, guys. Such subsidy will be exempt. Now that deposit, if the business closes down, that deposit will be taxable. If the firm is dissolved, that entire deposit will be taxable. If the SSC dies, then it is not taxable. If the HUF is partitioning, not taxable. Company is going for liquidation, not taxable. And if I acquire an asset which I have not used for these things, which is not prohibited, which means that 20 lakh I am using it to buy an asset which is actually used in tea board, rubber, all those things, then good. But guys, I may do cheating also. I may buy an asset worth 5 lakh and immediately sell it off the next day. What is the point of the deposit? The point of the deposit is furtherance of business using that asset to ensure that the tea board, a tea company, rubber company, the business will go on. But if I cheat by just taking it and selling it off, then if an asset acquired as per the scheme is transferred within 8 years from the end of the previous year in which it was acquired, such part of the cost of the asset for which deduction was allowed will be treated as income for the previous year in which the asset was transferred. Deadly. Right? So it will not be taken into account. Site restoration fund is also the same. Instead of 40%, it is 20%. This is site restoration means what? Any site which is used for mining, etc., has to be restored back. So restoring that back to the original position. So same SSE, this is for what? Prospecting for extraction of natural gas or both in India. So I have to restore the site after extracting back to how it was. And for that, if I spend money, it is allowed. Instead of 40%, here it is 20%. Withdrawal also 8 years should be the same. Right? Moving on, guys. Scientific research. So as far as scientific research is concerned, section 35. Section 35. So it is divided into 35, 1 and 2 other things, 2AB and one more. So you see, under 35, in-house research, land is not covered here. Land is not covered. And all other SSEs are covered. Land is not covered. And it covers all SSEs. But what is the scientific research? If I buy an asset which is used for scientific research, it can be capital expenditure or revenue expenditure. Income tax department gives you 100% deduction. Generally, if I buy a capital expenditure, if I make a capital expenditure, let's say I buy a machinery, it will be going to the balance sheet as an asset and then I will have to take only depreciation. But if I buy a scientific research asset, that entire amount will go to what? Debit to the P&L account under section 35, under income tax P&L account, okay? That is called in-house, that is called scientific research. It could be in-house research where the company is spending money on itself, or it could be a specified company investing in itself, or it could be a random company investing in some other company or donating to somebody, some other company, which will use it for scientific research. So one you have in-house research. One more is specified company 35(2)(ab). One more is what? Contribution to others. So what do you mean by in-house research? In in-house research, if I buy an asset, their land is not covered. If I buy land, I will not give you any 100% deduction because land is a non-depreciable asset, right? So that is why land is never covered here. In none of the cases, land is covered, honestly, right? But in-house research is for all SSEs. If, for example, a firm is doing research in scientific analysis, maybe they are doing some research in cancer, then if they buy a building worth 10 crores, that full 10 crore will be available as a debit to the P&L account. Deadly. Guys, if I debit 10 crore into the P&L account, will there be a loss? 100%, because I am not be doing anything. No, I'm just doing research. I would have commenced business also, but money is not coming in. So there will be a loss also from scientific, because of scientific expenditure, there will be a loss also. How can I carry forward that loss? All that we will see here. Okay. Land is not covered. All assets are covered. 100% deduction. Guys, specified company. Here only company is covered. Manufacturing company and biotechnology company. Earlier it was only for biotechnology, but later this manufacturing company also said, even I want to be included. So biotechnology company, manufacturing company, everybody is covered here. Only company is covered. Land and building not covered. So if a manufacturing company buys a building or a land, they cannot take 100% deduction. This is predominantly for machinery. For machinery. 100% deduction. All revenue expenditure is allowed, all capital expenditure is allowed except land and building. Pre-commencement expenses not allowed. It will only be allowed from which date? The date you commence the business. Third one, if I am not into research at all, I am a normal company, right? Like for example, Punarvas Jayakumar Classes Private Limited. Now we transfer some money to some company which is there in cancer research, okay? So let me, I donate to Tata Cancer Research Institute. They use that money for what? Whatever, scientific research. Now, since I donated my money to Tata Cancer Research Institute, can I take the debit to my P&L account? Yes. It is not related to my business only, but can I take? Yes. So 100%. But Tata Cancer Research Institute must be an approved institution. Approved as on the date of giving the loan, giving the donation, or approved as on the date of the end of the year. That also they had asked one question. At the time of giving the donation, they were approved. But by the end of the year, approval was removed. So what should I take? It is always the day when you are giving the donation. If it is approved, you are safe. Right? Yes. Unabsorbed capital expenditure, guys. As I told you what? Unabsorbed capital expenditure. How unabsorbed capital expenditure? Building 20 crore. Profits 5 crore. 15 crore is not absorbed. Unabsorbed capital expenditure is same as unabsorbed depreciation. It is carried forward indefinitely. No change. It is carried forward indefinitely. Unbelievable. It can be carried forward anytime. Absolutely no problem. Got it? So if you see, this chart is what is very, very important to understand. Page B33. Guys, research during business expenditure 100% allowed. Capital expenditure, land no deduction, others no deduction, 100% deduction. Here also same. But if you are doing any research prior to 3 years of commencement of business, then there also capital expenditure, land no deduction, others 100% deduction. Here capex, land no deduction, others 100% deduction. After you commence business, revenue expenditure 100% deduction you will get. But here, research prior to 3 years of commencement of business, revenue expenditure, purchase of raw material 100% deduction. Salary to employees 100% deduction. Others you will not get any deduction. So guys, let's say I commence my business in 2024. From 24 onwards, revenue also allowed, capital also allowed, except land for in-house research. But let's say before commencement 3 years, 21 to 24, capex, everything is allowed except land. Revenue expenditure, what are the most important things till I start the business? purchase of raw material and salary to employees. These two things are needed. So those two things are allowed. Other things are not allowed. But these things get accumulated for 3 years. Only two things. What? Purchase of raw material, salary to employees. They keep getting accumulated. And it will be allowed as a deduction in which year? It will be allowed as a deduction in the year of commencement. Allowed as a deduction in the year of commencement. And if I'm in a specified business, all these things. Research, very easy, guys. Any research association, 100% deduction. Any research association, 100% deduction. Absolutely no change. And it should be done only on the date of the granting of approval. Otherwise, there will be absolutely no deduction. Any unabsorbed capital expenditure will be treated as unabsorbed depreciation, carried forward indefinitely. Right? And finally, when the asset is being sold, what to do? Asset is being sold, what to do? Very simple. Scientific research, for example, motor vehicle. Let's take an example of motor vehicle. Motor vehicle, can it be used for scientific research? Yes, why not? I can use it to help the SSEs, help the scientists from the factory till their home to the factory, yes. Now, scientific research, motor vehicle, for example, if it is used in the business later, that we know, it was a scientific research asset used in the business later means what? It is brought into business. If it's brought into business, normal business, obviously I have to add to block. So guys, in actual cost, we already saw, if you have already used it for scientific research for which 100% reduction is already claimed, actual cost will be nil. Actual cost will be nil. After adding it to the block, sometime later if I am selling it, if I am selling the asset, then it's the same dialogue. If at least one asset is present in the block and value is existing in the block, then no capital gain. Depreciation to continue on the block of assets. But if all the assets are sold or if the value of the block becomes nil, that is selling price is more than the written down value, then capital gain will come. Selling price more than written down value, then capital gain will come. Same, very simple. That asset will be added to the block. Taken at what? 0. Then when the block is only sold, when will the block cease to exist? We have discussed. When will the block cease to exist? Block will cease to exist when value is not there and, value is there and one asset must be there, block will exist. Block will cease to exist when, if either value is not there or number of assets are not there, or number of assets become 0, then it is what it is. So then normally, if the asset is sold, if the value is there in the block, no problem. Value is not there in the block, then capital gain. On the other hand, if it is sold directly without using in any business, cost of the motor vehicle 20 lakh, deduction was allowed 20 lakh, 100% allowed. After use in scientific research, it immediately sold. Guys, if it is sold for 15 lakh, what was the cost? 20 lakh. How much was debited? 20 lakh. Now it's selling it for 15 lakh. That 15 lakh will be PGBP. Very simple. But instead of that, it is sold for 25 lakh. 20 lakh asset, fully 100% reduction, 20 lakh. Now it's sold for 25 lakh. Up to 20 lakh PGBP. Extra 5 lakh is capital gain. Extra 5 lakh is capital gain. So this is what, guys, our scientific research. This would be our scientific research. Yes, next. Come to 35D. Come to 35D first, but I'll finish off 35D. Amortization of certain preliminary expenses. So guys, if basically this section will apply to what? Either new businesses, this section will apply to new businesses, or it will apply to extension of a business. So in the company starting initially, they will spend a lot of money in preliminary expenses. This could be legal charges, feasibility study, market study, cost of preparation of any report, project report, etc. So this is for starting of any business for that matter, or it could also be Once a business has started, new line of business is added, then it could be that also. It could be for a new line of business of an existing business, or it could be setting up of a new unit, or it could be a total business altogether. When Pabba started, or rather when Ideal started, they would have done some research, feasibility study. And then they wanted to extend that. Ideal ice cream started in multiple locations. So that also is what, after commencement of new business, if I want to open in multiple locations, let's say they want to start one branch in Bangalore. So then also they have to do some feasibility study. That also will come here. Then let us say they want to set up a brand new unit. That Ideal Ice Cream became Pabas. Obviously, it is the same family. The son took over and started Pabas. It is a new unit, maybe a new company in this example. But what if they have a new sub brand? Let's say, actually, Pabas is a new company, but let's say Ideal only. They said, let me start a new brand called Pabas to cater to the college going crowd, to cater to the young generation. So then again feasibility study will happen. I hope you are understanding. For everything, these are before commencement of business. Ideally, anything before commencement of business, I told you, is not allowed in Income Tax Act. But exception is 35D. Anything when the company is not incorporated only, how will I allow that expenditure? Exception is 35D. Under 35D, it is possible for you to do it. Got it? Under 35D, it is possible for you to do it. So expenses before commencement of new business, expenses after commencement of new business. Expenses before after commencement also for extension of existing undertaking or for setting up of new unit. Preliminary expenditure will include what? Legal charges, cost of preparation of feasibility report, project report, all these things, registration fee, public issue of shares, debentures, drafting, typing, all these expenditures will be covered, guys. And guys, this you will take for how long? All the expenses that you have incurred till you have commenced business, you will add everything. And you will be getting a deduction. How much deduction you will get is what we have to see. If you check that, it will be for 5 equal installments from the year of commencement of business. 1/5 every year. All the expenses you should take into account. But then that all those expenses that you combine before commencement of business, that also has a limit. So all the expenses, let's say you have spent 1 crore. Will 1 crore be given equal 20% over 5 years? No. I cannot take 1 crore. It will be this limit, you see. For company SSE, it is either the preliminary expense, in my example 1 crore, or 5% of the cost of project or 5% of capital employed, whichever is higher. Capital employed will be your share capital, debentures, etc. Cost of project will be your assets. So it's 5% of the asset value or 5% of the capital employed, whichever is higher. That amount you should take. And preliminary expenses you should take. Then this or this, whichever is less. This or this, whichever is less, is what I need to take. And for others, it is preliminary expenses or 5% of project, whichever is less. This expenditure will be allowed over how many years? 5 years in equal installments. Be allowed in equal installments. So what is project? Total fixed assets as on the last date of the previous year. Capital expenditure will be what? Capital expenditure will be shares, debentures and long-term loans. Shares, debentures and long-term loans. Reserves and surplus will not be counted. Amortization, how much? 1/5 of the third one. 1/5 of whatever amount you get. That will be allowed over the next 5 years. Over the next 5 years. That's all there is to it and with respect to this. Similar to this 35D is 35DD, which is amortization in the case of amalgamation or demerger. When the company goes for amalgamation or demerger, the resulting company can claim. All those expenses will be there. Guys, in amalgamating company, the old company will no longer exist. New company can take all the demerger expenses or all amalgamating expenses for 5 years. 5 equal installments. They can take it for 5 equal installments. So And capital employed will have what all, guys? Share capital, debentures, long-term borrowings as on the day of the relevant previous year. Now, will it include share premium also is a question. Will it include share premium? So check out, I've sent you a notes, right? Check out question number 8 in that. Anyway, here I've given it. I've given you one merged one file. In that you see question number 8. Page number 24, question number 8. Check it out. Rama Cements is a company engaged in the manufacturing of cement. The company issued 20 lakh equity shares of 100 each to the general public. Shares are issued at a premium of 150 per share. SC claimed reduction under 35D in respect of preliminary expenses at 5% of capital employed and added the amount of share premium also to the capital employed to arrive at 5% eligible amount. The assessing officer disallowed the said expenditure on the basis that capital employed does not include share premium amount. Yes, so obviously guys, share premium is not a capital. It was the intention of the legislature, they would have told it includes premium. They would have given breakup, subscribed capital, issued capital, all those things. So there's no reference. So will you take premium also? No. Share premium is not a part of capital employed. This was a case Berger Paints, not Rudger, Berger Paints. You know, Berger Paints are there. So you can write down here only share premium account, not to be taken. You've given here actually. Leave. See? Please read all my material, every single line, because in one line there will be an question. See, this was a question which was asked when. So I have made my material with a lot of effort, guys. You see, November 2019 question paper. November 19. Adjustment also can come accordingly. Then guys, come to page B35. Very simple. This is expenditure obtaining what? Spectrum for telecom services. 35 ABA is similar to the next section, 35 ABB. 35 ABA is for right to use the spectrum for telecom services. And this one is right to obtain telecom license. So when the telecom license bidding will happen, when I buy the license, it is 35 ABB. Then I may sell the license to somebody else. Somebody else can buy the spectrum from me. The person who's buying the spectrum from me, that will come under 35 ABA. Both will be capital expenditure. Buying the license from the government, 35 ABB. Nature of expenditure, capital expenditure. So fees paid before commencement of business, I will be allowing the expenditure from the year in which the business commences till it is expired. Basically, I bought a 10-year license. I started the business in 2024. In 2025, I bought a 10-year telecom license. Deduction will be available 1/10 from 2025. On the other hand, in 2024, I bought the license. It was valid for 10 years. I started my business in 2026. Yeah, I'll buy the license and commence business. I'll commence business later because I am fixing other things. I got the license, I'm fixing other things. So now 2 years already gone. It will be allowed over how many years? Till the previous year in which the license actually expires. If it is done before the commencement of business, in which the business commences till in which it expires, 8 more years. If the business is commencing later, I will only get for the remainder time 8 years. If the business has commenced before only, then the license is bought later, then 10 years in the example. Same examples are given here. Now when I sell off the asset, check this example here. When entire right or license is transferred, M purchased the license of 10 lakhs for 10 years. License was sold in the 4th year only. So every year 1 lakh. After 4 years, amortized amount is 4 lakh, unamortized amount is 6 lakh. At the end of 4 years, I am selling the license. So you check. When the entire license is sold or transferred for 4 lakhs. Right? So 10 lakhs, in that 4 lakh, I have already taken deduction. To be taken deduction is 6 lakh. 6 lakh is still to be debited to the P&L account. But I sold it for 4 lakh already. 6 lakh is to be debited. But then 4 lakh has been credited. So this 4 lakh can be adjusted against the 6 lakh which has to be debited. Remaining 2 lakh can be allowed as a deduction from the year of transfer. Simple. But if I sell it for 15 lakhs, it's very simple, guys. I've already sold my license for 4 lakhs in this example. So what I'll do, 6 lakhs I'll debit, 4 lakhs I'll credit. That's what they're trying to tell. Anyway, it's gone. License is no longer there. Full 6 lakhs you debit this year only. Terminal depreciation concept, single asset method. 4 lakhs you credit. What is the net effect? 2 lakhs. That's why balance 2 lakhs will be allowed as a reduction. Here, 4 lakh already debited, no problem. Remaining is 6 lakh. But now it is sold for how much? 15 lakh. You can't credit 15 lakh. Why? Because cost only is 10 lakh. So, what should you do? 4 lakhs. Deduction claim till date. 4 lakhs will be business income. No choice. 4 lakh has already been debited. 6 lakh is allowed to be credited. So it's like debiting 10 lakhs, debiting 6 lakhs and crediting 10 lakhs. The license has been sold for 15 lakhs. This one, 15 minus 10, always remember, anything over and above cost is always capital gain. Logic I'll explain. You see, in the P&L account, 4 lakh I have already debited. To be debited in the next 6 years is 6 lakh. But unfortunately, I have recovered the entire amount today only. 10 lakh I have recovered. In fact, I have recovered more than the cost. I have sold it for 15 lakh. Lawmaker is telling 15 lakh minus 10 lakh. 5 lakh is always capital gain that you leave. So 6 lakh would have been debited. 6 lakh anyway is credited now. Part of the 10 lakh. Remaining 4 lakh, whatever was debited before has been recouped this year. Whatever was debited before has been recouped this year. This and this is just a notional thing that you are writing. This is actually debited. You have claimed the benefit before. Now you are taking the credit. So please pay tax on 4 lakh. That only if you give it in a formula, it will come like this. See, what is the formula here? Sale price minus unamortized amount or deduction allowed till date, whichever is less. Sale price 15 minus unamortized amount 6. That will come to 9. Or deduction allowed till date 4, whichever is less, 4. Formula and all is immaterial, guys. Logic is the most important thing. You understand the logic, everything will be easy. Just understand the logic. Capital gains will be what? Capital gains will be 15 minus 10, 5 lakhs. The part of the license is sold, no problem. Remaining will be allowed over remaining years. So if part of the license is sold for 4 lakhs, then balance 2 lakhs shall be allowed over the next 6 years, because 6 years is still pending. That's the only change. Otherwise, apart from everything is the same. Same concept for license also. This is license, that is spectrum. Spectrum also same, no change. Got it? So this is with respect to the spectrum. Specified business we'll see in the next class. Rural development, very simple. If you are contributing to rural development, 35 CCA will come. It could be any approved institutions, it could be implementing programs, National Fund for Rural Development, whatever it is, 100% deduction is allowed. And also ATG provision is also there. Similarly, agricultural project, if you do, same, 100% deduction is allowed. Same with skill development also, 100% deduction is allowed. Then we have 35D, then we have 35DD. Then in any voluntary retirement scheme, if I'm going for a voluntary retirement scheme, so deduction, basically guys, VRS is something where people will retire at the age 50, 45, 52. So the company has to pay something called as a VRS, voluntary retirement scheme. How much will they pay? They'll pay in lakhs or crores, whatever. Now, can I take the deduction, a full deduction in the same year? No. Lawmaker says you can take 5 equal installments beginning in the year in which amount is paid. This year I have paid 1 crore as voluntary retirement scheme to the employees. As a company, how much deduction can I take? I cannot take 1 crore. I can take 1 crore by 5, 20 lakhs every year. Very simple. So this is over 5 years. If I am in the business of prospecting or extraction of minerals, there also I will be incurring a lot of expenses for extracting minerals. So all those expenses I should take into account, and that also will be allowed. So when such expenditure are claimed as deduction, provided is incurred during the period of 5 years ending with the year of commencement of commercial production. So for all the operations that I have, mineral extraction operation, during the 5 years ending with the year of commencement of production, first 5 years expenditure I will take into account everything and then allow it. Over a period of 10 years in equal installments beginning with the year of commercial production. Deduction in each year will be 1/10 of the expenditure or income, whichever is lower. You'll solve a sum on this, you will understand. See this example. Kala Patthar Limited is engaged in the business of production of minerals. During the previous year 22-23, it starts commercial production of a new mine at Maki. Income from mining was 60,000 rupees. Expenses for exploring and locating mineral till 31st March 2018, 5 years, where 3 lakh. Where expenses for exploring the locating mineral was 7,50,000, plant and machinery 9 lakh. Prior period item cannot be taken. So 3 lakh here was a prior period item. This is only for after the commencement of production. This prior period item of 3 lakh cannot be taken. 9 lakh is a capital expenditure, and if you see here, is capital expenditure allowed? You see, capital expenditure in respect of which depreciation is admissible is not qualifying for deduction, because for that already I have taken a capital expenditure and I will be treating it as an asset. So 9 lakh will not be counted, 3 lakh will not be counted. Why will 3 lakh not be counted? 3 lakh is what? 3 lakh is prior period item. Why is 9 lakh not counted? While 9 lakh is capital expenditure. 7 lakh 50,000 definitely will be taken into account because that came after you commence the business. That is from April 2018 to March 2022. That will definitely come. So 7 lakh 50,000 will be eligible for deduction over 10 years in equal installment. That is 75,000 for 10 years. So you see 1/10 of the expenditure 70,000 or income whichever is lower. Guys, income they have given. Income is how much? 60,000. So mining income was 60,000. It's either 60 or 75, whichever is less. 60 or 75,000, whichever is less. Which is less? 60,000. So the remaining unabsorbed deduction of 15,000 shall become part of the deduction next year. So for this year, what is it? 60,000 only. Next year also I have to compute. No, every year I have to compute. For how many years? 5 years. Year number 1, what was the expenditure? 7 lakh 50. Suppose in the next year, mining income is 2 lakh. In this year, reduction of 75,000 plus 15,000. That is 90,000 can be claimed against the mining income. Right? 7 lakh 50,000 is eligible for first year. Then 75,000 next year. But can I take 75,000? No, I can take only 60,000. What is the unabsorbed mining expenditure? 15,000. Every year income will change and every year I should take it into account. When say it shall be carried forward for 10 years in equal installment beginning with the year of commercial production. Okay. So guys, is to read all these provisions that we have done. Please go through again with the examples. You'll 100% understand. So in the next class when we'll be starting, I'll be starting off with a very important section 35 AD. Then 36, 37. Then your 40 series, 40 capital A, 40 small a, 40 small a 1a. Then your presumptive taxation, tax audit. So a lot of discussion pending in PGBP. Very interesting area. After PGBP, we'll do other areas. So that's about it, guys. So yes, my dear buddies, let's start off with section 35 AD. Deduction of capital expenditure of specified business. Very, very important section. Usually they will definitely ask questions from this area. Yes. So deduction of capital expenditure of specified business. Okay. Specified business. Right. So capital expenditure. So this is a section whereby they are trying to tell if you invest anything where capital expenditure or what, some business, which business, specified business, then you will be getting a deduction. Under which section? 35 AD. Under 35 AD, you will be getting a deduction. What amount of deduction will you get? Eligibility will be any SSE. Amount and year of deduction. Yes, this deduction is optional. If you want, you can do, otherwise no. Deduction shall be allowed at what rate? 100% in respect of any capital expenditure incurred by the SSE. So basically guys, you need to understand that incentive can be investment linked incentive or a profit linked incentive. So investment linked incentive is 35 AD, whereas profit linked incentive is, ATIA, ATIB, ATIE, all this is there in CFN anyway. Investment linked incentive is 35 AD. So 35 AD, if you think about it, revenue expenditure is not covered in 35 AD because it's already covered under other section 32, 37. So in the previous session, we had done section 28 charging section, 29 computation of income, 30, 31 that is your building, machinery, etc. 32 depreciation. Then we did the tea development account, coffee board account, all those things. And apart from that, there is section 30 to 37, which has especially 36, which has other deductions, 37, which is general deductions, 36 is specific deductions in certain cases. Right, and then comes the 40 series, 40 capital A, 40 small a, all those things. Now, what I'm trying to tell is the capital expenditure alone is covered under 35 AD because other revenue expenditure is not covered under 35 AD. It's covered under 32 37, which means generally if I open a specified business, what is specified business? We'll see. So if I invest in some machinery, etc., generally it will be added to the asset and then depreciation will be claimed. No. But here they are saying no, directly debited to P&L account. Okay, directly debited to P&L account is what they are saying. So capital expenditure in specified business is given in which section? 35 AD. So three types of things are not covered. Tell me which are the three things not covered? Land not covered, goodwill not covered, financial instrument not covered. Which is not covered? Land, goodwill and financial instruments, LGF. LGF will be not be covered in this. So if you purchase land, no 35 AD. If you purchase goodwill, no 35 AD. Financial instrument, no 35 AD. Logic is there. Land is not depreciable. Financial instrument, it's too volatile for me to take it as a deduction, and also goodwill cannot be measured properly, or it can be open to lot of, what do you say, golmaal. It is open to a lot of golmaal. That is why goodwill also is not covered in capital expenditure. Even if it's do capital expenditure, you cannot take it as a debit to the P&L account. Hope I am clear, my dear friends. What is the list of the entire structure here? This is the list. So you need not know in depth in all these things, but at least you should know some part of the thing. Some part of the thing. So first of all, these are all the items which are there, right? Now, it all started was with, what do you say, Chidambaram ji, P. Chidambaram was the finance minister once upon a time. So he said, India has a lot of grains, pulses, etc. We are one of the largest exporters of rice, largest exporters of pulses, etc. So for storing facility, we also need to develop businesses who will do the cold chain facility. Cold chain is for storage, right? This frozen food like meat, etc. So you are, in the coastal area of Mangalore, Udupi, etc., you will have a lot of fish, etc. Then how will you store it, right? You need cold chain facility. So those businesses who run cold chains, you would have seen many such things near Mangalore, Udupi and all those things, large containers, cold chain facility. So if you are in the business of setting up and operating a cold chain facility, then what will happen? That frozen food, if you are there, if you are holding frozen food, then guys, what is that? What is the section trying to tell? That any person who setting up and operate a cold chain facility, for the cold chain facility, whatever capital expenditure he spends, he can debit it to P&L account. Crazy. So it is just encouraging people to do more and more. So back in the day when liberalization, privatization, globalization was introduced by Manmohan Singh ji, slowly we had to open up our market to outside investments. So that is why also I would also want to support the domestic investment as well. That is the reason when I am telling that, boss, if you are Indian company, you are setting up a cold chain facility, please come and take full deduction. Because for foreigners, I will have income based incentive, ATIA, ATIE, that's all for foreigners generally. Indians also can take, I'm just saying generally to attract foreign investment. For the domestic people, what to do? This section, setting up and operating a cold chain facility, frozen food and all those things. Next, setting up and operating a warehousing facility for storage of agricultural produce. So all your pulses, rice, etc. So warehousing facility also, if you do just for storage, then also you can take whatever. Let's say you construct a warehouse. You construct a warehouse. Will you get deduction on that? Yes. How much deduction? 100% deduction. Agricultural produce. Now, some people were storing sugar, cane, all those things. And they had storage facility for sugar and sugar cane. And what do you say? The assessing officer said that will not qualify as agricultural produce. Right? Sugar cane may be agricultural produce. Sugar is not agricultural produce. Sugar is a byproduct. So he said sugar cane, yes. Directly you grow sugar cane, you take it out, you store it, absolutely no problem. But sugar is a byproduct. It's a processed, when the sugar cane is processed, it becomes either jaggery or sugar. So he said sugar is not agricultural produce. So all the sugar manufacturing companies went to the finance ministry and said, boss, what is this? If sugar is not agricultural produce, you give us a separate section for the same. So think about it, guys. You see, point number 11 was added. Setting up and operating a warehouse facility for the storage of sugar. Understood? So sugar cane is agricultural produce, my dear friends. Sugar cane is agricultural produce, but sugar is this. Then, of course, during COVID, you would have seen the surge of hospitals. Movie theaters were converted to hospitals. Normal shops were converted to hospitals. So, I'm just saying, so even before that, in India, we need medical care. And the medical infrastructure is pathetic. I mean, compared to other countries, of course, because of our population, nothing can be done. So they are saying that if you build anywhere in India a hospital with at least 100 beds for patients, then that whatever building that you build, whatever you do, full 100% reduction you can take. Then, especially during tsunami, many houses were destroyed. That's one part of the story. And second one, Dharavi is a slum in the largest slum in Asia. So to ensure that I build some homes for them, I rehabilitate them. They created something called as, affordable housing scheme, especially for the ones who are affected by tsunami or to cater to the lower middle class society. Apart from that, also for the slums, I wanted to rehabilitate the slums. So if you see, point number 4 and point number 8 came into the picture. For developing and building a housing project under an affordable housing scheme. And 8, developing and building a housing project under the scheme for slum redevelopment. Housing projects came. Then, of course, we are predominantly into agriculture. We grow our own food. So obviously you need to invest in the fertilizer production companies. Hence, to, because everything is linked to agriculture there. So to do that also you have given fertilizer. So though there are various industries there, I hope you are understanding the link, why these sections came. This is predominantly Make in India campaign. Predominantly telling, please come and invest in your own country. Definitely, I will give you the tax benefit at least. If not for any other benefit, look at the tax benefit, because whatever capital expenditure you spend, it will be easily allowed in the debit to the P&L account. So in company law profits, you can show it as an asset and claim depreciation. But for income tax purposes, that entire amount you can debit to the P&L account. How cool is that, right? Yes. And apart from that, we are a treasure trove of lot of petroleum, natural gas, mineral oils, etc. So point number 6 was added. Laying and operating a cross-country natural gas, crude oil, petroleum oil network. So guys, you don't need to remember the list, but you just need to know what all is there. That's why I'm giving you the story and the real logic as to why these things came. You don't have to mug up the list. But just remember, okay, housing scheme was there, slum redevelopment was there, okay, natural gas and all was there, hospital was there. That much, if you remember, more than sufficient. Okay. Then apart from that, also, during there was a movie called Slumdog Millionaire in the year 2003. It released. It won a lot of Oscars because of lobbying. But it threw India as a slum country, and it threw India under a very bad light. So people started thinking that India is only made of slums. So there was an advent of something called slum tourism, believe it or not. So people used to come from abroad only to see our slums. Crazy. So that's why this slum redevelopment scheme also came. And apart from that, they said India is much more than these slums. So they said we'll also encourage people to, of course, like there are many natural wonders, but still it was not developed. For example, the northeast part of our country, Meghalaya, Sikkim, all these things were not developed properly back in the day. That's why they said, let us do something whereby people will also travel to these countries, to these states, Meghalaya, Nagaland, and all these things. So they said, okay, let's do that. That's why they also gave this particular option of point number 7. Because when I travel to this northeast, many of our Kannadigas and many from South India have opened hotels there. So when I asked, I was just asking around, they said, yeah, sir, we have a tax benefit. Then I was wondering, oh, yeah, correct. So their tax benefit is there. Under which section? This point number 7. Building and operating anywhere in India, hotel of 2-star or above category. Yes, guys, if you are operating in India, anywhere in India, 2-star category, that entire building that you buy, yes. Now, what if you cannot, run the building? And then can you sell it off to somebody else? Yes, you can sell it off to somebody else. And will that somebody else get the credit also? Yes, they will get. Then, of course, you would have seen in the ports, Mangalore port, Udupi port, and all those things, especially Mangaluru port, so many things will be there. There will be something called as inland container depot or container freight station. So I am from Mumbai and the goods are coming to Mangalore. Generally, earlier what had to do, I had to actually take the goods away from Mangaluru to Mumbai and I had to bear all the costs, etc. Now there is something called as inland container depot or container freight station, whereby I can just directly go there, deposit my goods there, and they will look after those goods. So those companies which are building the inland container depot or container freight station, for them also 100% deduction is available. Apart from that, for iron ore, the entire pipeline where the mining is happening, where the iron ore is getting extracted till the factory, there will be a conveyor pipe. That conveyor pipe is called a slurry pipeline for the transportation of iron ore. Setting up and operating of, yes, and also for the mobile phones, for the calculator, etc., you need something called as a semiconductor wafer fabrication unit. So that also I am giving you. Please come and do it in India only, don't go anywhere else. Guys, all these things were there. It was all logical, no problem. But Adani and Ambani went to the finance ministry and said, boss, what about us? We are businessmen who are into complete manufacturing. Of course, we are into natural gas. Of course, we are into warehousing here and there, natural gas. Okay, but what about manufacturing of any item? Where I am, like, for example, they are saying we are providing roads. Adani is constructing airports. Correct. And Adani and Reliance have taken up the project also in many areas of developing roads, developing bridges, right? Everything. So now the concert culture has picked up in India. So Diljit Dosanjh, a singer, went to Narendra Modi and said there is infrastructure needs a revamp in India for concerts. Concerts bring big money both to the artists as well as to the country and creates a lot of job opportunities. So even Narendra Modi ji acknowledged it in one of the meetings that yes, concert culture has to be developed and I need to develop the infrastructure. The first person said that yes, sir, I will develop infrastructure is Adani. So with respect to infrastructure, with respect to everything, they went and told, boss, I am in manufacturing company, but I'm also into doing all this infrastructure facility. Please give me also. So imagine coming under political pressure, point number 14 was added. Guys, for every point I can speak for 20-25 minutes. But the thing is, this is a batch, like a marathon for the examination. So, I mean, let me not go there, but at least I want to give you the logic. Simply reading and all doesn't make sense. We need to give the logic behind each point. Right? So, logic we will tell in the regular batch. 240 hours coolly will each and every point, why it came, when it came, who brought it. That's a different discussion. Right? So, but here in a marathon session, I cannot go and waste time. It cannot waste your time. My time, oh, no problem, I can speak. But I do not want to waste your time. This much is more than sufficient. I hope you understood, okay? So you should understand what all has come, why it has come, little bit, more than sufficient. So then you can all this. So laying an operating pipeline, yes. That iron ore, all these things, no, it should be owned by an Indian company or a group of such Indian companies. Infrastructure facility will be your road, toll road, bridge, water supply, everything. Land goodwill financial instrument is not there, guys. Now, additional depreciation, you would have remembered, right? Additional depreciation should only be there for new machinery. It cannot be imported into India. All those things we had seen in the previous session. Here there is something slightly different. We will discuss that, right? Okay. So first of all, guys, it should be a new business. I cannot use a old business. It cannot be split up or reconstructed business. Whatever I am doing, it should be a new business under 35AD. And also the asset that I am buying must be a new asset. It cannot be transferred from some non-specified business to specified business. So it cannot be like that. It should be like I have a non-specified business. I cannot transfer that to a specified business and say new asset. So I am having some normal manufacturing facility. I cannot take that asset and put it under infrastructure facility and then claim 100% reduction, because in the other business I already would have claimed depreciation. Well, that is not allowed. But asset must be new. Guys, but there are two exceptions. In these two exceptions, even an old asset will be a new asset. I repeat, in these two exceptions, even an old asset will be a new asset. Exception number one, should not have been used in India previously. So guys, additional depreciation cannot be claimed if you have imported an asset. It should be brand new. But here there is an exception. This is not about additional depreciation. This is about 35AD deduction. Even though you have used it abroad, if you are bringing it into India, it is deemed to be new, deadly. Right? It just should not have been used in India previously, but it could have been used from abroad, no problem, and it should be imported from abroad. And depreciation under the Income Tax Act in India should never have been claimed. So guys, additional depreciation, if you are importing an asset from abroad and using it for the first time, it is still not called as new asset for additional depreciation. But for the purpose of 35AD, for the purpose of 35AD, it is still called as what? New asset. When, what are the three conditions? Should not have been used in India previously. Second one, it should be imported from abroad. Third one, depreciation under the Income Tax Act should never have been allowed before. Right? Exception number 2, old asset is still treated as new asset if old asset is transferred from a non-specified business to a specified business. Old asset is transferred from non-specified business to specified business. It is still called as deemed new asset if value of the plant is less than or equal to 20% of the plant and machinery of the specified block of asset of specified business. So guys, if a new asset is brought into, new asset worth 20 crore is brought into it, whereas all the assets put together is already 120 crore. So 20 by 120, it is, isn't it less than 20%? Yes. Since it's less than 20%, even an old asset will be deemed to be new asset. So I hope you understood this particular point. Then any cash that you pay which is more than 10,000 rupees to a person in a day, if I buy an asset by paying cash, that will be disallowed. Remember guys, if you use it as an expense, there is a disallowance under 40A3 I had mentioned in the previous session. And if you buy an asset more than 10,000 by paying cash, it will not be added to actual cost. That also we saw now. I am not talking about actual cost. I am now debiting to P&L account. When I am debiting a capital expenditure to P&L account, here also there is a point. If I pay cash more than 10,000 to a person in a day, it will be disallowed. When 100% deduction is already allowed on this particular asset, do you really think depreciation will be allowed on this? Obviously no. Obviously no. And can I also accumulate the expenses that I have done before commencement of the business? Yes, it is allowed in the year of commencement. So if I sell the asset after claiming deduction, the same treatment as scientific research asset. We saw scientific research asset, what will happen? Scientific research asset was used and suddenly sold directly, different treatment. Brought into business, if I bring it into business guys, then WDV will be, actual cost will be 0. We had seen that. Same treatment, there is no change. And yeah, petroleum, gas, pipeline and new infrastructure business should be owned by Indian company or an Indian consortium. And hotel operation, if it is transferred from one person to another person, deduction will be allowed to the one who takes over also. There are certain things. There is one dialogue. Loss from specified business cannot be, can be set off only against profit from specified business. I repeat, loss from specified business can only be set off against profit of specified business. So for example, if PJ Hotels, specified business, has a loss of 8 crore, PJ Classes has a profit of 6 crore, can you set off? No. Loss of specified business can only be set off against profit of specified business. Here there is no set off. Second one, PJ Hotels, profit of 5 crore. PJ Beekeeping, loss of 3 crore. So can a profit of 5 crore be set off against loss of 3 crore? Yes. Can a loss profit of a specified business be set off against loss of specified business? Yes. Or can a loss of specified business be set off against profit of specified business? Yes. Third one, PJ Hotel, specified business. PJ Classes, loss 2 crore. Guys, can a profit of specified business, important point, can a profit of specified business be set off against loss of specified business? Sorry, loss of non-specified business. I repeat, can a profit of specified business set off against loss of non-specified business? Answer is yes. What is barred is, only loss from specified business can be set off only against profit of specified business. Nowhere they say profit of specified business cannot be set off against loss of non-specified business. So the third example is important. I hope you got the point. Everyone, yes or no? Right. And guys, same, the specified business to be used only for 8 years. If discarded before 8 years, then whatever deduction allowed earlier will be not claimed. So the logic is very simple. If you take roughly 15%, see all this is machinery and plant, everything, right? Building. So roughly take depreciation of 15%. So if I had debited, if I had created an asset and it would have charged 15% depreciation, then it would have been 0 by 8 years. So on the same logic, they are saying if you debit the full amount in the first year only in the P&L account, at least use it for 8 years, guys, because if you had created an asset also, you would have depreciated over 8 years. Instead of that, you are debiting the full amount this year, at least use the asset for 8 years. That's the logic. That's the logic, okay? If transferred after 8 years, then actual cost will be nil because you would have claimed the entire deduction, and that's about it. I hope you understood, my dear friends. Yes or no, all of you? Come on, thumbs up. Right. So, guys, whenever we saw the concept of subsidy, remember in actual cost, if there is a subsidy, then what will happen? They said that subsidy has to be subtracted from the actual cost, because if I buy something for 10 lakhs and then 2 lakh I get a refund from the government as a subsidy, then that has to be subtracted, we had seen. So what do you mean by this subsidy and all those things we need to check. And also we saw explanation 11 and explanation 5, which spoke about one was bringing building into the business. Building was used for personal use, now brought it into business. And one more we saw where a non-resident, that is at Firangi Limited, brought the asset into India. That also we had seen. So just to, revise that portion quickly. So the Firangi portion was explanation 11, whereas building portion was explanation 5. Now explanation number and all, if you can remember, otherwise it's okay, no problem. So if you see, explanation 5 is for both resident and non-resident, whereas explanation 11 is only for non-resident. Okay, explanation 5 is what? For building. And explanation 11 is for any asset. Explanation 11 is for any asset. And explanation 5, it's, what does it say? Rate in force on that date. Rates in force on that date. Which date? The date when you are bringing it into business. Whereas explanation 11 is rates in force. That is respective assessment year, rates in force. That is what we had seen. That's what it is. And ultimately in, what do you say, amalgamation, merger and all those things, it's very simple. The transferor, if it's a non-depreciable asset, transferee also, it's a depreciable asset. If both are depreciable asset, if transferor company is depreciable asset and transferee also is depreciable asset, then the WDV of block, whatever WDV, you should take into account. On the other hand, for one person it's a non-depreciable asset, but to the other company it's a depreciable asset, then explanation 6 to 43(1) will come, where it is actual cost of the transferee. For example, transferor company, let's say a company called Tesseract. Tesseract is being taken over by Reliance. Who's the transferor company? Tesseract. Who's the transferee company? Reliance. Let's say Reliance Realty. So Reliance is into real estate, assume. So Tesseract is a company which has a lot of land. For Tesseract company, it was a normal, company. It is, land is a depreciable asset or non-depreciable asset? Non-depreciable asset. So for transferor company, Tesseract, it is non-depreciable, but they are selling it to Reliance. Reliance is a real estate company, assume. Reliance Realty. So now transferee company is taking it as a depreciable asset or non-depreciable asset, right? Land will always be non-depreciable, guys. Land will always be non-depreciable. So this you cannot take an example, and here I am taking land as a stock in trade. So this you cannot take an example. I just want to tell you that should not get confused with these things. On the other hand, if any transferor company had taken an asset but was using it for other uses which was non-depreciable in nature, but the transferee company takes it as a depreciable asset, so then you should take the actual cost and not WDV, because transferor company had never claimed depreciation on the same. But that doesn't work for building, remember. Building used for personal purposes, it will be rates on force on that date. I should claim depreciation even if you had used it for personal purposes. I also told you the other day, instead of building, if you brought some motor vehicle, Motor vehicle, then you should take it at actual cost. So these are some of the pointers that they'll ask in the exam. Got it? Yes. Now, I want to now talk about subsidy. Subsidy. So I told you yesterday, when I give you subsidy, I am a government, I bought an asset for 10 lakh and 2 lakhs the government gave me subsidy, then I have to reduce from the actual cost. So if I want to analyze what is subsidy, the definition of subsidy is what? It can be subsidy, grant, cash incentive, duty drawback, waiver, concession, reimbursement, whatever name you give it, no problem. It will be still called as subsidy. Now subsidy will be, on a depreciable asset, or subsidy can be on a non-depreciable asset. If it is on a depreciable asset, we have already seen, guys, cost of the asset, then you should subtract the subsidy. Very simple. Cost of the asset you take, subtract the subsidy, you will get the actual cost. Very, very simple. And also we saw one thing, if government of India had given a loan, let's say 10 crore to buy an asset, and tomorrow government waives off that loan. They said no need to pay. Then will I reduce it from the actual cost? Answer is yes, because 43(1) clearly says actual cost is that cost as reduced by that portion of the cost met by some other person. So I told you that day that if government gives you some benefit, then that has to be subtracted from the actual cost. So ultimately every subsidy for a depreciable asset, has to be subtracted from the actual cost. On the other hand, if I buy a non-depreciable asset, for example, the company buys land and subsidy is given to whom? The company buys land and government gives subsidy. I repeat, the company buys land, which is a non-depreciable asset, and government gives subsidy, 2 crore, 1 crore, whatever. Guys, I bought a non-depreciable asset, but now I'm getting extra money subsidy. That will be called as PGBP income. 224.8 PGBP income. Okay. So if it's a depreciable asset, subtract from actual cost. If it's a non-depreciable asset, take it in P&L account credit side, because it's non-depreciable. Okay. So if I'm getting a subsidy, credit P&L account credit side. Now, subsidy for a depreciable asset, SSC repays the subsidy. Sir, government, you gave me 2 crores, please take that 2 crore back. So guys, whatever I have subtracted, I have to add back, obviously. And non-depreciable asset, refunded, repayment done, expense. I mean, when it's already non-depreciable asset also, if I refunded, it is expense allowed in the year of refund. Why? Because I have credited to P&L account now. Now I have to reverse it. How will I reverse it? I have to add it as an expense. Very, very simple, guys. Quite simple. Hope you got it, guys. Now let's move on to other areas. Yes. This also they regularly keep asking in the examination. Share issue expenses. Now I am issuing shares. I have made some expenses in issuing the shares. So will it come under 35D? Yesterday we saw a section preliminary expenses. Will it come under preliminary expenses or will it not come under preliminary expenses, or what is the question? So generally in adjustments they keep asking these things. Before commencement of business, if I have any share issue expenses, before commencement of business, if I have any share issue expenses, that will come under 35D. 1/5 of that will be allowed. That goes without saying, very simple. On the other hand, after commencement of business also, if there is a new undertaking or if there is an extension of business, we saw yesterday, 35D will come, 1/5 will be allowed. 1/5 will be allowed. On the other hand, if it's a working capital money, working capital, if I have taken, I mean, if you issued shares not for extension of business, I've issued shares for what? For working capital. Then I'm repaying for repayment of the loan, whatever I'm doing. Either for working capital, I'm issuing shares, or to repay the loan, I'm issuing shares. For example, in 2020, Reliance did a right issue of shares, and the main objective of the right issue was to pay off their liability, loan. If that be the case, it will not come under 35D also. It will not come under 37(1) also. The share issue expenses is not revenue in nature. It is capital in nature. Right. Then if I want to expand the authorized capital, I'll have to pay some ROC fee. Is ROC fee allowed as a deduction under 30 to 36, or is it allowed under 37 is the question. Answer is no. There's a Supreme Court judgment, Punjab State Industrial Development Corporation, where they have told no, it is not allowed, because ultimately you are issuing shares, ROC fee you pay, and that's all for expansion of your authorized capital. So you are not bringing in anything anyway. It's capital in nature, not revenue in nature. Then there was this company, Kodak India, Brook Bond, etc. So in the 90s, they also did not want so many people from outside to invest in the country. They also wanted a minimum Indian public shareholding. So Brook Bond had almost 70-80% from abroad, but the SEBI wanted, RBI wanted Indian public shareholding to be, let's say, 40%. So they told Brook Bond, you kindly issue shares new to Indians in such a manner that the Indian shareholding, public shareholding, will be 40%. I'm just giving an example. So now I am forced to issue shares. That is to comply with RBI, SCRA, Security Contract Regulation Act, or with FEMA. I am forced to issue shares to comply with what? RBI, SCRA, FEMA. So when I am forced to do it, I have some share issue expenses. Would that be allowed or disallowed? Answer is, it will not be allowed again, because again it's a capital in nature. It will not come under 30 to 36. It will not come under 37. Brook Bond India Supreme Court judgment. Kodak, one camera used to be there, no? Kodak camera. That is also Supreme Court judgment. Then what if I issue bonus shares? What if I issue bonus shares? So GIC, Supreme Court judgment, they said bonus shares will not increase my capital base at all. At the end of the day, it is what? Conversion of, it's capitalization of reserve. Reserves will be converted to capital. So is it a revenue expenditure? Yes, it will not increase the capital base. It is just revenue expenditure. So will you allow it as a deduction? Yes. So expenses on issue of bonus shares, it will not increase the capital base as such automatically. It is just conversion of what? Profit into capital. So it is revenue in nature, and hence that will be allowed as a reduction under 37 or even 30 to 36, wherever it comes. But this will prominently be under 37. Issue expenses in IPO. So guys, I have issued the shares in IPO. I have paid a lot of money. Let's say 20 lakh rupees I have spent in issuing the shares. But unfortunately, SEBI has cancelled the IPO. Just because IPO did not happen, can I still claim it? No. The purpose of the IPO was to increase the capital base. The purpose of the IPO was to increase the capital base. When I am increasing the capital base, it is not a revenue expenditure. It is a capital expenditure. So hence no deduction. So what I have done now in this chart, I have taken all the adjustments with respect to share issue expenses which has come in the exam. All the adjustments that has come in the exam, and then I have made it into this chart. So this chart will help you understand all the adjustments. Next, debentures, bonds, etc. So if debentures and bonds, if I issue the debentures, so guys, if I issue the debentures, any expense on issue of debentures or bonds, it is always be in the nature of the loan. Is it revenue expenditure or capital expenditure? Revenue expenditure. So this was given in India Cements Limited. Debentures and bonds, on the other hand, expense on issue of fully convertible debenture. Expense on issue of fully convertible debenture, it is what? In the nature of loan. In the nature of loan, obviously, because I am issuing what? FCB, FCD, fully convertible debentures. Is it revenue expenditure? Yes, because it's in the nature of loan at time of issue anyway, and it's called as revenue expenditure. Again, ITC Hotels, Karnataka High Court decision. Discount allowed on debentures. Rare case. If I issue discount on debentures, Madras Industrial Investment Corporation Supreme Court judgment. General rule 1/5 for 5 years 35D it will come. Or I can take the full payment in section 37. But in this particular case, they told, yes, you can allow yearly across the life of the debentures. So if, for example, the debenture, whatever, for 12 years, what do you say, discount allowed was, let's say, 15 crores or something, 15 lakhs. So every year, it's across 12 years. So 15 divided by 12, something like that, or whatever it is. So if the discount is 15 lakhs or 12 lakhs, and the, what do you say, age of the debentures issue entire sequence is 12 years. So 12 lakhs divided by 12, 1 lakh every year I can claim. So general rule, it is 1/5, or you can take full also, but then you can also allow yearly access. Not a problem, depends on the facts of the case. That is what they say. Then on the other hand, if I issue discount on debentures and I give two options, One option is what? To the debenture holder. One option is debenture amount is 100 rupees. Debenture amount is 100 rupees. I will give you discount of 18 rupees. I will give a discount of 18 rupees. How can you claim that 18 rupees? You can claim 9 rupees discount every year. I mean 18 rupees per annum. So 9 rupees into 5 years. I can do 9 rupees into 5 years. Correct? 99 into 2, sorry. 18 rupees into 5 years you can do. They said I am giving a discount of 18 rupees every single year. Correct? 18 rupees every single year you can claim that. Or one more option I will give you. 55 rupees upfront discount. 55 rupees upfront discount. So either you will take 18, 18, 18 every year, or 55 upfront I will give you. No problem. Your choice. Now, I gave the discount. So some of them opted for option 1, some of them opted for option 2. My question to you is, when I am claiming as a company, can I claim, okay, in the first one, 55 rupees. Can I claim entire amount, 55 rupees in the first year? And the other one, can I claim 18 into 5 in the first year? Directly. Can I claim the full amount, or should I do pro rata basis? Because here 55 rupees upfront payment, but spread across next 5 years, 10 years, whatever. So the issue here was, can I claim as per the policy, or can I claim whatever I feel like claiming? Or is there a one policy whereby in the first case you can claim the entire amount, in the second case, since upfront discount you gave 55, it should be spread across many years. Full confusion it was there. So the Supreme Court in Taparia Tools Limited, they said, boss, whatever is the policy, the assessee can claim it. It is his choice. If it is clearly outlined in the policy, he can do the needful. No need to follow a certain rule as such. Both options you can claim full amount. Just because you have given two options to the debenture holder doesn't mean there is two different tax treatment. That is just an option given to the debenture holder. He can choose upfront discount or he can choose 18 rupees discount per annum. That doesn't mean the taxability will change, or that doesn't mean the claiming power will change. So they said assessing officer has no power, absolutely no power to claim this. Okay, so this is all regarding the share issue expenses, my dear friends. Hope you got it. Yes or no? Thumbs up. Come on, all of you. Yes or no? Thumbs up. Yes, coming to section 36, my dear friends. So come to the notes here. You see, we have section 36. There you go. Page number 45. Page number 45 gives section 36. Yeah. Some of the points. Insurance premium. Insurance premium, if it is taken on stock in trade, then it will be allowed. Health insurance premium for employees, it will be allowed only if paid other than cash. If you pay in cash, health insurance premium for employees, it will be disallowed. So they can ask in the exam, insurance premium on stock paid in cash, just to confuse you. Insurance premium on stock paid in cash, that will be allowed. Then they can tell health insurance premium for employees paid in cash, that is not allowed. Any payment of bonus and commission to employees will 100% be allowed. But people were cheating. What were they doing? Bonus expense 1 lakh to bonus payable 1 lakh. Then P&L account debtor to bonus expense they were doing. That bonus payable was never paid to the employees. Cheating. Just a book entry. Bonus expense to bonus payable. That's it. And then P&L account to bonus expense. There is nothing. Bonus payable to bank was not there only. That's why government inserted a section called 43B. Under 43B, it will be allowed only if actually paid before the due date of filing the returns. So under 43B, you will be paid bonus, you will be allowed this expense only if you pay before the due date of filing the return. And then, got it? So bonus and commission should be only on paid basis under 43B. You should pay it before due date of filing your return of income. 31st October for companies, 31st July for individuals and stuff like that. And if it is transfer pricing case, 30th November. Now, coming to employer's contribution. As you know, for statutory provident fund, recognized provident fund, there is something called employer's contribution. So employer's contribution, there are two things, recognized, unrecognized. So unrecognized, if it is unrecognized provident fund, unrecognized gratuity fund, unapproved superannuation fund, in all these cases it is disallowed. But if it's a recognized fund, that is statutory provident fund, recognized provident fund, approved gratuity fund, approved superannuation fund, any other approved fund, it is always allowed subject to 43B. So recognized fund, employer also will contribute, employee also will contribute. Employee's contribution I will not take into account. Employer contribution I will take, because I am looking from the point of view of company. So when employer is contributing to any recognized fund, it is allowed subject to 43B. It is allowed subject to 43B. Right. So employer's contribution in any pension scheme, ATCCD, that is National Pension Scheme, New Pension Scheme, all these things, it is allowed to the extent of actual contribution or 10% of salary, whichever is less. But then also it is subject to 43B. This is with respect to pension scheme. Here it's respect to provident fund. Provident fund fully allowed subject to 43B. Subject to 43B means what? You just can't put a payable entry. You should actually pay to the fund before due date of filing the return. But if your contribution is towards a pension scheme, then actual contribution or 10% of salary, whichever is less only, will be taken into account. Basic pay plus dearness allowance. Subject to 43B again. That's what it is. Now, one interesting thing is with respect to your livestock. And again, this we have seen, interest on borrowed capital. It is used for personal purposes, always disallowed, guys. But if it is used for asset, till the date it is put to use, add to the actual cost. We have already seen. After put to use, it is credited to the, it is debited to the P&L account. We have seen that. Then, interesting point. Livestock. So, guys, animals which is used as what? Livestock and animals which are not used in, if you are held as capital asset, what to do? Held as stock in trade, what to do? Temple will have an elephant. That elephant, will it be capital expenditure or will it be expensed off is the question. And if it is held in stock in trade, you are having a dairy farm with lot of, what do you say, cows, that is used purely as stock in trade. No, you are having a farm which has lot of sheep and goat. You are using it purely for meat purposes. So that is stock in trade. So if that is the case, any expenditure, etc., will be, you can claim it for maintenance and all those things. But if you are using a dairy farm cows, cow is not used for meat. A product is derived from cow, that is milk. So there you are holding it as a capital asset. If you are using an elephant in a temple, you are using it as a capital asset. Any expenditure in acquiring the elephant, acquiring the cows, etc., is similar to acquiring an asset, obviously. So then the question is, should I charge depreciation on livestock? Should I charge depreciation on elephant? So interestingly, livestock is not considered as a plant. Livestock is not a plant. And you cannot claim any depreciation on that. It's not permissible. So they say only when the animal dies, actual cost of that animal minus sale price of the carcass, bones, etc. Whatever, scrap value basically. So if I bought the elephant for 10 lakh, 10 lakh minus when I sell off the carcass, bones, skin, whatever it is. It's all wrong, but it's what the law says, 2 lakh. That 8 lakh will then be allowed to be debited to P&L account under 36(1) at the time of death, not at the time of buying. It's at the time of death, not at the time of buying. So what is plant? Plant will not include animals. Is pond a normal pond? Is it a plant? It will be depending on the facts of the case. This pond, if I am rearing prawn, this pond I am rearing some special kind of fish. In this prawn I am rearing some oyster. Then it will take a functional value and then it will become a plant. If I just put a pond or a lake for recreational purposes, it will not be a pond. It will not be a plant basically. You can still deem it to be a building because we saw building will include everything including swimming pool, roads, well, tube, everything. Depreciation rate will be different, but it cannot be called as a plant. Plant is a functional element. So the question was, is animal a plant? They said no. In the definition of plant only they excluded livestock. So when will I allow livestock to run? Only at the time of death. Okay. Yes, guys. Good. All of you understood? Moving on. Let's see interest on borrowed capital. So simple. Before that, bad debts. See, bad debts are given here. C, D, G. Bad debts. bad debts. First of all, guys, it should be an actual bad debt. Provision for bad debts are not at all allowed. It must be an actual bad debt. Because provision is just an estimation. I can estimate whatever I want. So provision for bad debts are not at all allowed. But actual bad debts, are they allowed? Yes. So bad debts on sales allowed. Actual bad debt that is on a loan, it is not allowed, because under PGBP, where the main business is giving loan, then bad debt on loan, it will be allowed. But if I have given a loan to somebody and then it results in a bad debt, will it be allowed? It will definitely not be allowed. Actual bad debt on sales, will it be allowed? Yes. Actual bad debt, if it is on sales, it will be allowed for sure. But there are conditions. Conditions are what? That bad debt must be written off in the books as irrecoverable. I repeat, that bad debts must be written off in the accounts as irrecoverable. And you don't have to prove that the debt is bad though. No need to prove that the debt is bad. It's just that the bad debt should be written off as irrecoverable in the books. And at any cost, any point, I don't have to prove anything that it is bad. But I just have to completely write it off in the books of accounts. And on loan, it is not allowed except where the main business itself is lending. What about bad debt recovery? So if basically today I have debited my bad debt and said I'm not recovering it, 2 years later, that fellow will come and pay me the money. I recover the money. That year it will be taxed in the year of receipt, and SSE must be the same. It does not matter if the business is discontinued or not, SSE must be the same. So predominantly bad debt recovery, first of all, it should be written off as irrecoverable in the previous year, and that particular debt should already be taken into account in the books of accounts. If it is not taken into account, then you cannot recover the bad debt, or you cannot claim the bad debt recovery. And yes, the debt should represent the money lent in the ordinary course of business. Only then it will not come under the 3617, it will come under 37 because it's in the ordinary course of business. 3617 will come only if it is taken into account in the books of accounts already. If it's in the ordinary course of business, then it will be, representing something else. So even if you take an advance also, that will also be the same. That is the portion of bad debt recovery. Now the thing here is bad debt recovery. If the expense is allowed and then recovered, it is taxable in the year of recovery. That is general section 41.1. But 41.4 is one more section specifically for what? Bad debt recovery. So the specific section will override the general section. So whenever I put a bad debt debit expenditure and 1 year later something is credited, right? Then it is called what? Bad debts recovery. Specific section will override the general section. A specific section will override the general section. Bad debt recovery 41.1, expense will be allowed and will be recovered, will be taxable in the year of recovery. Whereas 41.4 bad debts, specific section will override the general section. A normal specific section will override the general section because the general section says any recovery I will tax, that is 41.1. But 41.4 bad debts, a specific section will always override the general one, guys. Very, very simple. Now, so bad debt recovery is covered under which section? 41.4. I repeat, bad debt recovery is covered under 41.4. Now, what happens if, one more interesting point, I am a predecessor company, means what? I am an amalgamating company, or I am the father who's having a business, or I am the demerged company, I am the partnership firm, or I am a normal firm, partnership firm. It has gone through succession. Somebody else has taken over. So if I am an amalgamating company, amalgamated company takes over. If I am the father and after I die, son takes over, daughter takes over. If I am a demerged company, resulting company takes over the business. If I am a firm, it is converted to company. If I am a firm, then partners take over the business, assume. So if I had taken it into account the bad debts, I have taken into account the bad debts, for me at debited P&L account when I was the predecessor. Then it suddenly shifts to you. You're the successor. Can you, and the thing is, first of all, I had made the sale. Three scenarios will come. I had made the sale. Then I sold the business to you. That fellow did not pay. Can you claim bad debts? Question number one. Question number two. I had made the sale. I had claimed the bad debts. Then it has succeeded. You take over. Then the money came back. Is it taxable in your hands? I have made the bad debts. I have made the sale. I have claimed the bad debts. Money came to me. I will credit it to my P&L account. Then I will shift it to you. No problem. Problem is only in the two cases. I have made the sale. I have transferred my business to you. And then that you came to know that the business, the debt has become bad. Can you claim bad debt? And if you claim bad debt, tomorrow if the money comes to you back, should you credit it to the P&L account? One more, I have made the sale, I have claimed the bad debt. Then I have transferred the entire business to you. Then the money has come to you then. Will you claim the credit? These questions come in CA final. These are tricky questions come in CA final. So if you see, predecessor is A, successor is A, debt incurred by A, written off by A, recovered by A. No, 41.4 will not come only. Same person, all cases. Even if business is discontinued, section 41.4 will come for A only. I am the predecessor, everyone is me. Debt is incurred by me. Debt is written off by me. Debt is recovered also by me. Even if my business is discontinued, I need to pay tax under 41.4. Next, A and company firm. Successor is only the partner. Debt is incurred by A, means sale is made by A. Then bad debt happens. He doesn't pay. Written off by A also, but recovered by B, guys. Recovered by B. So guys, there is a case law, PK Kaimal. PK Kaimal case law. In PK Kaimal, it says since SSE is not the same, 41.4 will not apply. It's a capital receipt, not taxable. So they came out with a deadly dialogue that SSE must be the same. The person who writes off and the person who recovers must be the same. So here predecessor A, successor B. Debt is incurred by A, but written off by B and recovered by B. So they say 3617. One fellow who has claimed, one fellow who has made the asset, can it be written off by somebody else? Answer is yes. Veerabhadra Rao case law said 3617 will apply even if the SSE is changing. You can claim. Predecessor had made the sale. In your time when you have succeeded, for you it has been written off. Is it allowed? Yes. But when I am talking about recovery 41.4, SSE must be the same. SSE must be the same at the time of recovery. The person who incurred, wrote off and recovered, all must be the same. So in this case, A is the firm, B is the successor. A had made the sale, B wrote it off, B recovered. Will 41.4 come? No, because the person who made the sale, wrote off, recovered are different. 41.4 will not come, but 41.1 will come. 41.1 is a general section. General section will come. Any recovery made later, taxable. So, in simple words, if the person making the sale and the person writing off are different, Veerabhadra Rao Supreme Court decision says 3617 will apply, even if the SSE is changing. As far as 41.4 is concerned, the person who made the sale, the person who wrote the bad debt, wrote off as a bad debt, the person who recovered, all three must be same. Only then 41.4 will come. 41.4 will not come if the person who wrote off is different from the person who recovered. The person who made the sale is different from the person who recovered. In that case, a generic section will come 41.1. 41.1. Hope you got the point, guys. Interest on loan. Interest on loan. If the loan is used for personal use, then it is not allowed. If the loan is used for personal use, it is not allowed, definitely. But means any interest is not allowed. If the loan is used for business, if the loan is used for business, if it's a scheduled bank, cooperative society, public financial institution, state financial corporation, SIDB, NBFC, then it is allowed. Why only these things, guys? Scheduled bank, cooperative societies, public financial institution, state financial corporation, small industries development bank of India, non-banking finance companies, it will be allowed if it is on paid basis. Outstanding, if it is payable, it is not allowed because everything is subject to 43B. Everything is subject to 43B. So scheduled bank, cooperative society, PFI, SFC, SIDB, NBFC, it will be allowed. Subject to 43B only on paid basis. On the other hand, if I have taken loan from others, if I have taken loan from my friend, it is allowed only on payable basis also, no problem. 43B will not come. Interesting point. If I have taken loan from others, 43B will not come because if you go to 43B, only these things are there. Scheduled bank, cooperative society, PFI, SFC, SIDB, NBFC. They are not bothered about loan taken from friend because friend anyway will know how to recover. Loan taken from money lender will know how to recover. Those things are immaterial. Then zero coupon bonds. What are zero coupon bonds? Zero coupon bonds are those bonds where the coupon or the interest rate is, zero. So that is basically I issue something at 70 and redeem at 100. So 30 rupees will be the discount. That's like indirect interest. Now this 30 rupees will be given or what do you say? Allowed as a deduction on a pro rata basis. Allowed as a deduction on a pro rata basis. So that example is given here. A Limited issues 10,000 HCBs at 200 rupees per bond on 14th August 22. Amount paid on redemption of such bond is 300. ZCBs are redeemed after 1 year. In this case, discount on such each ZCB is redemption value minus issue price. So what is the redemption value? 300 minus 200, 100 rupees per ZCB. Total discount 100 into 10,000, 10 lakh rupees. Step number 1. Number of calendar months over which discount on ZCB is divided. So guys, from 14th August 2022 to 13th August 23, 1 year. So it is 12 months. But months in the previous year 22 to 23. So should I consider August also? Yes. Because August also has to be considered as more than 15 days is there after issue of the bond. Very simple rule. If more than 15 days is there after issue of the bond, then that month has to be considered. So August, September, October, November, December, January, February, March, 8 months. So in the year 2022-23, how much is allowed? 83,333. In the next year, say 8 more months. In that year, 83,333 8 months. 6,66,667 will be allowed. So if the number of days is more than 15 days from the day you issue the bond, you will take it as 1 month. If it was less, let's say if this was issued on 16th August, then August should be excluded. August should have been excluded. Very simple. It is regarding ZCB. So my dear friends, now you read C, D, G. C, D, G. Come on guys, all of you. C, D, G. Hold on, I'll finish off these two also. You can read everything together. Provision for bad and doubtful debts, 36(1)(7)(a). This is the banks, guys. The following banks and financial institutions only can claim a deduction for provision also, because banking you can claim for provisional thing. Banking you can claim provisional thing, but not normal companies cannot claim the provision. So banks, how much? Incurred within India, 8.5% of total income they can claim, plus 10% of the aggregate advances made by rural banks. Because only in rural banks generally there will be more of NPS. Technically, as per the figures, actually even urban people do not pay. A lot of large corporates, but the income tax department feels 8.5% of total income you can do on a estimation basis, plus 10% of the rural advances only. This much is allowed as a deduction. Whereas this is banks incurred within India. But public financial institutions, state financial corporations, NBFCs and all those things can do only 5% of total income. That is one part. That is enough. That's fine. Then apart from that, there are certain specified entities like ICICI, IFCI, IDBI, LIC, IDFC or a HFC, Housing Finance Company. They can also transfer an amount to a special reserve account. This they can ask in an adjustment. Just a 1 mark adjustment they can give. So there they are saying, I can transfer to a special reserve account. So you just need to mug up this. How much is allowed as a deduction? Either of the three, whichever is less is allowed. How much is it? Either the amount that you transfer there, let's say you transfer around 10 crore, or 20% of the profits computed before claiming this deduction. So the profit is 100 crore, 20% is 20 crore, or 200% of the paid up capital and general reserve minus the balance of the special reserve account on the first day of the previous year. 200% of the PUC and general reserve means 200% of your net worth. 200% of your net worth minus the balance of the capital reserve, special reserve account on the first day of the previous year. So that amount. They have arrived at some logic. So this you just have to mug up and tell 1 or 2 marks MCQ they have asked. Right? Then family planning, you can just ignore any family planning if it is there. They never ask this question, guys. You can ignore this. And STT and CTT, definitely, if you are doing normal share trading, any security transaction, commodity transaction paid will be allowed. Then, yeah, if you are purchasing sugar cane, and in those cases, basically, whatever amount is approved, there is something called as the final cane price. When you are manufacturing sugar cane, final cane price will be arrived at by the government. So in that be the case, whatever expenditure you spend on buying the sugar cane, which will be the final cane price, whatever the case may be, then at a price which is equal to or less than the price fixed by or approved by the government, final cane price. So whatever you buy, because you are buying sugar cane as a raw material, so will it be allowed as a deduction? Yes. To what extent? To the extent of the final cane price. Right? Yes. Market to market losses we'll see later. So guys, finish off these other things now. We have done everything, but please read C, D, G. Please read right now, guys. C, D, G. All right, friends. So let's go to section 37. 36 is done. Let's go to 37. After 37, we have to do the other sections 40 small a, 40 small a 1a, 40 small a 1, 2, 43b, 40 capital A2, 40 capital A3. All those sections are there. Let us finish off 37. So 37 is a more generic section, so I'll give you time to read it later, but let me just finish the overview, okay? So if it doesn't come under 32, 36, it will come under 37. 37 is a general section. If it doesn't come under 32, 36, where will it come? 37. So 32, 36 it will not come. 37 it will come. It should not be capital expenditure. It should not be personal expenditure. And wholly or exclusively it should be taken into profession or business, and it should not be illegal. Okay, so 32, 36 it will not come. Capital expenditure it will not come. Personal expenditure it will not come. wholly and exclusively it should be for profession or business, and it should not be illegal. Then only it will come under 37(1). So this should not be illegal point was added later because, you know, in this thing, what do you say? Hello, mic testing. Okay. So that not to be illegal point was added later because, Tatas had their tea estate in northeast of the country. So when Tatas wanted to, do the harvesting of the tea leaves, they had to give a bribe or called hafta to the North Maoists and the, Naxalites there. So then Tata being a very honest individual, he added that saying that bribe given to the Northeast protection money. It's called protection money given to the Northeast to protect my estate. And he said it is general deduction. It is wholly and exclusively used for business. It is not personal expenditure. It is not capital expenditure. It is not coming under 30 to 36. So to actually curb that from happening, this section had to come. What about this? Illegal expenses are not allowed, guys, but is loss allowed? For example, this was a very famous case, Dr. T.A. Qureshi. So Dr. T.A. Qureshi was a pharmacist. He was a pharmacist by day and a drug dealer by night. True story. During the day, he was selling paracetamol. During night, he was selling all the powders. You know what powders, right? So they confiscate means what? Take ownership of. They confiscated his property worth crores. Then he said, I paid 1 lakh to this expense, 1 lakh to that expense. I had bought a two-wheeler to carry the drugs. All those expenses, is it allowed or not? Not allowed. But then he said, this business was making a profit. Now you have confiscated my raw material, or you have confiscated my finished goods. Because you have confiscated the finished goods, I have lost out on the thing worth 1 crore rupees. 1 crore rupees I have lost, which is the finished goods. So that 1 crore rupees, can I claim as a loss was the question. Guys, section 37 does not talk about any loss. It only talks about expense. So can I claim under 37(1) the loss? What do you think? Yes, loss can be claimed under 37. Only expense, illegal expense is not allowed. Illegal expense is not allowed. That is the thing. What's the difference between seize and confiscate? Seize means you will take over the possession. Confiscate means you will take over the ownership. So when you are going on the road in Mangalore, your police mama will catch you because you are not wearing helmet. Then immediately will take over the key. Will you say that mama seized my vehicle or mama confiscated my vehicle? So it is actually seized. Seize is what? Take possession. Whereas confiscation is take ownership. Okay. So in the government, if they do any illegal activities like drug, etc., they will confiscate. Confiscation is a loss. Can the loss be claimed? Yes, it can be claimed. Dr. T.A. Qureshi said so. Then, as far as these are all generic expenses, salary to employees covered, working partners you will give, salary to sleeping partner is not covered. Salary to director covered, leave salary you can take, no problem, subject to 43B. Any advertisement expenses you can give, but if the advertisement or expenses in the form of a booklet or a pamphlet, which is there for a political party, then it is not allowed. Any penalty for the breach of law is not allowed, but penalty for a breach of contract is allowed. On penalties, I'll come to it later. Taxes also. Direct taxes, that is with respect to tax, interest, penalty, not covered. Indirect taxes will be covered because except penalty, indirect tax and fees will be, interest will be covered, but subject to 43B. Diwali expenses, festival expenses will be covered, no problem. Premium for keyman insurance policy is covered under 37. Gift to employee is covered. Telephone, printing, audit fee, everything will be covered. Now, people were giving some freebies, samples, especially doctors. Doctors get lot of samples. Doctors get lot of freebies. The pharma companies will go to doctor and say, sir, if you take our tablet, if you actually prescribe our tablet to others, we will give you this much money. If you just say Dolo 1,000 crore scam, there's an allegation that during COVID, all of us used to eat Dolo like chocolates. There's an allegation which said that they had paid 1,000 crore freebies to all doctors for them to suggest Dolo and not Crocin. It's an allegation, it's still going on. So the thing is, it's still in the court. So the question I'm asking you is, for Dolo company, they have paid 1,000 crore as freebie. To whom? To the doctors. Can they claim it as a business expenditure? Answer is no. They have added those provisions now. Anything against the ICMR guidelines, Indian Council of Medical Research guidelines, whatever you do, all those activities, it is not covered. It will not be allowed. CSR expenditure, very simple. CSR 2%. So that is about it. CSR. As far as CSR is concerned, my dear friends, under section 135, 2% of average net profit is covered under section 135 of Companies Act in the preceding 3 years. So in the preceding 3 years, every 2% of the net profit will be taken into account. Now, if it is more than 2%, then the Companies Act says something else. Under section 37, my dear friends, even if you spend any amount on CSR, it will be disallowed. Why would you disallow CSR? Very simple. Why would you disallow CSR? Why would you disallow? Because CSR, corporate social responsibility, is something to give back to society. If I am giving back to society and you allow me to debit it in the P&L account, then it will be like giving a tax benefit on some donation which you are supposed to give. First of all, if I am telling you that 2% you need to donate and you put it as an expense in the P&L account, then 30% of that, 30% of 2% will be a problem. 30% of 2% will be a, if I allow a deduction, it will be like subsidizing the donation. Can you allow any subsidizing the donation? No. Since I will not allow any subsidizing the donation, they have told any CSR expense must be disallowed immediately, will be added back, will be added back. Right. So the interesting thing is, if CSR expense is disallowed only under 37, mind you, CSR expense is only disallowed under section 37. So CSR under Income Tax Act expenditure under section 37, it is disallowed. But if CSR comes under 30 to 36, if CSR expenditure comes under 30 to 36, then it will be allowed. CSR under the Income Tax Act expenditure under section 37 disallowed. But if CSR comes under 30 to 36, my dear friends, it is allowed. Because as per the law, it only says it overrides section 37. It doesn't say it overrides section 30 to 36. So depreciation on school building owned by company which is used to educate poor people. Depreciation on school building owned by company used to educate poor people. Is it CSR school building? Yes. Depreciation, is it an expenditure? Yes. Is it allowed? Yes. Because it is not under 37 but it's under 30 to 36. So CSR activity will not come under 37(1). CSR will not come under 30 to 36, but CSR expenditure can claimed as an ATG deduction. Can be claimed as an ATG deduction. So for example, if I am also doing CSR activity for two funds, Prime Minister's National Relief Fund and PM Cares Fund, Prime Minister's National Relief Fund and PM Cares Fund, then it will not be, it will not come under 37, it will not come under 30 to 36, but it will come under ATG donation. On the other hand, if it is Clean Ganga Fund and Swachh Bharat Kosh, if it is Clean Ganga, these two are important, Clean Ganga Fund and Swachh Bharat Kosh. Now, regular batch, I'll take you to the Bare Act and show you. Now, it's not needed, just study this and go, guys. Clean Ganga Fund and Swachh Bharat Kosh. These two things, very interesting to know. It will come under CSR if you don't take it under ATG. I repeat, it will come under CSR if you don't take it under ATG. If you take it under ATG, it will not come under CSR. I repeat, if you have taken it as part of CSR, then it will not come under ATG. But if you have not taken under CSR, then it will come under ATG. That's only two funds, Clean Ganga Fund, Swachh Bharat Kosh. PM National Relief Fund, PM Cares Fund will not come under 37(1), will not come under 30 to 36, will directly come under ATG. But only these two, Clean Ganga Fund and Swachh Bharat Kosh. If you take it under CSR, it will not come under ATG. But if you do not take it under CSR, it will come under ATG. Mind you, these two are important. Clean Ganga Fund and Swachh Bharat Kosh. Clean Ganga Fund and Swachh Bharat Kosh. So that is regarding that. So there were other expenses. I already showed you about bonus shares, right shares, buyback, all this we already explained with respect to 37. Now, if I have, what do you say, PVR, Priya Village Road shows, they had, what do you say, gone across everywhere to start something called as director's cut. Now, director's cut is a very luxurious form of movie viewing. So a lot of recliner seats around, so you can sit and view the movies and all those things. Now they started in Bangalore, it worked. They want to start in Mangalore, they want to start in Hubli, they want to start in Chennai and all that. But when they're doing the feasibility study, they said they asked the people, "Are you ready to pay 1,000 rupees for a movie?" They said, "Nothing doing. We will wait for the OTT to come. We will not pay. We will not pay 200 rupees also." So they had paid a lot of money to understand whether it will work or not, and they had started work also, but they eventually realized that only in Bangalore people are ready to pay, only in Mumbai people are ready to pay, only in Delhi people are ready to pay. So only in 3 places they opened that PVR director's cut. In all other places they said, let's have the normal theater. So the other expenses in other places, just because business did not go on, they still claimed it under 37(1). Because they couldn't run the show, but they still claimed all the expenses under 37(1). Is it allowed? Answer is yes. Definitely it is allowed. Definitely it is allowed. Then if you are let's say in one case, the wife was accompanying the husband to take care of his health and all those things. Wife, obviously personal expense, guys. For a company, wife accompanying husband is a personal expense. But they were going to Japan, because the Japanese delegation had called all the CEOs of India and had specifically told, please bring your spouses. Now all the other CEOs who came did not bring anybody, but this guy got his wife also. So they went and attended the program, all that hi bye, all those things, discussion happened. They got the deal. So some deal with the Japanese delegation. Who got it? This husband got it. Then all the couple's expenses, including the wife's expenses, almost 10 lakh rupees, they debited to the P&L account of the company. Assessing officer rightly said it is personal in nature. That is, wife accompanying is personal in nature, so he added back. This guy, see the argument of the company. Company said because the wife came, they got the deal. Because in Japan, they give a lot of importance to family values. So since the wife has accompanied the husband, they saw that they are together and they are strong. Second point is she looked after his health also. His health was bad, looked after, attend to the food. So he said, this is commercial expediency. Means what? It may not be just, it may not be fair to include personal expense, but it is commercial expediency. Commercial expediency means what? It's advantageous. I don't care whether it is just or not. I don't care if it is fair or not, but it is commercially advantageous. Wonderful concept. Commercial expediency. So they said it is allowed. Crazy guys, it's allowed. So there are like various cases like that which is to be taken into account. Now, with respect to the taxation aspect, I'll just quickly show you that particular chart. Okay. Right, guys. So, section 37 with respect to income tax, interest, penalty, fee. Income tax paid, my dear friends, under 40A2 will be disallowed. Guys, any income tax under 40A2, there is a separate section, 40 small a2, which says any income tax paid. How can you allow income tax paid, guys? Income tax paid is like an appropriation of income. How can you say income tax? How can you allow it as an expense? Is it allowable? Not allowed. So even DTA benefit, if there is a double taxation avoidance agreement benefit also under 90, 91, 98 is not allowed. Other loss including interest. So income tax paid under 40 small a2 is disallowed. Even DTA benefit is disallowed. Other loss including interest. If it is compensatory in nature, it is allowed. If it is penal in nature, it is disallowed. So anything which is in the nature of penalty, then is disallowed. Anything which is compensatory, then it is allowed. More on that later. GST and other taxes. Is it allowed? Yes. GST is allowed, guys. GST is allowed. Demurrage. Demurrage is allowed. Demurrage is allowed. So demurrage is anything that is like your insurance and etc. paid. Demurrage for your shipping, that is allowed. Breach of contract. Any breach of contract. Right. Breach of contract. Guys, if there is a breach of contract, then for example, there is a breach of contract means what? You have agreed with somebody that you will do something and then suddenly you will breach that contract. The contract will come to an end. So then first one is called delayed performance. So delayed performance, of course there is a delayed performance, then gone. Second one, failure to perform, means you were able to, you should have performed it within 1 month, you did not do, delayed performance. So because of which you have to pay some money. Second one, you are supposed to do it by August. Forget about August, you didn't even do it. That is point number 2. Third one, penalty in the nature of compensation. Penalty in the nature of compensation. What is that? Let's see. Penalty in the nature of compensation. What is that? For example, Malwa Vanaspati and Chemical Supreme Court decision. So guys, in Maharashtra, they are told, I will charge generally for others 4% tax. This is coming up to, let's say, 4 lakhs. But only for you, that company, Malwa Vanaspati and Chemical Company, I will charge 2% only. That is 2 lakh. And they told, in case you commit a breach, you should only sell it in Maharashtra. Malwa Vanaspati and Chemical, you should only sell it in Maharashtra. If you sell it anywhere else, then I will charge 125% of the deal. 125% extra I will charge. So guys, you were paying 2 lakh. You were paying 2 lakh. Now they are telling that if you sell it elsewhere and you do not stick to the deal, you should sell it only in Maharashtra. If you sell it elsewhere, what will I do? I will charge 125%. So they are saying now, because you are selling it elsewhere, I am going to charge apart from that 2 lakh, 125% is how much? 2.5 lakh. What is 125% of 2 lakh? 2.5 lakh. So apart from that 2 lakh, I will charge 2 lakh 50,000 rupees. And this 2 lakh rupees, anyway this 2 lakh is becoming 4 lakh. This 2 lakh is anyway becoming 4 lakh. Right? This 2 lakh is becoming 4 lakh. So 2% plus 2.5% is 4.5%. So 2% to 4.5%. If it becomes 4%, this is like what anybody else in Maharashtra will anyway pay 4 lakh. Correct? So I had given you discount 2 lakh. But if I am giving you 4.5 lakh now, 4 lakh anyway everybody else will pay. So 2 lakh to 4 lakh. If it is going from 2 lakh to 4 lakh, it is just compensatory in nature. That's the difference. Compensatory, penal. Compensatory nature means it was supposed to be 2 lakh. It's supposed to be 4 lakh. I gave you discount 2 lakh. Now if you have breached the agreement, I am making you pay 4.5 lakh. Until 4 lakh, it's okay. Anyway, I would have paid 4 lakh. So that 2 lakh extra is called compensatory in nature. And that extra 50,000 is penal in nature, which is disallowed. That extra 50k is penal in nature, that is disallowed. So 2 lakh is compensatory in nature. Remaining 50k is penal in nature. So that is the deal. Penalty in the nature of compensation. Malwa, Vanaspati and Chemical Supreme Court decision. This is what they said. Then interest on default in paying TDS. Interest on 234 ABC. Interest in default in paying TDS. Again, it is not to be taken into account. Interest on 234 ABC. Any interest that you are paying, again, it is linked to tax only. That is not allowed. Interest on loan. Interest on loan taken to pay income tax. Guys, I have taken a loan to pay income tax. How cool is that? I have taken a loan to pay income tax. If I have taken a loan to pay income tax, then it is not allowed. But if I have taken interest on loan to pay, I have taken a loan to pay something else and then I am paying interest. Penal interest paid, allowed. Penal interest, extra interest. Basically, I have delayed. For example, I have taken a loan for my business. What is the interest charge? 10%. Is that 10% allowed? It is allowed under 36. I'll repeat. I have taken loan for my business at 10%. Is this 10% allowed? Yes, under section 36 only we saw already. When I did not pay the loan or when I delayed the loan, they charged a penal interest of 2%, extra penal. Is this allowed? Yes, this is allowed under 37. That is what I am trying to tell. That is allowed under 37. Interest on loan we already saw in 36. No, that is interest on loan. Now I am talking about interest on penal interest on loan. That is 37. So if I have paying interest on a loan taken to pay income tax, then it is a no. But in any other case, penal interest paid, yes. Then any fee, TDS filing for scientific research, 234 EFG, whatever, it is neither interest nor penalty, normal fee. For scientific research, I told you to take an approval. For that, you have to file a certification. For that, you have to pay fee. So this is neither interest nor penalty, but ICAI in the adjustment has allowed. All these are examination adjustments. ICAI says it is allowed. ICAI says it is allowed. Then website expenses is traveling expense in nature. Yes, it is revenue expenditure allowed. Prior period expenses, which are pertaining to previous years, disallowed. But if it results in embezzlement, somebody had embezzled cash before, I did not know. This time there is a loss. It's a prior period item, but earlier I thought it was there. For example, embezzlement. It's a loss. I told you losses are always allowed. Prior period item, if it is crystallized during the previous year, means what? If I have figured out the expense exact amount and if I'm debiting to P&L account, that will be allowed. Retrenchment compensation. It's a compensation given to forcefully retire somebody. So I'll tell somebody, boss, anyway, I don't want to keep you on board. You either resign or I will throw you out. Instead of throwing you out, you only resign. That is called retrenchment. For that, I'll give you compensation. If the business is closed down, any compensation paid is capital in nature, not allowed. But if it is a compensation given when business is still running, so in Ravindranath Nair case law, 4 out of 10 businesses were shut down, 6 businesses were running, and they gave retrenchment compensation. Is it allowed? Yes, 37(1), it will be allowed. Top employee, I have given golf club membership. Is it allowed under 37? Yes. Company paid golf membership, definitely 37(1). And there is glow signboard. In the glowing signboard, which is there everywhere, it keeps getting, it keeps going every 2 to 3 months. Glow signboard. But still, I don't care. It's not capital in nature. It's revenue in nature, 37(1). These are all decided case laws. It's all decided case laws. Now, whatever name you suggest of an offense, it can be compounding fee, regularization fee, compoundable offense, nomenclature does not matter at all. Any compounding done, that is also, what do you say, freebies, etc. Some courts justified the freebies. They said nothing doing, none of that will be allowed. None of this will be allowed. Definitely not allowed. Provision for diminution of investment, deferred taxes, impairment of assets, all these provisions are never allowed. Dividend distribution tax till 1/4/2020. The dividend distribution tax also was not allowed under 37(1) because now there's no DDT. Now the shareholders only have to pay. Provision for subsidiary company. At the holding company, I make provision for subsidiary company. Not allowed. Any salary and perquisites given to the directors are allowed under 37(1) subject to 40(a)(2). We'll do 40(a)(2) immediately. These are the things, guys. So this is ultimately all that is with respect to section 37. I hope you understood this, section 37. The next section is with respect to TDS. TDS default 40 small a1, 40 small a 1a. 40 small a1, 40 small a 1a. 40 small a1. What is this? What is covered? Who is covered? What is the component? What are the conditions of disallowance? And what is the amount of disallowance? So here the issue is very simple, guys. I am paying interest, royalty, FTS, fee from technical services, or any amount on which TDS is payable. Interest, royalty, fee from technical services, any amount on which TDS is payable, except TDS on salary. Where am I paying, guys? I am paying outside India. If I am paying interest outside India, royalty outside India, fee from technical service outside India, or any amount on which TDS is payable outside India, or if I'm giving to a foreign company, or if I'm making a payment to NRA in India, money is going out, TDS has not been deducted. Deadly. Which means Nirmala madam is not getting the TDS portion. Nirmala madam is not getting the TDS. Deadliest portion. Deadliest portion. Nirmala madam is not getting the TDS. Right? So, what is covered? Interest, royalty, fee from technical service. Interest, royalty, fee from technical service, and any amount on which TDS is payable. Any amount on which TDS is payable. So guys, I am transferring money from India to outside India. I am transferring interest, royalty, fee from technical service, and any amount on which TDS is payable. All these things I am transferring outside India. Or it can be a foreign company, or I am making a payment to an NRI in India, whatever the case may be. If I don't deduct TDS, it's a problem. So what is the component? TDS deductible is the component. What is the component? TDS deductible. It will be on as per the rates prescribed. Whatever rates, foreign rates. If you don't do it, which means what, guys? If the TDS is deductible but not deducted. If the TDS is deductible but not deducted. If the TDS is deductible, deducted but not paid to the government before due date of filing the return. Right? If the TDS is deductible but not deducted, or if the TDS is deductible, deducted but not paid to the government, before which day? Due date of filing the return of income. So there are two things that can happen. I am paying to a foreigner 1 lakh rupees. I was supposed to deduct 10,000 rupees TDS. So what is the first scenario? I did not deduct TDS only. Directly paid 1 lakh to him. Nirmala madam is angry. Second one, deductible, deducted but not paid to government. I paid to the foreigner 90,000. I retained 10,000. I didn't pay to Nirmala madam. Then also she is very angry. In the first case she is angry. Okay, boss, you didn't deduct, you paid directly to her, to them. At least I can try recovering from them. But in the second case, I have deducted and paid 90,000 to that foreigner. But 10,000 I am only keeping nicely. She is double angry. And guys, in both the cases, no mercy. How much did amount of disallowance? 100%. So, if the amount is 1 lakh, directly paid to the foreigner without deducting TDS, full 1 lakh disallowed, no mercy. On the other hand, I paid to the foreigner 90k. I retained 10k TDS, didn't deposit to Nirmala madam. 1 lakh disallowed. Deadly. That is the section 40A 1A. It is only interest, royalty, fee for technical services, FTS, or any amount on which TDS is payable. Any amount on which TDS is payable. That also they added later. TDS on salary is not covered here. You are a, let's say your name is Mr. Guillaume. Your name is Mr. Guillaume. You are from some France or Netherlands. You come to India and you are the CEO of some joint venture. You are the CEO of Starbucks. You come to India, India Starbucks. So you are the CEO of India Starbucks. All the money, etc., is coming to you from India, but it's going to your parent bank in Netherlands or wherever, France, wherever your bank is, it's going there. If you don't deduct TDS there, it will not come under this section, guys. It will come under 40A3, different section is there. Right? Yes. So, outside India, foreign company, what people were doing, no, they were telling, okay, boss, if I pay outside India without TDS, it's a problem. I used to tell that NRI, if I supposed to pay you outside India and you don't pay, it's a problem. So I told you one more thing. You come to India. You come to India. Payment to NRI in India, then it's a problem. You come to India, then I'll make the payment. So they said, nothing doing, boss. I'll cover everybody. You don't pay TDS outside India, disallowed. You don't pay TDS foreign company, disallowed. You don't pay payment to NRI in India, disallowed. How much is disallowed? 100%. Is it a permanent disallowance or not? That's the next question. Is it a permanent disallowance or what? Answer is no. It's not a permanent disallowance. It will be allowed the year you pay. So this year you don't pay. Next year you pay. No problem, allowed. It will be allowed in the year in which you deduct and pay tax to Nirmala Madam. I repeat, it will be allowed in the year in which you deduct and pay to Nirmala Madam. 1 lakh will be allowed when you make the payment of 10,000 rupees to Nirmala Madam, whichever year you make it. Very simple. So when will it be make it? That will be allowed in the previous year in which it is paid. Resident also same dialogue, 40A1A. See, here it is interest royalty free from technical services, 40A1. 40A1A is what? Resident. What is done? Any sum payable. Here there is no interest royalty fee for technical, it's any sum. Here it is what? Interest royalty fee from technical services, any amount on which TDS is payable. Here it is what? Any amount payable. No interest royalty. It's for resident. Who is covered here? Resident. Component is the same. TDS deductible, not deducted. TDS deductible, deducted but not paid. Guys, but here 100% is not disallowed. 30% is disallowed. 100% is not disallowed. 30% is disallowed. So 30% of the expense will be disallowed. Very simple. So what is covered? Any sum payable. Who is covered? Resident. Component and condition same as 40A1. How much is covered? 30% of the expense is covered under 40A1A. 30% of the expense is covered under which section? 40A1A. Got it? It is disallowed. 30% of the expense, which means if this 1 lakh rupees, I have deducted 10K and I have paid to that fellow 90K, but this 10,000 I have not deposited to Nirmala Madam, then she says 30,000 is disallowed of this 1 lakh. 70,000 is allowed. Is this permanent disallowance? No. The moment I make this payment of 10,000 in whichever previous year, whichever financial year, that year I will get this 30K allowance again. So whatever was added back, I can debit it to penal account. That is the logic. That is the logic. Now there is one question. TDS deductible, deducted and not paid, I understand. TDS deductible, deducted and not paid, I understand. Now, instead of deducting 10,000, I deducted 10,000, deductible, deducted, not paid, okay. What if I didn't deduct only this one? What if I didn't deduct? Which means 1 lakh rupees I paid him directly without deducting. Nirmala Madam is telling the moment it is deducted and paid, then it is sorted. But I have not deducted and paid. I have already transferred full 1 lakh to the other person. What to do? Generally, guys, if you do not do this, you will be called as an SSC in default. Because TDS is the duty of the deductor. If you don't deduct, you will be called as SSC in default. In this particular thing, you will be now what? SSC in default, unfortunately. Of course you are. What are you? SSC in default. So the people went and requested Nirmala Madam, Madam, please don't call me SSC in default. Please do something about it, whereby I will not be called as SSC in default. Can you do something? She said, okay. Let's say you're given to the foreigner. You go to the foreigner and say, or even in the domestic company, let's say I've already paid off that money to him. You go to him and say, sir, now I was supposed to deduct, but instead of that, I paid you only directly. In that 1 lakh, 10,000 I was supposed to deduct, give you 90,000. By mistake, I paid you 1 lakh. So you go and beg, sir, Have you considered 1 lakh in your income, sir? For me, 1 lakh is expense. For you is 1 lakh income, sir. You will tell, yes, sir, 1 lakh is expense. Second one, sir, have you paid tax on that 1 lakh, sir? Have you paid tax on that 1 lakh, sir? That fellow will say, yes, sir, I have paid tax. I'll tell, sir, can you please give me that uh, income tax computation and that receipt where you have paid the tax, sir, please, on that 1 lakh. Okay. See, so much I have to beg him. I have to beg him and say, sir, I had to pay you 90,000. By mistake, I paid you 1 lakh. Nirmala madam is behind me. She is now calling me SSC in default. To avoid that from happening, sir, one small request. First one, sir, have you paid tax? Have you considered 1 lakh as your income, sir? Yes, sir. Have you paid tax on it, sir? Yes, sir. Sir, can I get the receipt, sir? Yes, sir. Nirmala madam will say, this is not enough. I will need one authority to certify that whatever is happening is correct. Who is that certification authority? You only, chartered accountant. So she says, go to a CA and get it certified. Then only, then come to me, then I will agree. You did not pay, you did not deduct, but prove it to me that other fellow considered that 1 lakh in his income, other fellow paid, deducted TDS, other fellow, not TDS, paid tax basically, other fellow gave me the proof, and the entire transaction is certified by a chartered accountant. Then only I'll agree. Otherwise, no. Otherwise, you will still be called as an SSE in default, deadly point. Is there still a defect? Yes, there is a defect, but I'll not call you SSE in default. So they're saying, check here. When will it be allowed? It will be allowed in the previous year in which it is paid, or it is allowed when the payee pays the tax. I'll go beg no. When that fellow pays the tax and files the return of income and fulfills all the conditions, then only I'll be safe. Then I'll be like, oh, correct, okay, thank you. Got it? So, for example, if PJ Limited, who's the SSE, is paying a professional fee of 2 lakh rupees to Mr. Ching Chong of China, right? So, if I paid 2 lakh without TDS, TDS now deducted only, deadly. This is TDS deductible but not deducted, left side. Right side, TDS deductible, deducted but not paid to Nirmala madam. Let's see the right side first, easy what it is. 1,80,000 paid, 20,000 payable and deducted but not remitted to government, cheating. If you pay that 20,000 before 31st October 2020, before due date of filing the return, then 2 lakh is allowed. But if you pay to the government on 31/12/2023, my dear friends, that is the next year. I'm talking about 22-23 now. 100%, that is 2 lakh is not allowed in 22-23, but 2 lakh will be allowed in 23-24, the year in which you pay. Simple. The year in which you pay. Then year. On the other hand, 2 lakh I have paid without TDS. Full 2 lakh is disallowed. So for PJ Limited, 2 lakh will be disallowed. So he has to pay plus 2 lakh, 30% on that. And Mr. Ching Chang also should pay tax on 2 lakh, double taxation. To avoid that, I will give those 4 items. Go beg him and all those things. This is regarding 40A1 and 40A1A. 48.2 is income tax. Already discussed. Income tax payable, disallowed always. 48.3, guys. Salary paid to non-resident who's outside India. Deadly, you see, salary paid to Bakra fellow 5 lakh rupees, to TDS payable 1 lakh 50, to bank 3 lakh 50. If this 1 lakh 50 is deducted and remitted from April to Feb, whatever may make your payment, 7th of next month you need to deduct and pay. And for March month you should pay within 30th April, deduct and pay. Salary, that is your, Mr. Guillaume, I gave you that example. Most important thing, if you do not pay on time, what's the due date? 7th of next month, 30th of April. For March, 30th of April. For April to February, 7th of next month. Then guys, even if there is a 1 day delay, deadly, even if there is a 1 day delay, fully disallowed. Even if there is a 1 day delay, fully disallowed. Deadly point. Due date is not due date of filing the return. Due date is this due date, 7th of next month. That is for salary portion only. 40A3 salary portion. This is 40A1, 40A1A, 40A2, 40A3. Going on, this one. Payment made to state government. So guys, what used to happen was many, companies which were owned by state government. For example, we have Jungle Lodges in Karnataka. Jungle Lodges Private Limited is a government owned company which is actually making a lot of profit because they have all these forest resorts in the jungles of India, of Karnataka rather. So let's say the state government owns 100% in Jungle Lodges Private Limited, and all the profits they want to take out in the form of dividend, service fee, privilege fee, whatever they charge. So everything, all the earning is done by that state government company, and they are passing it on to the state government as form as fees, license fee, royalty, service fee, whatever. Government did not like this. Government said some money should be there in the companies also. You take your dividend for the shareholding, whatever. Dividend is okay, but don't take any other thing. Don't take all the money. If you take for Jungle Lodges and private limited, it will be disallowed. You are making huge profits and you are not paying any tax because you are showing expense called royalty, license fee, service fee. All the money is going to government. Will government pay tax on itself? No. For that government tax free. For this company also tax free. Why? Everything is debited to P&L account. Cheating. So they said this one. No deduction shall be allowed in respect of any amount paid by way of royalty, license fee, service fee, privilege fee, service charge, whatever you pay to the state government is levied exclusively on a state government undertaking by the state government is disallowed. Right? State government company transferring most of the thing to state government, not allowed. Then they asked a counter question. Nirmala madam, can you take it? Can central government take money from jungle lodges? Will that be disallowed? Nirmala madam said no. See guys, no disallowance under this section if said payment are made to central government. Central government will pay nothing. And the state government is making payment to all people similarly, then it's okay. But exclusively to state government, not allowed. Exclusively is the key word. But if it's making exclusive to central government, allowed. Deadly. Exclusively to central government, allowed. Crazy. So payment made to state government, 40A to B, deadly points. See how they cheat. Cheat, planning, whatever you call it. Any payment to any provident fund or other fund is always allowed, guys. When TDS is deducted, that's fine. Then 40A5, this is what? Tax on non-monetary perquisite. For example, if I'm paying an employee 10 lakh, of which 8 lakh is your fixed pay, 2 lakh is your rent-free accommodation. Employee has to pay full tax on 10 lakh. He will say, I will not pay tax. Let's make it like 30 lakh. 20 lakh is fixed, 10 lakh is your accommodation per annum. He will say, I will not pay tax on this. He will say, I only pay tax on this. He will tell, if you want me to join the company, this has to be borne by the company. So when the company is debiting the account for salary, 30 lakhs will go. This is fully allowed, no problem. But on this 10 lakh, 30% tax will come, no? Because it's a higher slab rate, 30 lakhs. 30 lakhs is higher slab rate for the employee. So this 3 lakh tax, 3 lakh tax, employee is telling, I will not pay. Do whatever you want. It won't come 3 lakh. You'll have to take the entire amount. You take the entire amount. On 30 lakhs, you'll be paying something, no? How much you'll be paying? 15 lakh into 30%. 4.5 lakh. Plus 1 lakh 40,000 in the new regime. 5 lakh 90,000 you'll be paying tax. So employee is telling 5 lakh 90,000 tax is for my income of 30 lakh. What is the proportionate for 10 lakh? What will be the tax? What will be the tax? So it will be around 1,63,000. Just an example. 1,63,000 I am not going to pay. You do whatever you want. I am not going to pay. It's your expense. So the cost to company will be 5,90,000 first of all. Sorry, this 30 lakh first of all. Plus this extra 1,63,000. Tax. Tax which should have been paid by the employee is being paid by the employer. What is this? This is a non-monetary perquisite like rent-free accommodation. The question is, when I am debiting to my P&L account from as a company, 30 lakh will be allowed, I agree. What about 1,63,000? What about 1,63,000 was the question. You see? Tax on net, any tax on non-monetary perquisites borne by the employer on behalf of the employee, which is exempt under 1010 CC, in the hands of the employee shall be disallowed. So 1,63,000 will be added to the P&L account of the company. They have to pay tax on this 30%. Who has to pay? Company has to pay. Like a tax on tax. And this portion of tax is exempt for the employee. So he will compute his tax 5,90,000 minus 1,63,000 will do, balance only he will pay. That is this point. I hope you got it. Tax paid by employer on non-monetary perquisite 40A5. 40A5. Next. Certain payments which are disallowed. 40 capital A2. 40 capital A2. Under 40 A2, guys, in the Companies Act, the relative is defined under 2 clause 77. So for that person, you will include brother, sister, father, mother, son and son and stepson, son and son's wife, daughter and daughter's husband, spouse. And for father, mother, brother, sister, son, step people are covered, except daughter. Stepdaughter is not covered, error of omission. Spouse is covered. Step spouse and all don't write. 2 people, 3 people, sir. No, only one. Yes, only one. Legally wedded. Sir, one in every place? No, only one. Legally wedded spouse. Your mother-in-law, father-in-law and all are not relatives in Companies Act. But I am not looking at Companies Act now. I have to look at what Income Tax Act. Income Tax Act is very simple. Lineal ascendant, lineal descendant. Whoever is coming on top, whoever is coming down, all siblings everywhere. So for an individual, relative is covered. For a HUF, members and the relative is covered. For a partnership firm or LLP, partner and relative is covered. For AOP, BOI, member and relatives are covered. For company, directors and relatives, everybody is covered. No questions asked. For a specified person, you should take a relative and anyone who, so basically guys, what this section is very simple. If a company is making payment to relative of a director, if a company is making payment to a partnership firm in which the director happens to be a member, the company is making payment to an AOP in which one of the directors is a member, The company is making payment to one more company in which the director happens to be a shareholder or director there. There is a, what do you say, relative. Then he says that is if it is excessive or unreasonable. If it is excessive or unreasonable, that will be disallowed. If it is up to the mark, okay. But if it is excessive or unreasonable, then it will be what? Disallowed. If it is something more excessive or unreasonable, it will be disallowed. So, who will decide this? Assessing officer will decide this. I have hired the director's relative as an accountant in my company. I have hired a director's relative as an accountant in my company. Outside he was getting 40,000 rupees per month. Here I am paying 4 lakh rupees per month. Why? Only because he is the director's relative. 3.6 lakh is extra. I am actually saving tax on 3.6 lakh rupees. Will that be disallowed? Yes. Excessive payment will be disallowed. That is 48. So, but here you should also see not just the relative, but also any other company in which you have a substantial interest. That also you need to see. They are also related parties. Any specified person, relative, or anybody who has a substantial interest. What is substantial interest? Very simple. It is where you have more than 20% voting power. Substantial interest will be where you have 20% voting power. So in the exam, this much depth is not needed. They'll only give you 20% voting power. They'll only give you a relative and all those things. That much you remember and go, more than sufficient. So guys, 48 unreasonable expenditure only is disallowed. So this and all you can just go through, no problem. But of course, just these examples they have given. If I have a dry cleaning business and there is an SSE, SSE is a sole proprietor. All relatives of the SSE deemed to be a relative. So any payment made by the dry cleaning business to the relative of SSE, if it's excessive, disallowed. Any individual or a relative of such individual who has substantial interest, means what? 20% of the voting power of the dry cleaning business, they are also covered. Any company, firm, AOP, BOI who has 20% voting power in that particular thing, they are also covered like that. So in the exam, they'll only give you 20%. You just remember that and go. Similarly, holding and subsidiary companies also, they are covered with each other. So if any trade discount is given to one company, then that is not covered under 48 because trade discount everybody will give anyway. Right. Apart from that, you have 48.3 which you have already discussed. Any which you have discussed in actual cost anyway. Any cash payment made beyond 10,000 rupees. Beyond 10,000 rupees to a person in a single day. To a person in a single day will be taxable. In the sense disallowed and taxable. Payment should be made other than what? Account pay check, account pay bank draft, ECS. If it is made other than that, disallowed. Which means it should be made only by account pay check, account pay bank draft, then RTGS, ECS, electronic clearing system. To a person in a single day, more than 10,000, refer the same chart of actual cost. Other payment will be NEFT, IMPS, RTGS, UPI, all these are covered. So, for example, one more example. If Mr. A pays 10,000 rupees per day for 60 days continuously, will he get a disallowance under 40A3? No. But will the receiver get a penalty? Yes. So that also they have capped. Receiver will get penalty under 269 ST. Receiver will get penalty under 269 ST. 100% penalty will get. Receiver will get penalty under 269 ST. 100% penalty. Yes. Co-payment. 15,000 rupees cash is given to a person. To a person more than 10,000, disallowance will come. 2 lakh 10,000 in that 10,000 every day, no problem. Suddenly 1 lakh 70,000 I'm giving, disallowed. And the same guy is receiving so much amount, more than 2 lakh rupees, 269 ST penalty will come for that guy. Can I do this also? Expenses account 20,000 to expenses payable 20,000, financial year 2023, it is allowed in 2023 because it's just payable entry, no problem. Next year I pay cash, imagine, next year I pay cash. 1 year it is allowed, next year I am paying cash. You can't say I can disallow it because last year it was allowed. In 23-24 I cannot say expenses disallowed. It will be disallowed only if it is allowable. I repeat, it will be disallowed only if it is allowable. Is it allowable this year? No. Why? Last year only I allowed it, no. So in 23-24, expense payable to cash. Can I debit it to P&L account, add it back? No. Because I debited to P&L account last year. So lawmaker is telling under 48(3)(a), what you claimed expense as last year, but this year you are making payment in cash, I cannot disallow because last year you allowed it. This year I cannot disallow. What did they do? Instead, I will take it as income. Disallow, adding back is as good as adding income. Adding back the expense is as good as adding income. So they said deemed income. 48(3)(a), 20,000 is deemed income. That's all. Then some people were cheating like this. They are paying advance to cash, 40-40. And then they were making a journal entry, purchase or expense account to advance. Expenses should not be more than 10,000 rupees, they said, but they made ulta. They made advance to cash, 40-40. 40(a)(3) is disallowed even if payment was made before booking the expense. That's all. Simple. But there are certain exceptions, guys. If you are running a goods carriage vehicle, that 10,000 is increased to 35,000 rupees per person per day. So goods carriage, if you are giving, no problem. Then a contract will say that you have to pay only cash 20,000. But when I'm making the payment to you, I will not pay cash. I will pay through bank account. You will say the contract clearly mentioned you have to pay cash only. I will say, sir, if I pay cash, I'll be violating income tax law. You will say, but if you don't pay cash, you'll be violating Contract Act. So there is a problem now between Contract Act and Income Tax Act. What will apply? In a fight between contract law and Contract Act and Income Tax Act, what will prevail? Income tax law will prevail. 40(a)(3) will override Indian Contract Act. Then there is a rule 6DD which says 40(a)(3) is not applicable in the following cases. It is not applicable where payment is made to government, RBI, SBI. They can make direct cash payment, no problem. If there's any letter of credit, bill of exchange, I can make. If this is just a book adjustment, book entry, I can make. These are all MCQ questions. I can make payment to employee or legal heir of employee for gratuity or retrenchment compensation. If I am giving some gratuity or if I am making retrenchment compensation up to 50,000 rupees, I can make a payment to the employee or legal heir in cash up to 50,000 only. 10,000 disallowed, but exception 50,000. Only for what? Gratuity, retrenchment compensation. I will go to a village where banking facility is not available. Can I make payment in cash? Yes. They'll twist this question and ask, I'll go to a village where banking facility is available, but that day it is a holiday. Can I make payment in cash? No. MCQ question this is. Have they told where it is, bank is closed? No. That provision was there earlier. They have deleted it. Which means you cannot say bank is closed. Now UPI payment has come, guys. You cannot say bank is closed, that date and all, you cannot tell. Then, if you are an employee of a ship and posted in a place other than where your usual place of business and no bank account also in that ship, and you're staying for more than 15 days in that ship, TDS will be deducted, but you can pay in cash. If it's your own ship, where your bank account will always be there in that ship, then then there is no cash payment. If you are in some other ship where your bank account is not there, then you can pay in cash if TDS is deducted. Payment made to agent, you can make a payment to the agent in cash, no problem. You go to an authorized money changer for some cash, that is your Western Union money transfer, ICICI, all these people, for some trip you want some cash, you buy dollars and pay cash, no problem. Problem or no problem? Problem. I repeat, if you pay to Western Union money transfer in cash, that's a problem. You cannot pay. But you have gone for a trip and come back, you have some $1,000 with you. $1,000 into 80 is 80, 100, 80,000 rupees. You will go to the Western Union money transfer and give that $100,000. They will give you 80,000 rupees. Can they give you cash? Yes, they can. Payment made by authorized money changer. And any cottage industry like bamboo, etc., where they don't use power, can they pay you cash? I mean, can you pay them cash? Yes. You want to go buy fresh fish from a fisherman. Your ITC hotel in Mangalore. You are going to directly to Bengre Beach. And you are taking what? You are going to Bengre Beach directly and you are taking, what do you say, fish from them. You are paying him as ITC company, you are paying him 25,000 rupees, no problem. Payment made to producer, agricultural produce, forest produce, horticulture, poultry, fish or fish products, no problem. In all the coastal area, you cannot go to the fisherman, you will go to the head fisherman. Head fisherman will collect fish from everybody and then sell directly. He is actually a middleman. If I make payment to the head fisherman, it is not deemed that I am making payment to normal fisherman. But Nirmala madam said, no problem. If you are making payment to head fisherman, it is deemed that you are making payment to main fisherman. Other fellows came, sir, I am prawn seller. I am octopus seller. I am scuttlefish seller. I am crab seller. Nirmala madam said, okay, don't cry. Fish will include everything. Fish will include octopus. Yes. Fish includes prawn. Yes. As per Nirmala madam. Any payment you can make, no problem. Got it, guys? This is 40A2 and 40A3. 40A2 and 40A3. So come to section 41. After this, we'll go back to that and finish it. Section 41. Deem profit. Deem profit. So 41.1 is there. 41.2 is there. 41.2 is balancing charge, which you have already done. In a single asset method, if an asset is sold as a profit, that will be credited to the P&L account as balancing charge, which you can read later. Scientific research, sale of asset of scientific research also I have already covered in scientific research. With example, you can read. I'll give you time. Recovery of bad debts, I have already told you under 41.4. It should be allowed earlier as bad debts and it should be allowed earlier in the bad debt. So bad debts recovery 41.4 already discussed. And there's a special reserve fund that you already have under 36.18. If you withdraw from that special reserve, then also it is taxable. Any discontinued business under 41.5, suddenly the business is discontinued, 2 years over, suddenly that old money comes back today. It's not a bad debt, but some money was supposed to come and you forgot about it actually, then suddenly it came. It's not a bad debt as such, but it's a, what do you say, like a final payment they had to make, which was due only after 1 year, then suddenly they make the payment, then it will come under 41.5. Any profits from discontinued business, 41.5. All that is fine. But now the main thing is which one? 41.1. Remission or cessation of a trading liability. Remission or cessation of a trading liability. So basically, 41.1 suggests that. Yes, 41.1 suggests that any allowance or a deduction, that is any loss or expenditure under point number A, or a trading liability under point number B. Any allowance or a deduction. What is allowance or a deduction? Any loss or expenditure under point number A, or a trading liability under point number B. Right? So this, whether you receive in the form of cash or any benefit, it will be deemed to be profits and chargeable to income tax in that particular year, right? Any allowance or a deduction. Allowance means what? Loss or expenditure, point number A. Trading liability, point number B, which you receive in the form of cash or any benefit, which will be deemed to be profit and chargeable to income tax in that particular year. Cash or any other form, that is called as recovery, whereas any benefit is called cessation or remission. When you see the example, you will come to know. So this A, loss or expenditure, you will get in the recover in the form of cash. I repeat, loss or expenditure, you will recover in the form of cash. Trading liability, there is a benefit that you will get through cessation or remission. In all other, whatever cases it is, it will be chargeable to tax. How? Recovery of cash, how is it? In 2018, you would have made an entry, expense account 2 lakh, accounts, it's there in the account and already paid, but it was allowed only 1.1 lakh. So what was allowed as for taxation? 1.1 lakh. Suddenly in 2021, you recovered the full 2 lakh back. You recovered the full 2 lakh back. Expense to cash you had made 2 lakh. The assessing officer disallowed 90,000 for whatever reason. So he allowed only 1.1 lakh. But 2 years later, you have completely recovered that 2 lakh. So 2 lakh is taxable or 1.1 lakh is taxable? 1.1 lakh is taxable. Mind you, in 41.1, the dialogue is whatever was allowable and allowed before, if you recover, whatever was allowable and allowed earlier, if it is recovered, what was allowable? 2 lakh. But what was allowed? 1.1 lakh. What is recovered? 2 lakh. But how much is taxable? 1.1 lakh, because 90,000 was never allowed before. So whatever was allowed before, if you are recovering today, that much only is taxable. What was allowed before? 1.1 lakh. How much you are recovering today? 2 lakh. But out of 2 lakh, how much was allowed before? 1.1 lakh. So how much is taxable? 1.1 lakh. Very simple. Cessation or remission. Cessation means what? In 2019, there was an entry, expense account 2 lakh to payable account 2 lakh. Then 2022, you made payable account 2 lakh to P&L account. Basically, that fellow said no need to pay back. So he has ceased, means he has waived off that right. So now it's a payable entry. Now it is reverse. When I'm reversing, is it taxable? Yes. One more example, expense account 2 lakh to payable account 2 lakh. Allowed only was 1.3 lakh. Allowed was 1.3 lakh. In 2022, there was a remission of 1 lakh. Means what? He said only 30,000 you pay. 1 lakh you need not pay. So how much is reversed? 1 lakh. How much is taxable? 1 lakh. Cessation or remission of a trading liability, that is the thing. So as far as cessation or remission is concerned, I have taken into account all the adjustments and I have made this chart. If it is a time barred debt is called LOL. LOL is not laugh out loud. What is LOL? It is law of limitation. In law of limitation, guys, between two people, if there is a contract and you do not recover the money or do not attempt to recover the money, then after 3 years, it will become barred by the law of limitation. If you have already written off the amount before, then it will come under 41.1. Whether unilaterally or not, it will come. If it is not written off, then 41.1 will not come. Why? Because you have not written off in the books. What does 41.1 say? 41.1 say that it should have been allowed before. Allowed means debited to P&L account. If you have not debited to P&L account only, why will you credit to the balance sheet? Why will you credit to the P&L account, right? So if you have written it off, whether unilaterally or not, then only it will be credited to the P&L account. So it should be written off to the accounts. Accounts can be P&L account also, reserves and surplus also. Doesn't matter, right? It should be written off in the accounts, they say. So if purchases to creditors 2 lakh, 2 lakh is there, creditors to P&L account or creditors to reserves and surplus account, I don't care. It is taxable. It should be written off in the accounts, then only it is taxable. It's not written off, not taxable. Waiver of loan. Personal loan I have taken from a friend or a bank. Bank says no need to pay anymore. 41(1) will not come, guys. Since it's a personal loan, I'm not business loan. 56(2)(10) will come. Gift taxation under income from other sources. If it is a business loan, 41(1) will not come because loan is not an allowance or a deduction. 41(1) only covers allowance or a deduction. 41(1) covers allowance or a deduction. Loan given to you is neither an allowance nor a deduction. One company gives a loan to you. Is it an allowance for me or a deduction for me? No. So any allowance or deduction is waived off. This is where I have given a loan. I have given a loan, it's waived off. Then will I credit it to my P&L account? No, because it's not an allowance or a deduction. This one is what? Personal loan. Personal loan. Right? I had got a personal loan. Then that fellow, I did not return it back. They waived it off. Is it income for me? Yes, under 56(2)(10) IFOS. Trading receipt. Any trading receipt that I got from somebody else, it is taxable as benefit. I told you. This watch I gave you, trading receipt it is. Is it nexus to business? Yes. Definitely yes. TV Sundaram Iyengar. Waiver of working capital loan. Salary to cash credit, purchase to cash credit. All this. There is no actually entry for cash credit. I'm just overdrawing. I'm keeping on overdrawing. Salary to cash credit, purchase to cash credit, overdraw happening. Then suddenly the bank will say, okay, no need to pay. Is it an income? Yes, it will become an income. Waiver of term loan. Guys, if they have given me a loan to buy a capital asset and then they said no need to pay that, 41(1) will not come because 41(1) is neither an allowance or a deduction. If waiver of loan is like a subsidy, you have to reduce from the actual cost of the asset under 43(1). This was again held by Steel Authority of India case law. Steel Authority of India case law. Done. So guys, kindly read this one, full one, 41, everything. 41, 1, 2, 3, 4. Till here you read, guys. Come on, start. And then let me know if you have any doubts. Okay, buddies. So moving on, just come to the other part. We'll see later. These small points and all are very easy. Yes. Interest income on bad and doubtful debts. Interest income on bad and doubtful debts. 43D. So what is this? Very simple. Whereby public financial institution, scheduled bank, cooperative bank, deposit taking, NBFC, State Industrial Investment Corporation, State Financial Corporation, public company, all these things. They will recognize interest on bad and doubtful debts as per the guidelines of RBI. And when is it taxable? It is chargeable to tax in the previous year in which it is credited to P&L account or the previous year in which it is actually received, whichever is earlier. Previous year in which it is credited to P&L account or previous year in which actually received, whichever is earlier. So this, if there is any interest received on bad and doubtful debts as per the guidelines of RBI, is chargeable to tax in which year, in which the amount is credited. So this is one thing. So cooperative bank will include primary agricultural credit society and all those things. Now, in this particular thing, there is a housing finance company, which was there. So you see, one amendment has come on 1/4/2025. the clause related to public companies has been omitted. So here, this public company is no longer there because it says National Housing Bank, NHB, they have amended to say that is conferring housing finance company with Reserve Bank of India approval. So when I say public company, that public company will be what? Housing finance company. So there was one company called Diwan Housing Finance Limited, which actually went for insolvency and bankruptcy because there was some fraud in that. So I'm not just that, I'm just saying there are many such public companies which are housing finance companies. Now those housing finance companies are again governed under the National Housing Bank Act of 1987, and separate provisions with respect to NBFCs are already covered under 43D. Therefore, reference to that under this particular section of 43D, because the housing finance companies anyway they're deposit taking NBFC. So all these public companies are now regulated under this anyway. So this point can be removed. That is one small thing. Apart from that, if you are into a trade organization, you would have seen all Jains have an organization called Jain International Trading Organization. Correct? Jain International Trading Organization, it's already there. So that association will come together and do the needful. And the, for example, the Konkani Sangha, that is also an association of Konkanis who obviously are there for a reason. Now they will collect all the information, collect all the data, then they'll take, maybe subscription from certain members, may not take, but ultimately it's for what? It's for specific services to the members. So for all normal general services, for example, if I have a Karnataka State Chartered Accountants Association, that association will only cater to the CAs of Karnataka, and they will provide regular services to the members. But let's say I want to hire a room in the KSCA office. I need to hire a room in the KSCA office. Karnataka State Chartered Accountants Association office, I need to hire a room. In that case, would it be a general service or a specific service? It will be a specific service. So in that case, do I have to take whatever the rental I pay? Is it an income to them? Yes. So any income from specific services to members is taxable under 28(3). Other incomes like interest shall be taxable under income from other sources. Surplus from subscription, mutuality source, it shall be exempt, it says. So if I have any surplus from any subscription to that particular club or association, then it is exempt. But if at any specific service, for example, I want to hire a room to conduct some seminar or a class. Now, when I have to pay rent to that association, for them, is that income? Yes. Because is it specific service as such? Yes. So that is what they are trying to tell. Subscription fee falls short of expenditure. Deficit is allowed as a reduction subject to maximum of 50% of total income before such reduction. If there is absence of income under PGBP, such reduction is allowed from income of other heads. That's what they are trying to tell. So basically, ultimately, subscription fee is not taxable, it's exempt, but if it is falling short of expenditure, then the deficit is allowed as a deduction subject to a maximum 50% of total income before deduction. So if any subscription fee is falling short of the expenditure always, your expenditure is 10 lakhs and your subscription is just 2 lakhs, then the deficit 8 lakh is allowed subject to a maximum of 50% of total income. So whatever the total, this is only subscription fee. Total income, whatever is given, let's say total income is 6 lakh. What is 50%? 3 lakh. So 8 lakh will not be allowed. To the extent of 3 lakh only it will be allowed. That's what they're trying to tell. Very simple. That is regarding this. Moving on, guys, there is one more section which is very important. Let's go there. Important section 43B. Come to this. Expenses allowed only on payment basis. 43B. Expenses allowed only on payment basis. Expenses are allowed only on what? Payment basis. So, okay, guys. So, guys, some expenses now are allowed only and only and only on payment basis. Why? Because what people were doing, they were just putting a payable entry and not paying it to the government or to the concerned person and then still claiming the deduction. For example, interest on any loan or borrowing from bank. They used to just make an entry, interest expense to interest payable account. That's it. Interest payable to bank never happened. That's why they said that now I will add such a manner that those certain expenses which are allowed as a reduction will only be done when the payment is actually made within the due date of filing the return under 139(1). What are those? All these things. All these points are there. So in that, let us see. These are the things, guys. It could be any tax, duty, cess, any fee, any of those things. As far as tax is concerned, as we discussed, guys, income tax is not at all covered in this because as discussed under 40A2, Income Tax Act, 40A2, it is disallowed. 43B is not at all applicable to income tax because as per 40 small a small 2, the entire thing is disallowed. So Income Tax Act will not come. Sales tax will come. Sales tax will come under 43B. What is the example of 43B? Sales tax. Third one, interest on sales tax. When sales tax is only allowed, interest on sales tax also will be covered under 43B and not 37(1) only. It is covered under 43B. This is the decision as per Mewar Motors. Apart from that, what about GST? GST also will be allowed only on payment basis. If you pay it within the due date, allowed. Otherwise, no. GST is covered under 43B again. Then, municipal taxes. Yes, municipal tax also is covered under tax under clause number A. Okay. Then when I say about duty, when I ask about duty, excise duty also is covered under clause number A. Any excise duty paid, all that will be covered under clause number A. As far as cess is concerned, will secondary and higher education cess, if you do not pay it within the due date, will it be covered under 43B? No. Cess here does not include secondary and higher education cess because secondary and higher education cess is actually included as part of income tax only. Income tax will include cess, surcharge, everything we know. So this cess will not be secondary and higher education cess. This one of the examples of this cess here, where which is to be allowed only on payment basis, is called, for example, R&D Cess Act. There is something called as Research and Development Cess Act, where when you are doing R&D, research and development, you have to pay a cess. Some 10% cess you need to pay on all the expenses that you are incurring on research. So that cess is covered. Just an example. Apart from that, it says fee. Any statutory fee will be covered. Any other fee will not be covered. Any statutory fee, for example, ROC fees, all these things will be covered under 43B. What about license fee? License fee to renew the bottling plant. I have a bottling plant where I have my own distillery. So then for bottling, I have to take a license. License fee I pay. Will it be covered under 43B? No. This fee is predominantly a statutory fee and it will not incur any license fee, etc. License fee cannot be called as a statutory fee. License fee is because you need a license, you need to pay a fee. Statutory fee will be all these ROC payment, income tax department payments, those fees. Fees for 234EF, those fees is what they are trying to tell. As far as GST is concerned, GST can be given separately or GST can be given together. So guys, if generally as per the law, GST should be done separately like this. Bank account 2,36,000 to sales 2,36,000, GST expense 36,000 to GST payable. Or should it be like all inclusive? Here also, if you see, it is inclusive. It is not GST, I mean, it is not bank account 2 lakh, GST payable 36,000. It's not like that. It's always included like this. It's always included. It's not generally bank account 2 lakh 36,000, 2 sales 2 lakh, 2 GST payable 36. It's not like that. So as per method of accounting 145 capital A, income tax department wants you to do everything bulk. Means what? Bank account 2 lakh 36, 2 sales 2 lakh 36 it should be. And from then I will carve out what? GST expenses to GST payable 36, 36. That is what I am trying to tell. So because of that only they are saying when you make the payment of GST payable, since you have taken it into account as a GST expense here, 36,000, it is not this entry, it is not bank to this thing, it is this one. This is the expense which is allowable. See the wordings under 43B, certain expenses are allowed as a deduction. How will GST be allowed as a deduction? GST will be allowed as a deduction only because entry will be like this in tax purposes. For tax purposes, it's always all inclusive. Bank account 2 lakh 36 to sales. In GST expense 36 to GST payable. That's what you should look at it. Okay? Yes. Next. You see, tax, duty, cess or fee. All these 4 things we discussed. Regarding funding, we'll come to that. Next, bonus or commission to employees, we have seen. You see this interest on loan to borrowing. Interest on loan on borrowing. Loan from PFI, loan from SFC, that is State Financial Corporation, loan from your, State Industrial Investment Corporation. All these things is clause D. Interest from scheduled bank, clause E. Interest from cooperative bank, excluding the agricultural and society, clause E. Deposit taking NBFC. Then SI means systematically important non-deposit taking NBFC. So what is systematically important? Whereby total assets is greater than or equal to 500 crore. That is called systematically important non-deposit taking NBFC. The total assets is greater than or equal to 500 CR as per the latest audited balance sheet. Deposit taking NBFC, systematically important non-deposit taking NBFC. Total asset greater than or equal to 500 crore as per the latest audited balance sheet. So all these things, guys, interest on borrowing on all these borrowings will always be on payment basis. But I already told you, interest taken from your best friend, interest on loan taken from your friend, interest on loan taken from some random person, all these things is not on payment basis, it's always on accrual basis because they don't care about it. They know that anyway that person will recover the funds the way he wants to recover. It is only for other cases where banks etc. are involved, only for those cases. Now an important question they asked was, if there is an interest, I'm converting it to a loan. Possible. There is a lot of interest outstanding. Loan is 1 crore, interest is 20 lakhs. I'm unable to pay the interest. So they are saying I'll go and beg for restructuring of loan. Can they restructure that interest into a loan? Yes. So if an interest is converted into a loan, payment on the date of conversion, as per the High Court judgment. Correct? So when I say payment, when I say make the payment, on what date? Is it on the date of conversion? So High Court said that, yes, even interest. So what did they say, guys? If I'm converting interest into the loan, that only is deemed to be payment, is what High Court said. Crazy. Payment means what? It should be paid to the bank. But they're saying if I convert interest into loan, that is only deemed to be payment. High Court said. To overthrow the High Court judgment, they added explanation 3C, 3D and 3CA. And they said, if you convert interest into a loan, that conversion is not deemed to be payment. That conversion is not deemed to be payment. To escape this, they are very, very smart. Interest, instead of being converted into a loan, they converted interest into debenture. What did you say? You cannot convert to loan. I don't want to convert to loan. What did I do? Convert to debenture. Can I convert to debenture? No. Interest converted to debenture also. Interest converted to debenture also was covered under Finance Act 22 3C 3D3. So guys, any interest which is due, which is still liable to be paid, cannot be converted to debenture or loan. Even if you convert, it is still not deemed to be payment. You actually have to make the payment. So whenever you make payment of that EMI, whenever you make payment of that EMI, that is the day when they say, okay, it is not. That is the day when they say that yes, you have made the payment. Until then, there is no payment. On the other hand, guys, if I convert share capital into loan, if I convert share capital into loan, then they say the date you convert, that only is the payment. Nothing can be done. This is only applicable to what? Conversion into. This is only applicable into what? Conversion into interest into loan. Conversion of interest into debentures. Interest into loan and interest into debentures. Now, let's do a master chart on employer's contribution to gratuity fund. Employer's contribution to gratuity fund. So, if I make a contribution to the recognized gratuity fund or approved gratuity fund, we already saw in 3615 read with 43B, it is only and only on payment basis. If you see this also, 43B here it says provident fund. It will be allowed under 3615 only if it is paid before the due date as per 43B. I repeat, it is allowed under 3615 only if it is paid as per 43B. If it is not paid after 43 as per 43B, it will not be allowed. As simple as that. It will be allowed under 3615 only if it is paid as per 43B. Simple as that. On the other hand, if let's say I'm making a payment of more than 20 lakh to an employee from the recognized provident fund. I'm making a payment of more than 20 lakh to an employee from recognized provident fund. Recognized gratuity fund, sorry. Recognized gratuity fund. So in that be the case. Why more than 20 lakh guys? Because up to 20 lakh recognized gratuity fund, it's exempt. If I'm making a payment of more than 20 lakh to an employee from recognized gratuity fund, maximum 20 lakh is anyway exempt. If I'm making a payment of more than 20 lakh to what? Recognized gratuity fund. If TDS has been deducted, if TDS is deducted, what to do? Not deducted, what to do? If it is not deducted, then obviously disallowed. Disallowed. We have seen disallowance in 40A4. Any employee, if you have not deducted the payment, TDS, while making payment, this is the fund is making payment to employee, right? So, deductible, yes. Have you deducted? No. So, is it allowed or disallowed? Disallowed. On the other hand, if for TDS has been deducted, when TDS you actually gone ahead and deducted TDS, then as per 40A4, that expense will be allowed, and as long as you deduct and pay it on time. If you don't deduct or pay it on time, then 30% will be disallowed. If you don't deduct and pay on time, then what is disallowed? 30% will be disallowed. So, section 43B will not come because TDS is not an expense. I again keep on repeating, certain expenses are allowed as a deduction only when payment is made. TDS is not an expense. Hence, TDS will never come under 43B. I hope you understood. These are all hidden points. So, these are all the things they can ask in the exam in whichever way possible. Provision made for gratuity under an unapproved fund. As discussed guys, unapproved fund is always disallowed. No questions asked. 43B will not come. 43B will come only when it is an approved fund. Provision made for gratuity for becoming payable in the previous year. So what is this? One is unapproved fund, anyway not applicable. This is provision made for gratuity, but which is becoming payable in the previous year. Means what? This is not some random fund that you are creating. This is genuinely people are retiring. So I have to genuinely pay them money. So when that is paying, I am paying money. It is allowed on accrual basis. It is not on payment basis, because 40A 7B says no disallowance. And if you see here, my dear friends, if you see here, it just, you see, it just says contribution to any provident fund, superannuation or gratuity fund. I am not giving any fund. I am not depositing it to a separate fund. I am just saying provision for gratuity for those who are retiring this year. Is it a fund? No. I hope you understood. If I make any provision to a gratuity fund, that will be only on payment basis. But if I set aside the gratuity to be paid to somebody this year who is actually retiring, it is allowed on accrual basis, not payment basis. 43B payment, it's not applicable as it's only a journal entry and it is not a contribution to a fund. These are all hidden points, guys. In examination, they'll give you. You need to understand that. Or if I am setting up and forming or contributing to unapproved GF. Guys, GF is not girlfriend. Sir, we are CA students. You only have 6 girlfriends, boyfriends. FR, AFM, taxation. Yeah, that's all. And the 6th girlfriend is open book girlfriend. Paper 6 IBS, right? Very interesting subject. Right. So, I'm very happy to take that. It's very nice. Setting up, formation, contribution to what? Unapproved GF, no. The only GF we know is what? Gratuity fund. Valentine's Day already over. Yes. So, 40A9, 40A7 disallowed. Because this will unapproved provision will not come only. See, very clearly given here. Contribution to any provident, superannuation or gratuity. Any cannot be read as unapproved also. Any will be approved. Because you have already seen in 40A series that anything which is unapproved will be disallowed. Which means this any should be read as approved only. Hope you understood. We will not come. So, provident fund and other welfare funds, employer contribution. If it is a recognized provident fund, as discussed, 3614, 43B payment basis will come. Payment of PF to employee for less than 5 years. Guys, less than 5 years if you make the payment, then that PF will not be exempt. PF will be taxable. If you make a payment to an employee for more than 5 years in business, is already in business for already an employee for more than 5 years, then it is exempt. If it is less than 5 years, TDS if it is deducted, then it is same as point number 8. TDS is not deducted, then 40A4 disallowed because 43B will not come. We have already seen. And if I give it to recognized pension scheme, as already discussed, less than or equal to 10% of salary, and from 1/4/2025 it has become 14% of salary. 14% is an amendment. So if I have deposit to a recognized pension scheme referred to in 80CCD, it is less than or equal to 10% of salary. It has now become 14% of salary from 3614A read with 43B. If it is greater than 10%, then it is 14% again. Greater than 14% now, greater than 14%, excess will be disallowed. So up to 14%, no problem, it is allowed. Up to 14%, it is fully allowed, no issues. This one. Now, employees' contribution is an expense. If it will be allowed. If it is credited to the fund on or before the due date. Employees' contribution. So guys, employees' contribution is always taken as an income. See, when an employee is contributing, in my account it's taken as an income and given as an expense also. If the employer is contributing, it's an expense. When employee is contributing, I'll first take it as an income and then take it as an expense. Then only it will be nullified, no? Because I'm just removing from his salary and paying. When I'm removing from his salary, it's an expense. If his salary is 10 lakh, which includes 1 lakh contribution to PF or whatever, I will show 9 lakh salary, 1 lakh salary. So ultimately 10 lakh I've debited. But this 1 lakh is not coming to me. No, it's not my income. It's not my expense. It is, I'm depositing to whom? I'm depositing it to the government. So that's why I will also take it as income 1 lakh. Income 1 lakh, expense 1 lakh. Or rather, if salary is 10 lakh, if I am showing one more expense of 1 lakh, income of 1 lakh, nil nil. So ultimately, what is my salary? 10 lakh. So here they are saying employees' contribution will be taken as income under 224.10. Expense, will it be allowed? Yes, expense also will be allowed under 36(1)(5)(a). If credited to the fund on or before the due date. If credited to the fund on or before the due date. Which due date here? Is it due date of filing the return or is it due date as per the relevant laws? Courts always told it is due date as per the return of income. But in Finance Act 21, there's an amendment which came which said it should be due date of as per the relevant laws. Payment will be what, guys? Due date as per the relevant laws. So yes, that is the law that we need to see. That is regarding that. So then there is one very important thing here. Loans or advances from scheduled bank are not covered. Yes. Leave encashment. Yes. See, any sum payable to Indian Railways for use of railway assets only on payment basis 43B. Railway asset. I'm using the railway platform to set up my shop. I'm paying rent to railways. It is allowed only on payment basis under 43B. Then, important amendment is this one. Any sum payable by the SSC, which page number I am doing? We are doing page number B63. Any sum payable by the SSC to a micro or small enterprise beyond the time limit specified in section 15 of the MSME Act. Not due date. Due date will be mostly return of income date. But due date here, due date under employees contribution is not return of income date. Due date under employees contribution is their respective due date as per the law. There is one more due date, MSME Act due date. MSME Act due date. So let's see the MSME amendment. Micro, small, medium enterprise. Micro enterprise is what? Where your investment in the plant and machinery is less than or equal to 1 crore and turnover is less than or equal to 5 crore. You just remember one. Investment in plant and machinery 1 crore. Turnover 5 crore. Multiply into 10. Small enterprise. Investment in plant and machinery 10 crore. Turnover 5 into 10 50 crore. Then you multiply into 5. Medium enterprise. Plant and machinery 10 into 5 50 crore. Turnover 50 into 5 250 crore. Medium enterprise 43B will not come. MSME provision is only for micro and small enterprise. Second point of the story, MSME will be the supplier. MSME is supplying goods to me. I need to make payment to them. So SSE will be the buyer. MSME will be the supplier. This is payment made to MSME, not payment made by MSME. So buyer and SSE to make payment not within the due date of filing the return, but it is under section 15 of the MSME Act. Section 15 of the MSME Act. What does MSME Act say? If agreement is silent about the due date, if agreement is silent about the due date, we don't know what due date it is. There's no agreement. Then it says within 15 days of acceptance of goods, you need to make the payment. The MSME Act does not talk about when you have to make the payment. Agreement is silent. Due date we don't know. So when will you do? Within 15 days of acceptance of the goods. Second one, agreement is present and it has a due date written. Agreement is present and it has a due date written. That is called as the appointed date. Appointed date cannot be more than 45 days from the date that you accepted. Maximum will be 45 days. I repeat, agreement is silent about the due date, then you should take 15 days. If agreement is there, it has a due date also, you should take the appointed date. But the appointed date cannot be more than 45 days. The appointed date cannot be more than 45 days. Even if MSME provisions are contravened, and there is default in payment on due date as per MSME Act also, if you make the payment before the previous year, that is 31st March 2025, then expense will be allowed. For example, for the previous year 24-25, 31/3/25 is the end of the financial year. On 1st October 2024, I received the goods. As per agreement, I had to make the payment before 30th October. You see here, is agreement there? Yes. Appointed date. You should make the payment on appointed date. That appointed date cannot be more than 45 days. So if I enter into an agreement today on 1st February, for example, it cannot be 1st April, 1st May, like that. It should be maximum 45 days. That appointed date also, where I should get payment, should be not more than 45 days. So here you see, 1st October I received the goods. Agreement says 30th October. Is it within 30 days? Is it within 45 days? Yes. But I didn't make the payment on 30th October. I made the payment on 14th February 2025. Even though I have contravened the MSME Act, since I have made the payment in before the financial year ends, before 31st March 2025, before the financial year ends, I have made the payment before the financial year ends. So what happens? It is allowed in the year 24-25. It is allowed in the year 24-25. That's the logic. This you can see later, case study, no problem. Not even now, when I tell you to, you can do it later, no issues. But till here, whenever I give you time, you can study till here. But before that, let's see this example here. Date of receipt of goods, 1/1/2024. Credit terms written in the term only, 30 days. Date of payment, 25/1/24. Is it within the payment due date? Yes. Is it a delayed payment? No. Year in which the deduction can be claimed, 23-24 only, because it's no delay. Date of receipt of goods, 1/1/24. Credit terms 30. You paid on 25/2/24. Is it a delay? Yes. But has it been paid in the same financial year? Yes. So when can you claim? Same financial year. Third one, 1/1/24. Credit terms, no written agreement. As per the law, it should be done 15 days. You have not done. You have paid only on 20th February. Is there a delay? Yes. By 45 days, there's a delay. By 50 days, there's a delay. But is it still allowed? Yes. Why? Because it was paid in the same financial year. 1/3/24, 45 days payment. And they paid on 5/4/24. They paid exactly 45 days. Have I delayed the payment? No. No delay. Fully allowed. 1/3/2024, 45 days is the time given, but you have paid 50 days later, 20th April. Is there a delay? Yes. Which year will it be allowable? Next year, because it was paid in the next financial year. Paid in the next financial year. Next one. 60 days is the time limit. Can I give 60 days? No. As per MSMED Act, maximum 45 days I can give. Even though I have paid it 50 days, within 50 days, I have followed the credit terms of the company, but it is outside the purview of MSMED Act. Because as per MSMED Act, maximum you can give only 45 days. Is it paid in this year or next year? Next year. So it's allowed in the next year. No written agreement. You should do maximum 15 days, but you still pay 20 days later. Have I broken MSMED Act? Yes. But is it paid in the same financial year? Yes. So allowed. 1324, no written agreement. I paid it on 1424. Have I broken the MSMED Act? Yes. But 1324 I should have paid before 31st March 24. I paid on 1424. Hence, it is paid in the next year. Please read this entire thing. So, my dear friends, the next part of the story is after 43B is over. What is the next part of the story? Come to page B73. Maintenance of books of accounts by certain persons carrying on business or profession. 44AA. So, we have 44AA and then we have the tax audit. 44AB. 44AA and tax audit of 44AB. Let's do 44AA. Specified person or profession. Anybody who's having a specified profession or anybody who is a specified person. The entire list is given in this particular B73. This is a specified SSE profession. Medical, legal, film artist, accountancy, engineering, technical consultancy, company secretary, architecture, interior decorator. All these people are carrying out a specified profession. Carrying out a specified profession. So, and then, what are the specified books? Cash book, ledger, journal, copies of bills amounting to exceeding 25 rupees, guys. If you buy a goli bhaji and coffee for 30 rupees, no bill needed, but copy of bill needed. If you buy one Gadbad ice cream from Pabas, then original bill needed. So stupid. What is 50 rupees, guys, now? They're still maintaining the same thing. Anyway, so you have to maintain the specified books when, if your gross receipts is more than 1,50,000 in each of the 3 preceding financial year. So it is immaterial. 1,50,000 is hardly anything. Even a daily wage laborer will earn more than this. Daily wage laborer will earn 300, 400 rupees per day. So 12,000 rupees he earns anyway. So he will earn per annum 2,40,000 easily. So when daily wage laborers only earn so much, what is this 1,50,000 every year? Obviously I'll earn no. Gross receipt, that too, not even profit. So all these fellows anyway have to maintain books of accounts. It's some old law, still continuing, nothing can be done. On the other hand, non-specified business means other than these fellows. If you are an individual or HF, for an individual you should earn more than 2.5 lakh rupees. If or income or gross receipts or turnover 25 lakh rupees. Income should be how much? 2,50,000. Income means after all the expense and all, whatever income left, that should be how much? 2,50,000. Or gross receipts must be how much? 25 lakh. In at least 1 out of the 3 years, then you have to maintain books of accounts for individual HF. Others, company, AOP, BOI, LLP, firm, income must be more than 1,20,000 or gross receipts or turnover should be more than 10 lakh rupees in at least 1 out of the 3 preceding previous years. In at least 1 out of the 3 preceding previous years. And that's about it. Books of accounts have to be maintained. If books have to be maintained for these figures, do you have to pay tax also? We have 44 AB. If you are doing business, if your turnover is more than 1 CR, you will have to get your accounts audited. 44 AB business, your turnover is more than 1 CR. Should you get tax audit? Yes. You are doing a profession, your gross assets is more than 50 lakh. Do you have to get tax audit? Yes. But this 1 CR of business, turnover 1 CR, limit can be increased to 10 CR. This limit of 1 CR can be increased to 10 CR if two conditions are satisfied. What are the two conditions? Cash receipts must be less than or equal to 5% of the total receipts, and cash payment must be less than or equal to 5% of total payment. If both the conditions are satisfied, then 1 crore limit will not apply. 10 crore limit will apply. That's about it. Sir, give me an example of that, sir. Sure. See here, this example. Page B76. First one. Rana sales in cash through other modes. Through other modes, his turnover is 7 CR. Purchase in cash nothing, through other modes 6 CR. Is the gross sales exceeding 1 crore? Yes. Does it exceed 10 crore? No. So this 1 crore above will apply if your cash receipts and cash sales is more than 5%. Have you done any cash receipts and cash sales? No. So the limit is increased to 10 crore or 1 crore? 10 crore. Hence, in the first case, Rana's case, no tax audit. Why? You don't have cash receipts, you don't have cash payments. Second one, 45 lakh, 45 lakh, 90 lakh. Is it going beyond 1 crore? No. So obviously no tax audit. It's not covered under only 44 AB. I don't care how much cash dealing you are doing if it is less than 1 crore. Cash dealing of 5% will only come if it is more than 1 CR, less than 10 CR. I repeat, you should see the cash receipt and you should see the cash payment, that 5% rule, only if the turnover is greater than 1 CR, less than 10 CR. If the turnover is less than 1 CR or the turnover is more than 10 CR, this point is immaterial to our discussion. If it is less than 1 CR, tax audit will never apply. Turnover is more than 10 CR, then I don't have to see any of this nonsense. Tax audit will apply. For example, you see Ashka. Ashka, I don't even have to see this percentage because her turnover only is 12.5 crore plus 1.25, 13.75 crore is her turnover. Why will I even bother seeing 5%? 100% tax audit applicable. Not applicable, not applicable. Third one you see, Rahul. 1 crore plus 1.2 crore. 2.2 crore. And here 1.3 crore. Sales is 2.2 crore. Purchases is 1.3 crore. But I have to see the percentage of cash in the total sales. So 1 crore divided by 2.2 crore is almost 45%. So definitely tax audit, this limit will not be increased to 10 crore. Limit will be 1 crore only. Tax audit will applicable. here, even though this will be less than 5%, 5 lakh divided by 1.3 crore is less than 5%, but it doesn't matter. Both the conditions must be satisfied. I hope you are understanding. Amit, Amit is how much? 5 lakh divided by 2.3 crore, definitely less than 5%. Whereas here you see, unfortunately, 50 lakh divided by 1.7 crore, definitely more than 5%. Hence, tax audit will apply. Babu, 5 lakh divided by 4.3 crore, less than 5%. 6 lakh divided by 4.06 crore, less than 5%. Hence, here the limit will be increased to 10 crore. Only in Babu case, no tax audit. Hope you got the point. So guys, in the same 44 ADAB, interesting to note that if you have opted for presumptive taxation, then provisions of 44 AB will not apply. Presumptive taxation under 44 AD or 44 ADA. Presumptive taxation under 44 AD or 44 ADA, if you have opted for, then provisions of section 44 AB will not come. As simple as that. So now we have to see the presumptive taxation part. Small businesses 44 AD. Then we have specified profession 44 ADA. Then business of plying, hiring or leasing goods carriages 44 AE. And then we have other things. Shipping business 44B. Then 44 BBC, which is a new section for Finance Act 24. That is non-resident engaged in operation of cruise ships. Then 44 BBA, profit and gains from business of operation of aircraft, BBA. Then we have profit and gains of business of supplying services or facilities or hiring used in mineral oil, 44 BB. Then triple B, civil construction, triple B. Little bit of amendments there. That's about it. Then the film thing is different, that you leave. Then there are important cases, very simple, that you can go through later. So, presumptive taxation. Yes, guys, presumptive taxation. So what do you mean by presumptive taxation? What do you mean by presumptive taxation? Presumptive taxation means that in case you are earning some amount which is below the threshold limit, below the threshold if you are earning, Nirmala madam says you don't have to maintain books of accounts, you don't have to do tax audit, nothing. I will give you a figure. You just take that amount as the what? Final figure. For example, final figure of income. So I'm just giving you an example. She is telling if you're earning, let's say 1 crore, just an example. If you're earning 1 crore, you have to maintain books of accounts, you have to show me all the documents, you have to prepare tax audit, all those things. Ultimately, you will tell, okay, my income is 8 lakhs, my income is 15 lakhs, whatever. Nirmala madam is telling, I will only tell you what your tax should be. I will only tell you what your income should be. If you are earning so and so amount, 1 crore, 2 crore, 3 crore, whatever, I will tell 6% should be your income. Not 6% tax. 6% should be your income. On that you will pay tax 30%. I will tell 6% should be your income. I will say 8% should be your income. I will say 20% should be your income. And guys, this is minimum 6%. Sir, I want to show more than 6%. Be my guest. Sir, I want to show more than 8%, be my guest. Sir, I want to show less than 6%, then prove. Prepare the books of accounts, show me the documents, tax audit if needed, go for it. I am telling you, minimum amount you should give something. Above it, if you are giving, good only. Less than minimum amount, not allowed. You will have to pay, you will have to maintain all the documents. So check it out. 4480 amended by Finance Act 2023. Eligible SSE. Guys, it's only individual HF and partnership firm. LLP is not covered. And you have to be a resident. You have to be a resident. Eligible business will be all businesses except plying goods carriage, 44AE. Professional services, because that's covered under 44ADA. Commission or brokerage, agency services. If you have already availed exemption under 10AA, 80IA, 80RRB, it will not come. SEZ deductions basically. Then percentage of PGBP. That is, what percent of PGBP will be deemed income? If you have received all the money through account pay, check, account pay, bank draft, ECS, etc. On or before the due date, you have received all these things. Then 6% of gross receipts or turnover will be deemed to be your income. If received other than that, then 8% will be your income. Guys, if you have received through cash, then the income will be 8%. If you have received through bank, income will be 6%. 6% will be deemed to be the income, minimum profit. You can show higher also. If it is less than 6% or 8%, what should you do? You should maintain the accounts and you should do a tax audit. Turnover or gross receipts should not be plying of goods carriage under 44A, obviously, because that's covered in a separate section. And guys, here they have told now. What should be the turnover limit? If less than or equal to 5% of gross receipts or turnover is in cash, and the limit is 3 crore. If more than 5% of the gross receipts or turnover is in cash, then it is 2 crore. So guys, you can go for presumptive taxation only if your income is 2 crore, assuming you are taking more than 5% in cash. If you are not taking more than 5% in cash, just like your tax audit where they have increased from 1 crore to 10 crore, here they have increased from 2 crore to 3 crore. 2 crore to 3 crore. Example you see. See, out of 3 crore, 1 lakh was in cash. Tell me, will 2 crore apply or 1 crore apply? 2 crore will apply because 1 lakh divided by 3 crore is less than 5%. Since it is less than 5% of turnover or gross receipts, limit will be 3 crore. In that 3 crore, 2.99 crore was obviously issued through bank. 1 lakh was received in cash. We just discussed that. So, this will be the deemed profit. For 2.99 crore, 6% will be the deemed profit. For 1 lakh, 8% will be the deemed profit. So for 2.99 crore, 6% is what? 17 lakh 94,000 will be the deemed profit. And for 1 lakh, 8% will be the deemed profit, 8,000 rupees. So out of 3 crore, 1 lakh was in cash. Since it is less than 5% of turnover or gross receipts, the limit will be 3 crore. For 2.99 crore, 6% will be the profit. That is how much? 17 lakh 94,000. And for 1 lakh, 8% will be the deemed profit, that is 8,000 rupees. Now in the above example, if cash received was 20 lakh, mind you, if cash received is 20 lakh, then out of 3 crore, 20 lakh cash means it comes up to 6.67%. So the limit will be 3 crore or limit will be 2 crore? Limit will be 2 crore, but I have already earned 3 crore. So presumptive taxation will not apply. 44 AD will not apply. Will tax audit apply? Tax audit, what is the scene? 1 crore limit or 10 crore limit? I should take, again depends. If the cash receipts is more than 5%, then 10 crore limit also will not apply. So here guys, 10 crore limit will not apply, 1 crore limit will apply. Hence, tax audit also will apply, 44AB. Similarly, 44AA also will apply. What is 44AA? Maintenance of accounts. If you do not follow 44AD, you have to follow accounts also, audit also. No choice. You have to follow what? Accounts also and audit also. Understood? That is the entire scheme. 44AD. Next, 44ADA. 44ADA is what? Profession. Eligible SSC, professional under 44A. Eligible profession, same thing as the artist, architect, accountant, etc. Here, it is not 6%, 8%. 50% of the gross assets is deemed to be income. 50% of the gross assets is deemed to be income. You can show higher also if you want. Right now, gross receipts, Finance Act 23. If greater than 5% of gross receipts is in cash, 50 lakh. If less than or equal to 5% of gross assets is in cash, then 75 lakh is the limit. 75 lakh will be the limit. Then there are certain points here. If you have page number 7B79, if your SSE has declared as per 44AD for any given previous year, for the next 5 consecutive assessment years, he has to follow the same. But for in the 5 consecutive assessment year, 1 year if you do not follow 44AD, then you cannot claim this benefit for 5 years. Basically, they are trying to tell if you are claiming the benefit, do continuously for 5 years. 1 year I will see what is better, next year what is better, no. And guys, when you opt for this section, 30 to 38 will not apply because this section overrides everything. So depreciation you will not get, 35 AD you will not get, 35 scientific research deduction you will not get. Everything is already included. So you need to see whether the claiming that all those things will make sense or not claiming will make sense. And then you should choose. So that's why 1 year if I am choosing this thing, what do you say, this provision, next year I cannot not choose. I have to choose it for 5 years. If I don't choose it for 5 years, 1 year if I break the law, 5 years I am not eligible. And then I have to maintain books of accounts, get them audited also, deadly. Same with 44 ADA also. That is about the presumptive taxation of these two sections, my dear friends. So after doing 44 AD and ADA, we will be now discussing 44 AE, business of plying, hiring or leasing goods carriages. Business of plying, hiring or leasing goods carriages. So basically for every goods carriage, it is very important to know that you should own maximum 10 goods carriage only. If you own more than 10 goods carriage, you cannot opt for this presumptive taxation. So maximum how much can you opt? 10 goods carriage only. So goods carriages maximum 10. And when can you hold this? At any time in the previous year. So you should hold this goods carriage at any time in the previous year. So even if one day you have held 11 goods carriage, then you can obviously, it should be always what? Less than or equal to 10. Not more than 10 at any time. Not more than 10 at any time. So guys, even if you hold 11 goods carriage on one day, I repeat, even if you hold 11 goods carriage on one day in the entire financial year, this section you cannot opt for the same. Okay. So here you need to remember certain things. One is heavy vehicle and one is other vehicle. So for heavy vehicle, what is it? What is heavy vehicle? Gross weight, if it is more than 12 tons. 12 tons is 1 ton is 1000 kg. So if the gross vehicle weight is more than 12,000 kgs, then how much is the income? So they are telling this only is the income. Simple as that. This only is the income. 1000 rupees per ton per vehicle per month. So if there are 10 vehicles, all are heavy vehicles and there are 15,000 kgs. There are 10 vehicles and there are 15,000 kgs. So what will you take? 1000 rupees into 15 by 1000 rupees per ton. So 1000 into 15 into 12. I told you there are 12 vehicles, 20 vehicles, 15 vehicles, whatever it is. So there are 10 vehicles, 15,000 kgs and 1000 rupees per month I should take. So whatever earning that lorry made, that is one part, that is normal provision. But under 44 AE, It is deemed that the income will be 1000 per ton per vehicle per month. So it is 1000 into 15. Why? Because there are 15,000 kgs. How many vehicles? Into 12. How many months? Into 12. So 1000 into 15 into 12 into 12 you have to do. Right? That is called heavy vehicles. Next, other vehicles. Other vehicles is not per ton and all. It is only 7,500 per month or part of the month per vehicle. So even if it's part of the month, even if it is used for one day, let us assume that the vehicle was bought on 29th June. Even though it was bought on 29th June, income should be calculated for the full month. That is the meaning of part of the month. Right? If the vehicle is bought on 29th June, so obviously from the when the vehicle was bought, June. So July, August, September, October, November, December, January, February, March, 9 months, not 9 months, 10 months, even June you should consider. Even though it was used only for one day in the month, you should consider that full 1000 rupees as the income. That is the beauty of 1000 per ton per vehicle per month or part of the month. 7500 per month or part of the month per vehicle. Gross weight more than 12 tons, 10,000 rupees per ton per vehicle per month or part of the month. So, and also one more thing, on 14th October 2022, you owned the vehicle, and 14th March 2023, you put to use the vehicle. So, you will take only March month, or will you take from October? October, November, December, January, February, March. You will take 6 months or you will take 1 month? That's the question. So 14th October 2022, you own the vehicle. 14th March 2023, you put to use the vehicle. So you will obviously put it to use. So you will take only March month or you will take from October? Answer is very simple. Income from October only is considered. Income from October only is considered. So October, November, December, January, February, March, all these months will be considered. Okay, that is what you should understand. Very, very simple. Income from which month is considered? From October only is considered, guys. Got it? That is the thing. This chart you can ignore, guys. 82 chart you ignore. I mean, now it's not relevant as such. You can leave it. No problem. Then, for non-resident and foreign companies, this is very simple. If you are in non-resident, you are engaged in shipping business. This is only specifically for the ones in shipping business. So 7.5% of the amount specified will be deemed to be what? The income. So that will be the PGBP. On that you will have to pay tax. That is, whenever you are coming to India and whatever the amount that I have to pay, that is the freight or whatever it is, the amount paid or payable on an account of carriage of passengers, mail or goods shipped at any port in India. Shipped at any port in India. So basically, all the amounts that you have to pay at any port in India on that 7.5%, and also amount received or deemed to be received in India by the SA on his behalf of account activities carried out by the SA outside India. So basically, even if you go outside India, but you are ferrying passengers from India or goods from India, and there you will go from India to some other place, that anyway you have to take, and from there you will take to some other place. Everything is happening outside India. That also has to be considered. So there is an example here. You can check that. So Mr. Jim is a non-resident and engaged in shipping business. He received 10 crore on goods which were loaded onto a ship from a port in India, of which 4 crore was received in London. You see here, loaded onto a ship from a port in India. Since this entire happened port in India, 10 crore to be taken into account. Was accrued in India. I don't care if 4 crore was received in London, but the entire 10 crore was accrued in India. On the other hand, is also received 4 crore for goods loaded at Miami. Of this, 2 crore was received in India. Whatever happened outside India, it's okay, but how much money was received in India, I should take. So out of the 6 crore which was accrued outside India, only 2 crore will form part of the specified as this was received in India. So first what I should take? 10 crore. Then what I should take? 2 crore. So totally 10 plus 2, 12 crore. 7.5% of 12 crore, 90 lakhs is what I need to take. It's very simple. Yes. So This was only for those into shipping business. What about cruises? Now, if you see, there is a cruise by Disney. Disney cruise is there. Disney cruise starts off, let's say, in Singapore, goes to Malaysia, and let's say it is coming to India. When they are coming to India, obviously they have to pay money and all those things. They will go to Nirmala madam and say, Madam, this you are telling only shipping business. We are not in shipping business. We don't do selling of goods, etc. But we are also in shipping in another way. We are luxury cruises, pleasure cruises. So why don't you offer this to us also? There is confusion with respect to this. Some court cases have told that it's not applicable to luxury cruises. It's only for goods and normal passenger, survey. It's not about the luxury cruises, etc. Cruise operator. Those cruise operator can take many, ships on rent also. They can lease out many things. They can take it on 20-year lease, 30-year lease, whatever the case may be. So, Finance Act 2024 has introduced one more section for that. 44 BBC. This is for normal shipping business. But what about cruise operator? Yes, 20% of the aggregate amount received or receivable to the non-resident cruise ship operator. Yeah, so specifically they have given separately because many people were taking this 7.5% shipping business. Some cases they said it's not applicable. Some cases said it's applicable. Now I said the luxury cruise business, lot of money is involved. So they charge 3x, 4x, 5x and the luxury cruise. So a luxury cruise 7.5% is too less. So what they did, even if you are following 44B, now I have stopped you from following 44B. Because there was a lot of confusion whether it's applicable or not. Whoever was making it applicable, they were taking 7.5%. But Nirmala madam is telling, boss, but in luxury cruises you will mint money. So much money you will mint. Right? Even the Indian cruise only, it's so luxurious. There is a cruise called Cordelia Cruises. So that is only so luxurious. What about foreign cruise then? So basically, see, on account of carriage of passengers, as profits and gains of such cruise ship operator from this business. Payable or paid to what? Non-resident cruise ship operator. Therefore, provisions of section 44B relating to presumptive taxation for shipping business shall therefore no longer apply to cruise ship business. Cruise ship is 44 BBC. Came from 1st April 2025. Guys, whenever the law says with effect from, this is what? With effect from, whenever they say, this is assessment year. Not previous. This is not previous year. It's what? Assessment year. Eligible SSE, non-resident engaged in the operation of cruise ships. PGBP is how much? 20% on the amount specified. Amount specified shall include what? Amount paid or payable to the passengers, received or deemed to be received on behalf of passengers. Same thing. Then I told you, they will also have the lease rental system. So, lease rental paid by company which are for presumptive regime under section 144 BBC. So, this is one part of the story. One more is what? Even if one shipping company leases out to the other shipping company, that rental is also an income, no? One is on behalf of the carriage of passengers. Even if I lease my ship to you, that is also for passengers only. I'm getting 20% on that. So, the lease rental paid by a company which opts for presumptive regime under this section, first company, shall be exempt in the hands of the recipient company. If such company is a foreign company and such recipient company and the first company are subsidiaries of the same holding company. So basically here, what are they saying? One company, that is the first company. Lease rentals paid by a company which opts for presumptive regime under section 144 BBC shall be exempt in the hands of the recipient company. So company A is giving money to company B. lease rental, rental. So this recipient company who is receiving the rental, for them that money will be exempt. If such company is a foreign company and the recipient company and the first company are subsidiary of the same holding company, all of this is like a sister concern. So what happens generally in this cruise line is all are foreign companies, there will be one holding company. That holding company will invest in ships in under one company, that is A, or rather B here, B. B is the person who is going to build the ships. Once they build the ships, they will give the other company lease rental. On lease rental, ship will be transferred from B to A, and A will give the lease rental. They are saying for B, this lease rental is exempt. Now A will use that ship and carry passengers luxury cruise. A will go for presumptive taxation. A will go for presumptive taxation. And how much will they take this presumptive taxation? 20%. On the entire income, 20% will be the profit. This is proposed to be done by insertion of a new clause 15b in section 10. Subsidiary company and holding company have been defined in the explanation to this new clause. Exemption shall be available up to assessment year 2030-2031. Then similarly, guys, if it is in operation of aircraft, again non-resident, Qatar Airways, whatever it is, there is just 5% of the amount specified. Same, it is the same thing from any place in India, but the money is received in India for carrying passengers outside India. Same like shipping business, here it is 5%. So Mr. Sandy, a non-resident, operates an aircraft between Gulf and Chennai, received the following amounts in the course of the business. Rupees 2 crore he received in India on account of carriage of passenger from Chennai, it will come. 1 crore of carriage of passenger received in India, it will come. 3 crores in India on account of carriage of passenger from Gulf. They received 3 crores in India. 1 crore received in the Gulf on account of carriage of passenger from Chennai. Doesn't matter where you receive it. It is happening in India, no? Carriages of passengers from Chennai. This also will come. Total turnover 7 crore, 5% I should take. Right. So, during the Delhi Metro, E. Sridharan was called as the main Delhi Metro guy. E. Sridharan. So when Mr. E. Sridharan was doing the Delhi Metro, there were a lot of issues whereby there was huge boulders, hills, etc. to carve through these hills. It was not possible for them to do it. The machines used in India used to drill like 1 kilometer in 5 days, 1 kilometer in 10 days, is to create a lot of delay. So India reached out to German and Swiss companies whereby I wanted to hire their services to drill. Their machines were so sophisticated, Swiss company, that it used to drill, because in Switzerland it's all mountain region. In Switzerland it was so awesome there that they were doing it at 1 kilometer per day drilling. So when they came, they started earning money and they were very happy about it. There is one part of the story, drilling this thing, there's infrastructure facility. One more is what? That is one part. One more part was again, yeah, see, civil construction. That's what I'm saying. Metro is civil construction. That is one part of the story. Second part of the story is when Reliance went into mining and mining of oil, mineral oil, etc. There were lot of huge machines which are needed to drill the mineral oil. Now this cost of this is millions of dollars. Rather than buying it, because it's only for a few years that I need it, rather than buying these machines, Reliance decided that we'll hire these machines. These are all huge drilling machines where the pipeline will go to the bottom or the sea bed, if I'm mining in the sea, checking for oil in the sea, checking for oil in the land, and then it's like a slurry pipeline, everything will go and then it is get collected everywhere. So basically these machines cost a lot of money. And Reliance at that point of time, today they can buy any company they want. At that point of time when they were starting out, they were like, no, let's not invest in this. Let's rent it out. No, big deal. Let us rent it out was the idea. Now, for those companies, one is that Swiss company that I told you who's into metro, and second one is this company. They were now made to pay tax of 40% that time. Foreign company, their income they are earning in India 40%. They said, okay, boss, if it's 40%, I'll not come only. No problem. I don't want to come. Why should I come from all the way here, do work for you, earn something, and in that something 40% you're taking away? And 60% you're allowing me to take home, and that too after all these other FEMA regulations, RBI regulations, oh, that I have to sit and handle. What is this nonsense? They said, I'll not come. Then this Ambani and all went to finance minister and said, sir, please do something about it. Hence, 44 triple B and 44 BB was added. See, supplying service or facility for hiring plant and machinery used in production of mineral oil. That machinery which sucks out the minerals and oil. Here it is what? Civil construction, E. Sridharan. Turnkey project it is called. Turnkey means what? Everything will be made ready and given to you. Just have to turn the key and start. That's all. So you see, this one. Non-resident engaged in the business of supplying services for prospecting for or extraction of mineral oil. Prospecting for. I don't know whether mineral oil is available or not. I did test. For testing also I need machine, no? 10% of the amount specified. Same thing. Whatever happens in India, even if it happens outside India, along with Reliance, you're doing it outside India, but money is received in India, that also deemed to be received in India. Here also you see, foreign company engaged in the business of civil construction, erection of plants, testing, commission, turnkey projects, 10%. Now for both the things, there has been an amendment in Finance Act 23. Both sections BBB provide that SC may claim lower profits and gains than 10%. If you, so obviously guys, in all this presumptive taxation, minimum will be that percentage. You can make it higher, but if you make it lower, you need to do tax audit also, you need to maintain accounts also. That is a normal provision. If he keeps and maintains such books of accounts and other documents and gets his accounts audited, due to the above provision, taxpayers are able to opt in and opt out of the presumptive taxation scheme in order to avail the benefit. This was happening. What they were doing? 1 year loss, do normal books, show lesser profit. 1 year profit, show 10%. 1 year there was a lot of profit, show 10%. 1 year less than 10%, show normal books. Unlike 44 AD and ADA, which said that it should be there for 5 years, that provision was missing in 44 BB and 44 BBB. In 44 AD and ADA, it said once you opt for it, you should opt for it for 5 years. That dialogue was missing here in BB and BBB. Correct? If SSA is maintaining books of accounts and claiming losses, then he should also disclose profit as per accounts then. They were setting off of losses whenever there was loss, but when they made huge profits, they showed only 10%. So that's why they said instead of maintaining for 5 years, and see these minerals and other things, etc., it won't happen every year. So there is no point in asking you that once you opt for it, you should opt for 5 years. Doesn't make sense. Instead, I can tell you something else. I can tell that 1 year if you opt in, next year if you opt out, and you're opting out, whatever loss you do, you cannot set it off. If I tell like that, then superb, no? So the year there was 40% profit, I am showing 10% profit. The year there is 20 crore loss, I am opting out and showing 20 crore loss. Next year, superbly, when I have 10% profit, I am setting off this point there nicely. When I use presumptive taxation, it overrides the PGBP sections. It doesn't override the set off carry forward sections. That's why amendment in 23 said that with effect from 1/4/24 to provide notwithstanding anything contained in 32(2) and 72(1), unabsorbed depreciation you cannot claim, business loss you cannot claim. Excellent. No set off of unabsorbed depreciation shall be allowed for such previous year. You opt in and opt out, opt in and opt out, I will not give you anything. No benefit given. Good provision. Then the last part is transfer of carbon credits. So it's a form of incentive given. So basically, guys, carbon credit is every single country will have a cap as per the United Nations regulations. You will have a cap. You cannot emit more than certain things. What is that? Greenhouse gases. You cannot emit certain things beyond this. Maximum is some amount. That's it. Let's say you can only emit 10,000 tons of carbon dioxide, which will impact the ozone layer. Now what will I do? I am now, they say that if any country or any company, for example, they do 1,200 tons, the allowance is 1,000 tons. You have done 1,200 tons, deadly. 200 tons extra you have done. So, unfortunately, our carbon footprint has increased by 200 tons. You either have to now, what do you say, do something which will reduce the carbon footprint, means you have to plant more trees, etc. Or that extra 200 that you have overshot, you have to buy, pay money and buy something called as carbon credit. Carbon credit you buy from other companies you buy, other countries you buy. There is a separate stock market for carbon credit also, imagine. So basically this is this credit. If you have done less, you will get a credit. If you have done more, you have to buy a credit. Now, I am a person who has done less. I am a company. For me, whatever is associated, I have done less. I am trading in carbon credits. I was supposed to emit 200, allowed to emit 200. I have emitted only 150. 50 credit I have. Now I am selling that credit. When I am selling that credit, money I am getting. Is it taxable? Yes, 100%. So there is a reduction there. How much? Tax shall be levied at a concessional rate of 10% in respect of income derived from such transfer of certificate. No expenditure shall be allowed. Very simple. So next is with respect to movies. For that movies, I will also show you one small movie. Okay. So generally, I also dabble in animation. So once upon a time, we had made, not once upon a time, it was recent, like a couple of years ago, we had made a video on animation also. Basically, the entire topic that whatever is there in this chart, no, we will just finish it off with one simple video. Okay. Ready to watch a video? It's a very interesting video, guys. So I had made it personally because we have a team where I was tried to analyze this particular thing and give the needful. I'll show you that 1 second. So let us watch taxation of cinema, how it works. There you go.
Hi, as an ardent cinema lover, I always used to wonder how film producers and distributors are taxed. And do they have any special deductions? Do you think there's any difference in taxation if a movie is released in December or if it's released in February? Hello, my dear friends. My name is Punarvas Jayakumar and welcome to my YouTube channel. In this video, let's discuss the taxation of film producers and film distributors. Rule number 9 capital A of the income tax rules empowers this deduction as a revenue expenditure and not as a capital expenditure. So what is the amount of deduction that is allowed? The rules define cost of production as the expenditure incurred on the production of the film, except two things: preparation of the prints of the film and advertisement expenditure. For instance, the movie RRR was made with a budget of 350 crore, excluding salaries to the actors and the director. But adding everything, it came up to almost around 600 crores. If the producers spent 100 crores on preparing the prints and let's say another 100 crores on advertisements, making the total around 800 crores, what is allowed, my dear friends, would be just 600 crores. Now, if SS Rajamouli was presented a Volvo car worth 80 lakhs from the producers, would it be allowed as an expenditure? Courts have held that remuneration paid in kind to the actors or such other members involved in the film shall also be included while computing the total cost of production. So, yes, that would be allowed. So, if a producer sells all the rights of exhibition of the film in the previous year, the entire cost of production would be available as a deduction. An important point is it doesn't matter when the movie was released. So, if the rights of the movie KGF 2 was sold in the year 2020 2021, but the movie was released in 2022, deduction will be allowed in 2021 if the producer sells all the rights of exhibition of the film in 2021. The same provision applies even to a film distributor. Here, cost of production is substituted by cost of acquisition. So, the producers can claim 600 crores and the acquirer, for example, Netflix, can claim the cost of acquisition as the reduction. In RRR's case, as per the reports, it was around 250 crores. But what happens if the producer himself exhibits the film in some of the areas and sells the rights of exhibition of the film in some other areas? For instance, for the movie Bahubali, the producers took up the distribution themselves in southern India, whereas for the other parts of our country and overseas as well, distribution was given to Karan Johar's Dharma Productions. Here, the provisions are slightly different. If the film is released for exhibition on a commercial basis at least 90 days before the end of the relevant previous year, the entire cost of production of the film shall be allowed as deduction in computing the profits and gains of such previous year. However, if it is released within 90 days before the end of the previous year, then the quantum of deduction would be cost of production or amount realized by exhibiting the film and sale of rights of exhibition, whichever is lesser. Hence, in this case, the quantum of deduction will vary if the film is released on or before 1st January and of the films that have been released after 1st January. Who? Seems difficult. Let's take a couple of examples, my dear friends, to understand. KGF 2 released on 14th April 2022. The relevant previous year for this would be 22-23. The film's budget was around 100 crores, but it crossed over 1,200 crores worldwide. So now, if the producer had sold all the rights of the film in the previous year, that is 22-23, then the entire 100 crore is allowed as a deduction. Even if the producer had exhibited the film in some areas and sold the rights of the film in some other areas, the entire cost of production of 100 crore would be allowed as a deduction since the film was released at least 90 days before the end of the relevant previous year, that is before 31st March 2023. On the other hand, RRR was released on 24th March 2022. Relevant previous year would be 21-22. If the producer had sold all the rights of the film in the previous year, that is 21-22, then the entire 600 crores is allowed as a deduction. But if the producer had exhibited the film in some areas and sold the rights of the film in some other areas, then deduction would be as under. Cost of production, in this case 600 crore. 2. Amount realized by the sale of tickets and sale of rights till 31st March 2022. In this case, as per the official statistics, it was around 477.5 crore in 8 days, whichever is less. 600 or 477.5, whichever is less. Hence, 477.5 crores is allowed as a deduction. So, the producers of RRR would offer 477.5 crores, that is the collection, minus 477.5 crores, that is the deduction, that is nil, as their income from PGBP. What would happen, you may ask, to the difference of 600 minus 477.5, that is 112.5 crores? That, my dear friends, would be allowed in the year 22-23. Similarly, Pushpa movie was made on a budget of 170 crores and grossed over 360 crores worldwide. The entire 170 crore would be allowed as a deduction in the year 21-22, since the movie was released on 17th December 2021, which is before 1st January 2022. I hope you understood this concept now. Let us discuss quickly three other very interesting questions. Question number 1. The movie Time Machine, centered around time travel, starring Amir Khan and helmed by ace director Shekhar Kapoor, who incidentally is a chartered accountant, was filmed almost 100% but was abandoned towards the end. Now, assuming the cost of production for this movie was around, let's say, 100 crore, would this be allowed as a deduction under Rule 9A? There were a lot of controversy over the tax treatment of similar such abandoned movies. The CBDT released a circular settling this issue. They clarified that the cost of production of an abandoned movie is a revenue expenditure allowable under Section 37, subsection 1. Very interesting. Question number 2. Can I claim deduction under Rule 9A if my film was not at all released in cinema halls, but it was directly released on OTT platforms like Netflix, Amazon Prime, Hotstar, etc.? Please note that deduction is allowed only if it is certified by the censor board. Since censor board provisions don't apply to content on OTT, Rule 9A is not applicable, my dear friends. Rule 9A does not hold any overriding effect on the other provisions of the Income Tax Act or the rules as such. And it should be noted that in case of any expense which cannot be claimed as deduction under Rule 9A, shall be claimed under Section 37(1) of the Income Tax Act if the expenditure was wholly and exclusively incurred for business. Third question. In the year 2013, Lucia, an independent Kannada film made by an ex-IT professional, Mr. Pawan Kumar, created history. The movie, a psychological thriller, was made on a total budget of 71 lakhs. It was the first ever crowd-funded movie in India, and Mr. Pawan raised around 51 lakhs from the general public in just 10 days. The movie was also sold to Udaya TV for about 95 lakhs in 2013. Now the question is, out of 71 lakhs, would 51 lakh be allowed as an expenditure because it came from other sources? Now, since it was used for producing a film, my dear friends, Rule 9A would apply. Rule 9A is not concerned with the source of funds. You could have taken a loan as well for your movie. It doesn't matter. Rule 9A is only about expenditure. But another interesting question. Would the 51 lakh be treated as donation and would it be taxed at the hands of the producers? Yes, my dear friends, under the head income from other sources, under section 56 subsection 2 clause 10 subclause A, 56 to 10A, if the donation is more than rupees 50,000 rupees. Very, very interesting areas that we have discussed today. Hope you enjoyed the video, my dear.
All right, buddies. So hope you understood. Yes or no? Yeah. So if we study income tax that way, becomes very easy, right? So whatever is there in this one page, I could have explained it in 7-8 minutes anyway. Instead of that, I thought I'll do something different and explain it through a video. Okay? Fine, guys. So that completes what? PGBP. Easy? Yes, it is very easy.